Very good morning. You're watching India Market Open, and is it going to be a bit of a day for consolidation? That is the question. While Trump is sounding decisively dovish on China for a change, but India has already heated and run up, so you could see some profit booking today.
Yeah, who's going to blink first? Apparently, you see that Trump has started blinking. I don't know whether the blink is going to remain that way or he keeps his eyes wide open next.
Yeah, and the impact, if you think about it, our markets have already started seeing that ahead of, because yesterday's session itself was absolutely volatile, right? And it's the banking space which actually started to see profit booking. So if that continues, probably you could see that consolidation that you're talking about.
Just one more factor to keep an eye out on, and it has had no impact on Indian markets yet. But if you look at what the Ministry of External Affairs has announced as measures against Pakistan because of the Pahalgam attacks, and there is an all-party meeting today to decide what next. So those have been very, very stringent. We're withdrawing diplomatic missions, 48 hours for all Pakistani nationals to leave the country. SARC visas are being cancelled. So some of the harshest and strongest measures in a while. So that will be in the backdrop. That is there going to be a military retaliation that you could see? So that's one factor I think that I would watch out for more than
certainly very important.
But global markets are looking good, and largely because of Trump sounding like he wants to make a deal and sounding like he's easing off on China now, saying Xi Jinping is my friend, etc. So US stocks were set for another day of gains as Trump was hinting at easing tariffs against China. All the key indices up in the green as those sounds became more and more friendly coming out from the US president. The Dow was up over 400 points. NASDAQ was the one zooming 2.5% up. S&P 500 also up. Key results are going to be in focus as far as the US is concerned in terms of earnings. Intel, Alphabet, all of those on track and on deck, so that'll be watched out for. The Dow Jones, that's why in the green, but Dow futures cooling off now at this point. Bond yields have remained completely rock steady on hopes of a trade war easing. Nothing much happening there. The 10-year at 4.36%. Oil prices were up on exactly those reasons, even though OPEC Plus is saying that they're going to curtail some production, but Brent at $66 mark. Asian markets opened up after that softer stance on China. So you will see some relief coming in there. Not so much for India, though. The India implied showing that you could end with mild cuts, or you could start with mild cuts. Remember, this can also be a bit misleading. You've seen this on several days where you see the implied showing maybe a bit of a open down, but then the mood changes, so we'll have to wait and watch. Meanwhile, just, a lot of Trump sound bites to choose from, but we've chosen this particular one because here is where he sounds decisively like he wants to ease off on China. Listen in.
Yes, earlier today, Treasury Secretary Bessent suggested that with tariff rates as high as they are now, it's effectively an embargo of trade between the United States and China. Do you see it that way?
That's true. 145% is very high, and it won't be that high. It's not going to be that high. It got up to that. We were talking about fentanyl, where various elements built it up to 145. No, it won't be anywhere near that high.
Yeah, and a couple more reports also coming through. You had the U.S. Treasury Secretary Scott Bessent talking about the fact that high tariffs between the U.S. and China not sustainable. You have a Wall Street Journal report that also talked about the fact that according to sources, according to a senior White House official, you could have the tariffs on China dropping to 50 to 60%. All of this is up in the air right now. We'll have to see how that pans out. What we do know is what happened in trade yesterday. And I must confess, it was quite a bit of fun looking at what happened over the last 7 days. So let me first tell you about the flows. Yesterday, you had buying once again by foreign institutional investors to the extent of about 3,330 crore rupees. Domestic institutions once again selling to the extent of 1,235 odd crore rupees. The Nifty 50 staged an intraday comeback. In fact, if we can pull up the intraday chart from yesterday, you will see that at one point it had dipped into the negative, but it made quite a bit of a comeback. It ended higher by about 0.7% or thereabouts. It is now the 7th day of gains on the trot for the benchmark Nifty 50. Foreign institutions net buying equity for a 6th straight session. Now take a look at this, right? You've had gains of nearly 2,000 points, 1,929 odd points on the Nifty 50 and 8.6% gains. The Nifty Bank has contributed to a large part of that, gaining about 10.2%. If you thought IT has not participated, well, after yesterday's move, it is up there, gaining about 8.9% or so in that same time frame. And you might have thought that the concentration of the gains was at the large cap end. Well, that isn't the case either, because you have the mid cap index that's gained about 10.7%, and you have the small cap index that's gained close to 11% in just the last 7 sessions. So bear that in mind. It has been a broad-based, across-the-board rally in stocks. And so therefore, what Hiral was pointing out at the start, consolidation may just be on the cards. The gains were in trade yesterday despite the cool off in banking stocks. Again, we mentioned this 0.5% cuts or thereabouts for the Nifty Bank. IT stocks took the baton, with the index gaining about 4.4% in trade yesterday. Infi, HCL Tech, TCS were the top 3 contributors on the Nifty 50. M&M, Tata Motors, Hero MotoCorp, by the way, gained quite substantially from the low points of the day and were among the best performers on the Nifty 50 in trade yesterday. In fact, the Nifty Auto ended the second best sector, gaining about 2.4%. The mid-cap index gained about 1% yesterday, and the small-cap index was up about 0.33%. I do want to point out a couple of outperformers in trade yesterday. We spoke about this. It was on our list, which is why I'm pointing it out. Waaree Energies on the back of a strong Q4, as well as the outlook for EBITDA growth in FY26, as well as EU Small Finance Bank. Both gained quite substantially on the back of earnings.
Right, so that's going to be an interesting part to watch out for. Thanks, Alex, for that. But clearly, if you talk about trade tensions, they are somewhere fading. So if you talk about the Indian markets, the focus is shifting in terms of the earnings season. Today is a earnings heavy day as well. Before we talk about the companies, but one aspect I want to consider in terms of China and tariffs is if China tariffs are going to be reduced, and as you mentioned that Wall Street reports are indicating a reduction to 50 to 65%, no final decision has been made. Sectors that could have been beneficiaries on the back of higher tariffs in China from India, they could be the ones probably could see a sentimental negative move. So say stocks like a UPL or a Jubilant Ingriva from the chemical space could see some bit of pressure
Apex.
today. Absolutely. Chemical companies, so textile companies is another aspect to watch out for. So these two aspects from the tariff perspective will be in focus in today's session. But overall, the outlook in terms of the markets, short term, that bullish tone continues to remain intact. What you should be watching out for is any profit booking or any signs of sideways consolidation. Now, there has been no confirmation in terms of a reversal pattern in spite of that profit booking that's happening at higher levels, and that tiredness at highs is still not visible clearly. So that uptick could continue. Overall, strong support coming in at 24,000 levels, and that's where that put open interest accumulation has been absolutely strong. So that's going to be the support zone that we should be watching out for. If Nifty breaks below that 24,000 level, then a minor pullback is something that could be on the cards for Nifty 50. And on the upside, you're watching out for 24,500 to 24,550 if the rally continues. And from there, 24,800 is what the street is watching out for. Moving on to in terms of where Bank Nifty goes as well. Now, the momentum indicators, if you look at the RSI data as well, that has been weakening. And taking that into consideration, the key support that you should be watching out for in terms of Bank Nifty is at levels of around 55,000. So there could be some bit of profit booking that could be coming in terms of Bank Nifty as well, with the kind of upside that you've seen overall. And very lastly, as Tamanna was mentioning about the IT companies or the tech companies in the US markets, you have NASDAQ, which has ended higher. So there is a probability that the tech upside that we saw in terms of yesterday's session, that could continue as well. So that translation into Indian markets could happen in today's session. 4.5% up move in terms of IT sector yesterday, a potential upside that could be on the cards today as well. Very quickly, the earnings that are on the cards today. So you have a HUL, Axis Bank, L&T Technologies, Persistent System, Tech Mahindra, Nestle, Emphasis, Laurus Labs, these were the ones that will be reporting numbers as well in terms of today's session. So that's what the markets are looking like for in terms of today's day. But Tamanna, an interesting note that's come in from a UBS with their target price as well.
Yeah, so, this has been across the board. Last few days, you've seen everyone from a Morgan Stanley to now a UBS also completely, re-looking at India very, very closely in terms of what they're seeing. So UBS's India strategy is basically they're upgrading India to a neutral from an underweight. So that is the first thing that they have done, and then they've given their reasons why as well. They say they still prefer China over India, but China remains their key overweight market. Having said that, India is definitely up there as far as UBS is concerned. So one of the reasons is they expect consumption-led recovery in FY 26-27. So this is key to watch. Kiral talked about how HUL numbers today, but apart from the numbers, the commentary that will come in from Rohit Java will be something that the street will be watching very closely from an HUL. Lower oil prices is helping us. They're aiding GDP growth and helping in lower inflation. That's UBS's take. India is better placed than Asian peers to weather the US tariff impact as well. Valuations are reasonable, says UBS. They prefer financials, consumption, auto, cautious on industrials, IT and pharma. They expect an 8% upside on the Nifty 50, one-year target of 26,000, one-year target from today of 26,000. Top 6 buys are focused on domestic market, consumption-driven. They say India has margin expansion potential and industry trend is improving. So here's their top picks: Hindustan Unilever, ICICI Bank, Indigo, Sun Pharma, Trent, TVS Motors as well. Their top sell stocks that have potential for consensus earning downgrades are also there. The sell stocks pricing in unrealistic assumptions. These are Asian Paints, Bajaj Finance, Cummins India and Jubilant Foodworks. So very clear list there from UBS, and you could see some reaction on some of these. Well, what are the other factors to watch? Earnings are back in focus as trade wars ease. This is something Hero talked about as well. I would watch out for what is happening on the diplomatic end and geopolitical end with India and Pakistan, because India has put out its most stringent actions on the diplomatic end against Pakistan. The Indus Water Treaty, etc., has been called off. A lot of things that we have not done in the past. Will there be military action that follows is something that the street will watch. You could also see consolidation at current levels now, because Indian equities have been up for the 7th straight session. The Nifty has rallied over 2,600 points from the 7th April lows of 21,743. So you now have a key support coming in at 24,000, which holds the highest put open interest. Resistance for Nifty is 24,500 to 24,550. The Bank Nifty has corrected 0.5%. Remember yesterday, after the sharp rally, the RSI, Bank Nifty RSI at 73.89 indicates an overbought zone. So the RSI is basically an indicator of momentum and the speed with which an index is moving. Over 70 means you could be in the overbought zone. So it is 73.89, but it is trending downward. So watch out for that figure, which is why it's important to understand. The Bank Nifty resistance is at 55,901, support at 55,186. But it's also going to be an interesting day because it's expiry day. Puneet joining in with more on that.
Well, thank you for that. So definitely, while the GIFT Nifty is indicating that we're going to start in red, we are seeing traders as well as across FIs also cover shorts in the market today, and we have the Nifty rollover data to pull that up as well. So if we can go to that, while the April open interest of course is coming out and has fallen by 37% because expiry is today, so we generally see that trend in the last week of at least in the last couple of days. Definitely the May open interest as well has actually is just up about 50%, and that's lower than the average that goes on across the contract. So we are seeing that traders are on the sidelines. They've covered their short essentially for April, but are not rolling over their current position in May as well. If you can also look at the Nifty Bank rollover data as well, that's another key aspect. While the April number is existing, the May open interest is really minuscule, just 11% compared to 50% of that of the Nifty. So Nifty Bank, a lot of traders also mentioning that these are very stretched levels, and the up move has been very fast, in very fast pace essentially. So banking stocks will be something to look at again. The IT index will also be in focus. We have 5 IT earnings today. Persistent has already come out with its earnings already. Thumbs up we've given to that, and we'll talk about that later in the show as well. But we can look at the open interest distribution for the Nifty as well. 24,500 seeing a lot of interest in terms of the calls, while we've seen call writing specifically at 24,200 as well as 24,300. Today in expiry, that will be the narrow band where traders will be focusing on. So overall, while implied open is indicating the red, I think where we close again will be one of the key levels with banking as well as IT stocks in focus.
Banking, IT in focus for sure. IT is surprising everyone, and we'll see what those results look like. I have two IT companies on my watch list. One has a thumbs up, one has a thumbs down, but I'm going to start with a different one. Tata Consumer first, giving it a thumbs up on their numbers. Numbers are largely in line. The India branded business volume has seen a growth at 6%. Revenue growth has been led by pricing. There has been some margin contraction on higher tea costs. And management has indicated slower opening of Starbucks stores. They are sitting on cash of 1,800 crores. Faster growth in low-end products and premium products is being seen, and the price hikes have covered only 46% on inflation. So there could be more there to go. But let's look at the core numbers for Tata Consumer. Revenue up 17.3% to 4,608 crores versus 3,927 crores. But this is a tad above Bloomberg estimates of 4,555 crores. So you could see an up move on Tata Consumer. Net profit is up 59% to 345 crores versus 217 crores, a beat on estimates as well. EBITDA is down just about 1% to 621 crores. And that's still better than what was estimated. So it's a beat on all fronts. Margins at 13.5% versus 16%. Exceptional items for this year include a gain of 120 crores and 72 crores of assets were written down. The board has also recommended a dividend of 8.25 rupees per share. What are brokerages saying? Citi has maintained a buy with a target price of 1,350. Believe they will see margin recovery in the second half of this financial year, and say that the growth trajectory remains intact. JP Morgan has maintained a neutral, hiked the target price to 1,100 from 970. It's already at 1150, but they say post the recent share price rally, valuations cap upside. Jefferies, meanwhile, has downgraded to a hold from buy. Target price is at 1,100, but that's largely because of the run-up that the stock has already seen. The stock is up 24% Y2D, which has pushed up valuation to 70 times FY26 estimated PE, hence the downgrade to hold, even while they like the structural food story. So their downgrade is more of a valuation situation. Let's talk about LTI Mindtree in Q4. That's a thumbs down. It's a weak operating performance. Revenue growth has slowed due to delayed deal ramp-ups and cautious client spending. There was weakness in the healthcare vertical. Revenue is up 1% at 9,772 crores, below estimates. EBIT was up 1.2% at 1,345 crores, also below estimates. Margins have been pretty much steady at 13.8% versus 13.7%, but again, below estimates. Net profit was up 4% at 1,128 crores. So what can we say about the results? Constant currency revenue growth at 0.6% Q on Q, and they have benefited from operating efficiencies. We'll have a conversation with the management as well later on. Hopefully we'll hear from them, as we will from Persistent. We're waiting to hear from Persistent. Remember, their con call starts anytime now, so we'll get those flashes for you up on the screen as well. The results looked good. Results have met estimate. The dollar revenue is up 4.2% quarter on quarter, which is going to be a positive. Its overall consolidated quarter on quarter revenues are up nearly 6% at 3,242, so slightly above estimates. Their EBIT is up close to 11% at 505 crores. This is also above estimate. Margins have also gone up from 14.9% to 15.6%. Net profits were up 6.1% at 396 crores. So Persistent is another good set of numbers that we've seen this time. So not half bad for the IT pack.
Yeah, I mean, surprising on the upside, certainly, right? When there was this pall of gloom, that doesn't seem to be the case. It's dissipating. I've got an interesting stock at the top, and, Dalmia Bharat. Before we get into the numbers, take a look at the intraday chart yesterday, because towards the end of the session, you saw quite a pop in the stock price, and it recovered quite substantially from the low point of the day. But the revenue picture is not really great. The the real improvement is on the margin front. We'll come to that. But 5% decline in revenue on the back of volumes, which we knew about already, and they were not really the best. But having said that, the EBITDA came in line with expectations, growing as much as 21%. And that is on account of an expansion in the margins. That came in to 19.4% compared with 15.2% and ahead of consensus estimates, which had pegged it at 18.6%. This is on the back of cost side factors. Costs have actually been beneficial for the company. The net profit as a result of which has come in ahead of expectations, up 38% at 435 crore rupees or thereabouts. So a couple of brokerage notes. Jefferies on the company saying that it's maintaining a buy with a target price of 2,050. It says that the revenue was a miss on weak volumes, but the unit EBITDA is in line and the realizations are tad below, but the costs are near estimates. That is certainly something that should be watched at the start in trade. Canfin Homes from the financial pack is a thumbs up. Strong performance operationally. Net interest income growing as much as 6% on a year-on-year basis. The operating profit is also grown by about 8% or so. The PAT growth is at 12% or thereabouts. ROA is strong at 2.59%, in fact better than the comparable quarter, up 34 basis points sequentially. The non-performing assets ratio is also pretty decent. It's actually improved about 5 basis points sequentially. The NIM has actually improved 9 basis points in the current context, which is quite interesting. It's at 3.82% versus 3.73% in the previous quarter. What are brokerages saying? Morgan Stanley on Canfin Homes has maintained an overweight rating with a target price of 800. The stock closed at 745, so not the most upside. What are they saying? They're saying that the pre-provision operating profit is in line. The PAT is a beat on lower tax rate. The disbursements guidance was met. The stage 3 provision coverage has improved, which is for basically for advanced stages of non-performing assets. And they're basically confident, or they're positive on the management outlook on FY26 loan growth. Jefferies has also maintained a buy with a target price of 915. They're saying that the disbursement improved, and then NII, though, was a tad bit below. The third stock on my list is also in the financial space, Tamil Nadu Mercantile Bank. This is a thumbs up as well on the back of strong PAT growth. This came in on the back of other income, though. Margins have shrunk about 13 basis points sequentially, but there are no concerns on asset quality in this one, so this is a positive. The net interest income has come in at 568 crore rupees. That's just about flat. The operating profit has grown about 10% or thereabouts, and provisions have come in at 17 crore rupees compared with 3 crore, so slightly higher than the previous quarter, but nothing really to worry about. PAT is up as much as 15%, and the ROA has actually improved to 1.81% compared with 1.7% in the comparable quarter. So it's looking good for the financial space. The only question is whether or not some consolidation plays out for the entire space, as you pointed out, Hira.
I mean, that's what it seems like, taking into consideration the kind of up move that we've seen. But staying with the financial space, I mean, the NBFCs, you have a Bajaj Housing Finance that is in focus today. Again, it's a thumbs up on the back of earnings. If you see it in terms of the growth trajectory, the NI has seen a growth of around 31% on a year-on-year basis. So a strong growth number on that front. Your operating numbers have also, I mean, the profit number has seen a growth of 43%. So that is what is actually going ahead and aiding your profitability with regards to a Bajaj Housing Finance. So your PAT has seen an improvement by almost 54%. The loan loss provision, that number has come in at around 30 crores. Now you have a Goldman Sachs, however, has maintained a sell rating on the counter, and they have a target price of 82. They've cut it by 1 rupees. According to Goldman Sachs, it's an operational miss. The spreads have declined, and this is mainly on the back of lower yields. And if you talk about the individual home loan growth, that is something that Goldman Sachs is not happy about, because they think that is lower than what the street was estimating, and this reflects a slowdown in the industry growth. Now, if you talk about the spreads, that is indicating higher competitive intensity, and it's trading, in terms of the stock, it's trading at a significant premium to the multiples that erstwhile HDFC traded at as well. So that's the view coming in from a Goldman Sachs, but it's going to be an interesting one to watch out for in terms of Bajaj Housing Finance. Moving from there on, you have a Syngene. it's a thumbs down. Now, what has happened in terms of Syngene is, if you talk about the estimates, that's what it has missed. On the top line, it's missed estimates. If you talk about the margin picture as well, the expectation was 34.8%. The number has come in at 34.2%. And in terms of the net profit number, the expectation was around 192 odd crores. The number has come in at 89 odd crores. Now, yes, they have crossed 1,000 crores in terms of the quarter threshold, and this has happened for the first time. The revenue growth has mainly been driven by biologics, CDMO, as well as the commercial projects. And the decline that we've seen in terms of where the EBITDA margins are concerned, that is mainly on the back of low gross margins as well as a higher employee cost. The profit impact is mainly on the back of a higher tax outgo. Now, key is going to be what you can expect in terms of FY26. So the guidance in terms of FY26 has been significantly lower and it's below expectations. The reported revenue growth is likely expected to be in the mid-single digits. There has been adjustment that they will be doing due to client inventory balancing. New biologics facility will be increasing operating costs as well as the depreciation for the company. And a year-on-year decline in terms of the profitability that could be on the cards. So the outlook in terms of FY26 is the reason why we are giving it a thumbs down. And if you talk about Thyrocare as well, it's a solid margin beat overall in terms of Thyrocare. The revenues are up 21%, margins at 30.8% versus 21.9%. The net profit has gone up by around 22% for the quarter. It's mainly the pathology and radiology segment which is supporting growth this time around. Partnerships has seen a higher growth versus the franchise model. And overall, it's going to be a thumbs up. The stock ended with cuts of 3.5%. So don't be surprised if you do see a sharp up move in today's session. So 2 pharma stocks and a Bajaj Finance.
Margin performance for Thyrocare
is absolutely fantastic.
After the acquisition, it has changed and managed to move in a place which is dominated by the metropolises of the world. Agilis, so much competition coming in as well.
And pathology and hospitals are the space what people are talking about, taking into consideration the kind of capex hospitals are making and the way the occupancy levels that have been increasing for them right now. And I think it's the best season. Sorry to say that, but it's the best season.
The flu season. It's when everyone needs to get their tests and hopefully not be hospitalized. But, the other big national development that we need to track today, the government yesterday paused the Indus Water Treaty, shut the Atari border with Pakistan after over 26 tourists were killed in a terror attack in Kashmir. These strong diplomatic and strategic countermeasures were aimed at Pakistan. Our colleague Sanjana Chauhan is giving us a summary of all of the key announcements from the External Affairs Ministry last evening.
Following a 2.5-hour meeting of the CCS, the MEA came out with India's diplomatic offensive, announcing a slew of measures after the deadly Pahalgam attacks that took place yesterday that saw 26 civilians killed. First up, the Indus Water Treaty, held in abeyance with immediate effect until Pakistan ends support for cross-border terrorism. Then came the Atari border closure. Integrated checkpost has been closed immediately. Those with valid endorsements must return by May the 1st. The MEA also announcing a slew of measures when it comes to SAARC visas. First is the visa exemption scheme. Pakistani nationals will no longer be permitted these SAARC visas. All previously issued visas to Pakistani nationals are cancelled with immediate effect. Pakistani nationals currently in India have 48 hours to leave. Then came the diplomatic measures. Defense, naval, air advisors at Pakistani High Commission in New Delhi have been declared persona non grata and have been given 1 week to leave. India will withdraw corresponding the defense, navy, air advisors from the High Commission in Islamabad, and the overall staff strength at both High Commissions will be reduced from 55 to 30 by May the 1st. Then, measures around security vigilance. All forces have been directed to maintain high alert. There is a commitment to bring the perpetrators and sponsors of the attack to justice, and the MEA also assuring continued efforts to pursue terror conspirators exemplified by recent extradition cases. So India talking tough, taking swift measures right after the attack took place yesterday. The Prime Minister cancelled and cut short his trip to Saudi Arabia, flew back to India and held this CCS meeting with Amit Shah, with Rajnath Singh, with Nirmala Sitharaman, and these measures being announced by MEA's Foreign Secretary right after the CCS meeting took place in the national capital for 2.5 hours.
The Indus Waters Treaty of 1960 will be held in abeyance with immediate effect until Pakistan credibly and irrevocably abjures its support for cross-border terrorism. 2. The integrated checkpost Atari will be closed with immediate effect. Those who have crossed over with valid endorsements may return through that route before 1 May 2025. 3. Pakistani nationals will not be permitted to travel to India under the SARC visa exemption scheme visas. Any SVAS visas issued in the past to Pakistani nationals are deemed cancelled. Any Pakistani national currently in India under SVES visa has 48 hours to leave India. 4. The Defence, Military, Naval and Air Advisors in the Pakistani High Commission in New Delhi are declared persona non grata. They have a week to leave India. India will be withdrawing its own Defence, Navy and Air Advisors from the Indian High Commission in Islamabad. These posts in the respective High Commissions are deemed annulled. 5 support staff of the service advisors will also be withdrawn from both High Commissions. 5. The overall strength of the High Commissions will be brought down to 30 from the present 55 through further reductions to be effected by 1st May 2025.
Okay, have no doubt that this is going to be a very important development to track over the course of the day. Of course, everything that's happening globally has a bearing on markets, but this is the most important domestic story to track over the course of the day. And we will bring you updates over as and when we pick up more. Tamanna pointed out there's going to be more developments through the day that can have a bearing on the relationship between India and Pakistan. But in the meanwhile, let's take a look at a few developments. We've spoken about earnings and we're hitting our stride in terms of Q4 earnings. Let's talk about some more. Rallis, as well as Aztec and 360 WAM. We've got Varsha joining in to tell you about what stood out with them. Varsha, over to you.
Thank you for that. So let me start with Rallis India, wherein we've seen weak set of numbers. Now, why? Because volume and margin pressure in export market have actually impacted Q4 performance, and the EBITDA loss that you're seeing is led by pricing pressure when it comes to domestic crop care. Though there was a volume growth in domestic crop care business, but pricing pressure impacted the growth for them. The net loss that you're seeing is led by lower EBITDA. Next on the list is of course Aztec Life Sciences, wherein there was a sequential growth, but year-on-year growth is under pressure. Now the volumes in the enterprise business grew 2x year-on-year. The profit impact that you're seeing is due to sharp decline in prices, and there was a significant drop in CDMO volumes, and that's the reason if you see the revenue is down and the EBITDA is down 56%. Last on my list is 360 WAM, wherein if you see the brokerage income has actually impacted growth, and the brokerage income was down 31% year-on-year. But overall, if you see the results were better than expected. Core profit was slightly above, and the transactional revenue at upper end of the guidance.
Right. Thanks, Varsha, for getting us the details. So 3 stocks that will be in focus. In fact, 361 did see a major beating over the last couple of trading sessions over some concerns, and then post that, when you talk about the entire UBS portfolio that has been taken over in terms of brokerage investment banking, that has been a key positive for them. So interesting moves that could be coming in on that counter as well. But let's quickly look at our NDTV profit list. Firstly, Adani Green Energy, a thumbs up as they've entered a PPA with Uttar Pradesh Power Corp. On number 2, you have a Bajaj Finance, where they will be considering a stock split, so that's a thumbs up. Bajaj Housing Finance, again in terms of the numbers, there has been operational efficiency which is aiding profitability this time around. So on our radar, Canfin Homes again a thumbs up on the back of growth that they've seen across matrix. And you have a Dalmia Bharat where the profit numbers have beat street estimates.
Okay, and lots of stocks to talk about. NHPC is also on the list. It is set to develop a 1,200 megawatt solar park in Uttar Pradesh, and this is a positive development. Quite a considerable capacity there. Persistent Systems, going to hear from the management soon, if not already. The Q4 results are largely in line with expectations. Popular Vehicles and Services, it has gotten orders to set up Ather 3S facilities. Tamil Nadu Mercantile Bank, a strong PAT growth on a higher other income, and from the financial space, certainly something you should watch out for. And Tata Consumer Products, one-offs which have driven the PAT beat in the fourth quarter.
Well, the other stocks that are on focus and in the green category this morning, Thyrocare is definitely one of them. Strong margin expansion is the reason. Vascon Engineers has orders worth over 225 crores. Thumbs down for an Aztec Life Science. Losses widened on price decline. LTI Mindtree is a miss on estimates across all metrics. Rallis India has seen losses widen on volume, margin pressure in exports. Syngene, on the other hand, FY26 guidance is significantly below expectations, so expect some pain on Syngene as well. Right, Kunal Shah joining us this morning, Senior Tech and Derivative Analyst, Mirai Asset Share Khan, Chakri Lokpriya, CIO, Equities, LGT Wealth, also with us today. Welcome to both of you. Very good morning to you. Kunal, are you expecting some recovery in the bank Nifty, or the trend remains downward after the kind of up move we've seen? Let's start there.
Good morning, everyone. Definitely, in this entire rally, Bank Nifty has been a very strong leader. But there are initial signs what we are seeing of at least profit booking from high levels. So 56,000 was our target, which Bank Nifty has achieved. The rally was sharp from 50,000 to 56,000. So almost a 6,000 point rally what we have seen in the Bank Nifty index. So we expect some profit booking to kick in from current levels, and we are seeing sector rotation happening where you are seeing some profit booking coming in the banking space, and this has been shifting to sectors like pharma, auto, where we are seeing good buying interest. So I think it's good time to book some profit in the banking stocks. You can expect Bank Nifty again to come down towards the mark of 54,500, which is the support zone for Bank Nifty.
What about Nifty? What would you do on Nifty? And of course, it's expiry day as well. Kunal, what would be your strategy there?
See, for the expiry day, Nifty in yesterday's trading session has witnessed sharp recovery from the lower levels, and that was all backed by IT, Pharma, and auto. These were the three sectors which gained some strong momentum. Even if you look at the open interest data for the Nifty index, the PCR is still above 1, that is 1.08, and we have seen put writing at 24,100 and 24,200 strike. So clearly the base is strong on the lower end. I am not expecting 24,200 to be breached on the downside in today's trading session. And the higher end, the resistance is placed at 24,500, which is the strike price where the highest open interest is built up. So I'm expecting this range of 24,200 to 24,500. Between this, Nifty should expire in today's trading session. So my strategy over here would be to go for a long call butterfly spread on the options data, where you can buy 24,200 call option, sell 2 lots of 24,400 call option, and buy 1 lot of 24,500 call option. So this is generally a bullish range bound strategy, which is deployed on the day of expiry. The maximum profit what we'll be getting if Nifty expires at 24,400 in today's trading session. And that is what my expectation is, that Nifty should expire in today's trading session around the mark of 24,400.
Picks this morning, Kunal?
2 picks, both are on the buy side. First is from the pharma space, as we witnessed strong buying momentum in the entire pharma sector in yesterday's trading session. So over here, Torrent Pharma is the stock which has given a strong breakout on the technical parameter, a falling trendline breakout with volumes, and I expect this move to continue on the higher end. So Torrent Pharma is a buy with a stop loss of 3250, and one can look for targets of 3,400 to 3,480 on the higher end. The second stock would be from the auto packs. I think auto packs have started to resume the momentum, and we are clearly seeing the shift in the sector. So your Bajaj Auto remains a buy. One can buy at the current levels, keeping a stop loss of 8,100 and looking for targets of 8,400 to 500 on their hand.
Okay. All right. Kunal, point well made. And those are stocks that you should watch on the in trade today. But Chakri, morning, coming to you on a couple of the developments that we saw in terms of earnings, right? What did you make of Tata Consumers first and foremost? That is the one Nifty 50 stock to track at the start.
You know, the earnings are coming out largely along the lines of expected, not very strong, but okay. And margins are not really holding up in general. I mean, so I think that environment will kind of continue for the consumer space and as well as the other sectors. But, you know, it's par for the course at this point in the economic cycle. So, but the company is well positioned and I would still be buyers of the stock.
Right. So that's with regards to where Tata Consumer goes. In fact, Chakri, let me ask you even about an HUL that will be reporting numbers in terms of today's session. What is your expectation and what would your call be ahead of the numbers?
You know, all these FMCG companies have corrected significantly over the last 6 months to 1 year on the back of low volume growth as well as no margin expansion. And, you know, now the talk will be about whether there will be some amount of volume pickup. That is the key to watch out for. But other than that, I don't think margins will really move the needle that much. So I would still wait to see whether there is a pickup in volume growth. Basically,
you're saying no buy in terms of FMCG counters at the moment. You have no top picks there.
That's right. We're staying away from FMCG unless we see a revenue growth for the next year.
Okay. Kunal, I want to come to you and then I'll come back to Chakri on a stock that stood out in trade yesterday. This is Waaree Energies and it gained about 15%. I'm just wondering that if you did manage to get it perhaps last week or a little bit before that and you have significant gains, would you take money off the table at this juncture?
Yeah, I think definitely the move has been very sharp and the stock has been quite volatile. So the IPO at what it was listed, it went below the IPO price, and now we have witnessed a significant recovery from the lower levels backed by results. But I think the move has been extended now quite a bit. I think good time to book profits at the current levels and maybe wait for dips. Probably you will get better opportunities to enter on the long side.
Chakri, so the stock has moved up very, very substantially over the course of the last couple of trading sessions. And in fact, we already had a couple of brokerage notes coming through, one that has cut the rating to underperform or at least cut its target price. What do you make of the current valuations and would you also take money off the table if you had the choice?
The stock has run up very significantly, yeah, and you know the valuations for both Waaree Energies, Solar, all these companies are trading at very high valuations. So, you know, while their underlying businesses, both India, US, are doing relatively all right, I don't think at this point in the cycle we can give that level of valuation. So it's expensive, and therefore we would not be buyers of the stock.
I do want to talk about, so the note that I was referring to that I glanced at, I couldn't remember, Hero has very helpfully shown it to me. Jeffries on Waaree Energies, they've downgraded the stock to underperform from hold with a hike in the target price to 2,100, but the stock is at 3,007 right now, so potential downside is quite considerable. The hike is from 2,030, so it's not very much. They have given their Q4 review. They say that it's a strong print and the FY26 guidance is also good. Profits should inflect over FY26 to 27 is what they're saying, and they see lower imports into the US in FY26, that is the current financial year, on high inventories and weak non-DCR economics. Okay, I need to go to the analyst and figure out what non-DCR economics is. Do you know?
No, not very much in terms of what the DCR stands for in their note, but the downgrade is coming in only because of that 25% rally that we've seen in the last 1 month, that 14 to 15% up move. So I think the key over here is going to be someone who's holding Waaree Energies from a short-term perspective. This is for them. Longer term, probably. I mean, how much more of a downside can someone see, okay, because of the potential that they are seeing in terms of the profitability. If they are expecting that inflection to happen in 26, 27, clearly they are indicating it's a good recommendation from a longer term perspective. So it's a very confusing note that Jeffries has put out so far. But
so DCR is the domestic content requirement in the context of solar panels. That perhaps is not working out for Waaree. But
interesting.
I don't know if there is a view on Waaree that we should get even on the technical side.
We just did. So he said take money off the table.
Take money off the table after that bump up. All right, HUL. HUL is the other one that is in focus today. Hindustan Unilever will be coming out with their Q4 earnings. The company is expected to post a muted set of numbers. Mahima will be attending at that call, and hopefully we'll get an opportunity to ask HUL management a question as well. Mahima, what's on top of mind?
Right, so absolutely. As you rightly mentioned, it's going to be a muted quarter once again for HUL in terms of how Street is expecting the numbers to pan out, where revenue is expected to grow around 1%, EBITDA is expected to fall around 1%. Margins will contract on the back of raw material inflation, and net profit may fall around 3%. Now, in terms of what to expect, flat volume growth overall, pricing growth will be ahead of volume growth. Margins will remain under pressure. There will be subdued urban demand, which has been the case for Tata Consumer as well. Slow rural recovery is something that the Street is expecting, and overall weak wage growth and higher rentals will impact the overall profitability. In terms of key things to watch out for, well, pricing in key categories like copra, tea as well as palm oil, because they have been on the rise in the past few months. Outlook on the ice cream business plus the commentary on recent development of sunscreen war is something that we could expect the management to give some guidance on. Now, in terms of what brokerages are expecting, well, JP Morgan rates it overweight with a target price of 2259. They're saying that the revenue growth of 2% will be driven by pricing, and EBITDA is expected to mirror the revenue growth. Jeffries on the other side has rated it buy with a target price of 2289. They are expecting a margin dip of around 125 basis points due to raw material inflation, and weaker than expected demand in key categories is something that Jeffries is also penciling in. Lastly, UBS has rated it buy with a target price of 2,800. What they're saying is that the outlook for second half of FY26 looks better. For now, the company will post a muted set of numbers. So this is the overall view of what you can expect from HUL's Q4 numbers.
Muted set of numbers in the fourth quarter, but a second half in FY26 might be better. So therefore, very important to pay attention to the commentary, which of course Mahima is going to get you from ground zero, if you can call it that. Year-to-date performance, I'm talking about 2025 for Hindustan Unilever, has really moved nowhere. It's gone nowhere. It's just about 4% higher. I'm just wondering on the charts if there's any call. I know Chakri's already said that he's avoiding the FMCG space. Kunal, what would you do with an HUL?
Yeah, I think with the HUL, the FMCG as a fact has witnessed some recovery from the lower levels because they were trading in an oversold zone. So probably the larger term trend still remains on the negative side. So we are not able to even surpass the 200 DMA for HUL, which is placed at 25-23. So you might touch that 2500 levels on the higher end, which could be a pullback. But those would be the levels where ideal profit booking would kick in, and again we can see some further downside. So just if you are holding longs from the lower levels, continue to hold. We can expect a rally toward 2500, but that could be a good opportunity to book your profits.
HUL, you're saying not that great maybe. What about a Tata Consumer, Kunal? How would you look at a Tata Consumer? Numbers have come in. There are some one-time elements on it, but the numbers have been a beat on some of the metrics. Would you, Chakri is not too excited about Tata Consumer, but what about you on the charts?
Yeah, I think on the technical charts, now we have seen firstly the stock has regained its 200 DMA. There is a positive trend where high tops, high bottoms are still intact. The stock has already witnessed a good rally from the lower levels, so a lot of things have been discounted. Wait for good opportunities for entry. 1100 will now be a very strong support on the downside. Currently trading at 1150. So if you get it around 1100, I think a good buying opportunity. What we'll be getting, we can expect at least targets of 1200 on the upside.
Okay. Chakri, what is your opinion on Bajaj Housing Finance? The numbers that came through, 26% growth in assets under management, disbursements up about 25%, the NIM steady at 4% or thereabouts. And from what I remember, the ROA is also steady on a quarterly basis. But some have pointed out, among them Goldman Sachs, that the valuations are very, very high and unsustainable at the current level, and they've given a target of 82 or thereabouts, which implies a considerable downside. What's your opinion?
You raised all the right points about the company. The loan growth was very good. The margins are right. In an environment of falling interest rates with RBI cutting rates, you'll see a further improvement in volumes for not just Bajaj Housing, but also the other companies as well in the space. But the valuation doesn't really justify. I don't know if Goldman's is like kind of overreacting on the downside, but I think there's not much upside. So from that perspective, given that the number of other companies are trading at much reasonable valuations, we'd rather look at them.
Sorry, I just to follow up, because this same brokerage is looking at Canfin Homes, for example, positively, and they came out with numbers overnight as well. So from the NBFC space, Chakri, given what we've seen over the course of the last few sessions, and if at all you see a cool off, any opportunities that you see, any names that you would focus on?
Canfin Homes, PNB Housing, all these companies, they'll all benefit going forward. One, there have been 2 rate cuts. So that in itself will help these companies in the next quarter onwards in terms of a volume pickup. And it'll also ease some kind of the liquidity measures will also improve their margins. So a combination of both these factors is usually a very good mix for these companies. And if you take Canfin Homes, the valuations are very attractive. PNB Housing is probably trading at about 1x more book. So from housing companies, the lower valuation companies, PNB Housing, Canfin, look good.
Right, so that's the housing finance companies. Staying with the BFSI space, you have a SBI Life that will be reporting numbers in terms of today's session as well. Overall, Kunal, what are charts indicating with regards to SBI Life? In fact, you did have the life insurance data also that came in over the last 2 trading sessions. But anything interesting, any picks from that sector?
Yeah, I think definitely I'll talk about SBI Life. I think the structure looks extremely bullish to me. The stock was in a sideways consolidation, and now we have seen a trend reversal in the stock. So I think even if you get any dips, on intraday basis, that would be a good opportunity to go on the long side. The potential target, what I see on the technical chart for the stock, is around the mark of 1725, 1750 on the higher end. So I think the risk to reward ratio is also favorable from the current levels. On the lower end, 1520 is a very strong support. So any dips if you get in intradays and today's trading session, that would be a good opportunity to go on the long side.
So that's with regards to SBI Life. Chakri, your picks taking into consideration the numbers that have come in for the month of March, because ICICI Prudential Life, Aditya Birla Sun Life, they've reported strong growth numbers. Worse than the industry where they've seen a degrowth, in fact, is SBI Life, Kotak Mahindra Life and Bajaj Alliance. And moderate has been HDFC, LIC and Axis Max. Your view on the sector, because this has been a sector which has been slightly underpenetrated, even from an investment perspective. So which would be your top pick?
Insurance as a space is something which we're avoiding as a whole, because, it's largely a volume-led growth with no margins and with a lot of regulatory pressures. The stocks have kind of underperformed in the recent past, and it's for a reason. And so in that context, given that there is no real earnings catalyst or business catalyst, yes, marginally in a push product industry. So from that perspective, I think, the valuations are all right for the sector, but I think we would rather stick to the lending businesses rather than an insurance businesses.
Chakri, are you liking IT? Huge upside yesterday. LTI, Mindtree numbers have come in. Persistent is not as bad. Tech Mahindra, everyone's waiting for. What would be your take on IT?
IT, as we all know, have corrected like 20-25% in the last few months on the back of well-known fears of a slowdown, discretionary spend slowdown. Largely, the discretionary spend slowdown is showing up, but the valuations, Wipro at 17 times, HCLT also in about 18, 19 times. The valuations are there. So the order book needs to convert. That will unlikely to happen. So, I think the stocks have hit a kind of a bottom. But is there a significant catalyst upside? I don't think so. But so therefore, if incrementally we would buy into an HCLT and an Infosys, and maybe a Persistence as well.
Okay, so that's interesting. So you're saying you will buy IT at this point. Your top pick would be an HCL Tech?
Indeed, because the valuations have corrected.
Yeah.
The numbers were all right as yesterday, as we know. The order book conversions is the key, and that is going to be soft in the next quarter with all the uncertainty in the US. But then it will come back. Needs to come back. So assuming the worst, I think we've hit the bottom. There's not much downside for the stocks. Therefore, we will be incrementally buyers, reducing some of that underweight positions in IT.
Okay. Kunal, what about you? Is there anything then in IT that you would pick right now? View on Persistent and LTI Mindtree, because they've reported yesterday. Let's start with that.
Yeah, I think, yes, IT has seen a strong pullback from the lower levels, but overall the larger term trend still remains on the downtrend. So this is a pullback of what we have witnessed in the IT space, and we might see some profit booking at higher levels. However, from the current levels, I think Persistence still looks stronger on a technical chart. On the higher end, the resistance for the stock is placed at 5,300, 5,400 zone. So currently trading at 5,200, more 200 to 300 points upside is left, but probably that would be a good point to book profit. The larger term trend for the entire IT index on the technical chart has been on the negative side. We are trading below the 200 EMA. We had already breached the support zones on the downside. Now the immediate resistance for the IT index is at 35,700. So we are currently trading at 35,400. So for current levels, more 300 points could be the upside for the index. Probably from those levels, again, the profit booking would kick in, and we might see further lower levels for the IT index.
Okay, Gensol fiasco has, impacted quite a few companies. And after that, Spandana Sphoorthi Financial has announced the resignation of its Chief Executive Officer, Shalabh Saxena, and the appointment of a CFO, Ashish Kumar Damani, as the interim CEO. Harsh joins in with more details.
Well, yes, so that's a big move, actually. And they had an analyst call last evening as well, where they reiterated that this is on the basis of certain personal preferences due to which Shalabh Saxena will be moving on. It's a significant development because we've seen headwinds in microfinance in the portfolio as a whole across lenders, but Spandana in specific also has faced its set of concerns with regard to microfinance. Recovery is expected in a quarter or two, with a leadership change plus a recovery at play that somewhere in some form delays things. So that's probably one larger overhang which is getting created now. The other piece is also with regard to how analysts are viewing this. So what analysts are saying is that Shalabh was instrumental in stabilizing the franchise post the exit of erstwhile promoter Padmaja Reddy, and Shalabh's exit might well lead to senior level team members also leaving. They're also saying that Shalabh's exit would make the bounce back journey for the MFI NBFC more difficult, and therefore some bit of skepticism around this.
Okay, Spandana Sphoorthi is going to be a tricky one to watch today. Chakri, is this a stock or a company that you've been tracking? Any views here?
Not really, but given so much uncertainty, it's best not to go after trying to buy these companies at these levels.
Okay, in terms of Bajaj Finance, let's talk a bit about Bajaj Finance stock split today. Chakri, in the NBFC space, leader Bajaj Finance, how would you look at a Bajaj Finance today?
Numbers were good, margins kind of held up. The perennial problem with Bajaj Finance is its valuation. Does it justify that valuation? Probably not. But given that the numbers are coming in, we would hold on to the stock.
So that's with regards to where the financial space goes. Kunal, taking into consideration, the chemical space and the textile space, how are you looking at a PI Industries, Pharma in Greva, Jubilant in Greva? What are charts indicating?
Yeah, I think chemical as a sector has witnessed strong recoveries from the lower levels, but still we need a lot of confirmation on the technical charts. They have been beaten down, and we are seeing the pullback that has played out in this entire sector. But still, we need some confirmation for PI Industries. There is a resistance at 37.30 on the higher end, and once that is taken out, you can expect a move toward the 200 DMA, which is 39.64 on the higher end. So if you look at the entire chemical basket, they all have been trading below the 200 DMA. So the trend has been down. We need to firstly surpass these levels decisively for a trend reversal, and probably from there onwards the momentum will resume and you will see further upside. So from the current levels, only PI industry is one stock on the technical chart, which is looking a bit on the stronger side, but still needs confirmation. 3730 is the level which you should keep on your radar. Once that is taken out, then you can expect a rally towards the mark of the 200 DMA, which is placed at 3900.
Okay, so what will be the target price and what is the stop loss on this counter then?
So for PI industry, the target on the higher, it is a conditional buy. That is firstly the buy above 3730. Look for targets of 3900 and keep a stop loss of on the downside at 3600.
Right, so 3600 will be a stop loss as well. Thank you, Kunal, so much for joining us on the show and sharing your topics as well. But let's quickly slip into a short break. We'll be right back with Pre-Open.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
Welcome back. First rates beginning to hit. We will wait for it to settle. A couple of things to watch out for. Will Bank Nifty see some kind of recovery after dropping about 0.5% down? Remember, Bank Nifty has been the star of the show. That's one thing to watch out for. Nifty IT. Will you see Nifty IT continuing its up move ahead of the results? What will Tech Mahindra do? How will Persistent fare? Persistent con call had some very interesting commentary coming in there from the management as well. So that's one to watch out for. 10% up on the stock. We told you it's a good set of numbers. It was on our watch list. I want to pull up LTI Mindtree also very quickly. Wasn't the best set of numbers, and you're seeing that reflecting. These are very, very initial rates, so they will settle. Keep that in mind. Shrikant Chauhan joining in on our conversation this morning. Shrikant, very good morning. Always great to have you on. What are you seeing on the Nifty and the Bank Nifty today? Let's start there.
Good morning, Tamanna. Good morning, everyone. See, the broader structure of the market is indicating us that we are heading for the levels of 25,000 plus. So it will take some time, but at the same time, we cannot forget that the market moved to these levels without any correction in between. Also, if we consider the trend of last 2 days, then there we can see that it is finding some difficulties to sustain at higher levels. I'm to say we are seeing some profit taking in those sectors where we saw very strong outperformance in last 2 months, and now traders have started looking for those sectors which have underperformed in last 2 months, like IT and all. So I'm of the view that at these levels we need to be careful in the short term. We could see some correction. Yes, the possibility of hitting 23,800, 900 are turning bright based on the current news flow as well as the technical structure of the market. And for the day and for next 1 or 2 days, the strategy should be to look for creating some short positions with a stop loss at 24,400. In case if it breaks 24,400, then the chances of hitting 24,600 or maybe 700 would turn bright. So ideal stop loss for creating any short position should be at 24,400 on intraday basis. And below 24,100, we can see further more weakness in the market. For the bank nifty, there also I'm seeing some range bound activity, and the possibilities of 54,500 are turning much higher.
So, Shrikant, when you say there's a possibility of a further correction that could be coming in for the short term, look at stocks which will see some potential upside from here on. But when you talk about bank nifty, where is that support that you're seeing? Because you're already seeing some bit of profit booking that has started to come in terms of banking names. And if that is the scenario, which will be your top candidates to short in terms of bank nifty?
See, like at these levels where there is like we are seeing some sideways sort of activity with bearish bias. There I need to be more strong on going short on indices instead of going short on any specific stock. The reason is because all these stocks are very close to their important resistance level, and because of maybe some any particular kind of activity in the market, we could see these stocks can again cross this resistance level for the momentary. So ideal strategy should be to creating short position on indices instead of creating any short position on stocks. In fact, I would say that in case if there is any weakness during the day, then we should look for adding those stocks which are not.
Okay, we've just about lost Shrikant at the moment when he was getting into the flow of the advice that he was giving. I do want to ask him about whether the stance has shifted, because over the last few days, a lot of technical analysts have been pointing to a strategy that you should employ, which is buy on dips. And the way that he's talking about going short on the indices, I'm curious to know whether or not he feels that that has changed. Okay, so while we're waiting for him to come back, let's take a look at some of the stocks that could be reacting. Bajaj Finance, for example, the board is going to consider a stock split or a bonus issue. It's up and about, in fact, close to 3% at this juncture. Let's see if that holds, because it's already given up a little bit of ground in the pre-open. Bajaj Housing Finance, it's a decent pop that the stock is seeing at the start. At least that's what I saw on the screen. Well, it is, right? About 2.5% or thereabouts. Let's pull up something like a Canfin Homes. It's also trading in the green. The results came through, and there is an improvement in the PAT number. It's not moving too much, but by and large, there is, of course, expected to be a little bit of a cool-off in the financial space. Let's pull up Thyrocare, because this stood out as a very strong operational performance. The margins coming in above 30%, and that's what's reflected in the stock price as well. Getting about 6.5%, at least in the early minutes of trade. Let's see if that holds. On the downside, let's pull up something like an LTI Mindtree. It has missed estimates across the board, and despite that, the stock is seeing gains at the start. So watch out for that. Okay, so let's go to our big brokerage call of the day before we go back to our experts. And let's talk about Jefferies on Tata Consumer. It has downgraded the stock to a hold with a rating with a target price of 1,100 rupees. Harsh joining in to tell you about why they've done that. Harsh?
Yeah, predominantly on the back of numbers, a softer set of margins coming through due to higher tea prices and therefore seeing a slight bit of tepidness with regard to the way the numbers have panned out. Even though going forward, maybe in a quarter or two, prices are expected to come off and therefore that should aid margins. But what Jeffries is really saying is the way in which the stock has moved. The stock is up 24% over in the year-to-date period and 18% in the last 1 month. They believe that this move is taking things a little bit too far, and therefore they are calling this out and saying that the 70 times FY26 price to earnings looks expensive to them, therefore downgrading this to a hold. The structural story though, they are quite positive on in that sense. They just believe that valuations have run away.
Consumer has actually had a whole host of views coming in. Valuations is one reason why Jeffries is downgraded, but others are seeing it as okay. There's some one-offs baked into the price though and into the profits as though. I want to pull up Syngene as well very quickly. Numbers weren't great. Guidance was also below par and disappointing. Yeah, stock is about 8% down in the pre-open session. Expect a poor opening for it. Shrikant is back with us. Shrikant, can you hear us?
Yeah, now it's clear.
Let's reiterate your picks. Let's reiterate your picks very quickly.
Yeah. So I would like to go with those stocks which are not either parallel to the index or where there is some news flow. So in that case, Bajaj Finance looks good where there is a news flow. And today, if there is any lower opening, then we should look for creating long positions with a stop loss at 9,100. I am expecting this stock to move towards 10,000 eventually based on technicals. But yes, in the near term, we may see the levels of 96 or 9700 sort of levels. So it's a buy at current levels with a stop loss at 9100. The other stock which we like is SBI Cards. And here also the long-term structure of the stock is indicating us that the stock is heading for its previous high of 1100. But in the near term, the chances of hitting thousands are very high. And we can create long positions with a stop loss close to 895.
Okay. Shrikant, the question that I wanted to ask you is that I think even you, over the course of the last few trading sessions, had a view on the indices to say buy on dips is something that you can look at. I'm just wondering, based on the kind of calls that you've given today, whether that stance has changed.
No. I think, in the short term, we could see some correction because, we saw the rally of nearly 2,500 points from the lows without any correction. And that is also in a very short span of time. And most of the time, whenever the market leave any important level without retesting, then in the future, those levels we again see. So this time, maybe like around these levels where there is a news flow is completely volatile or uncertain, I can say, there we could see some profit taking. Also, if we see the behavior of traders, then now they are looking for those sectors which have underperformed, like IT. So the overall pattern is suggesting us that the market is ready for the short-term correction. But the broader structure of the market turned very strong. It reversed positive by crossing this 23,800 levels. The chances of hitting 25,500 are very high. But yes, we need some correction in the near term. So for next 1 or 2 days or maybe 3 days, we may see some correction in the market. Again, if there is a medium term view, then look for entering into the market at right levels, close to 23,900 or 800 levels instead of adding at these levels.
What about expiry day strategy, Shrikant?
For the expiry day and the overall structure and based on the call writing at 24,400 and 500, I'm of the view that we should look for creating short positions on index with a stop loss at 24,400.
Okay. Let's look at some more buzzers just a few minutes before markets start opening up. Are you going to see another day of some excitement in IT? Shrikant, any of these that you would pick? A Tech Mahindra, LTI, Mindtree, a persistent on the charts?
No, I think at these levels, it is better to stay away from taking any position because there also we saw very decent rally in the near term. Not rally, but it's a pullback to the recent sell-off that we saw. But yes, if there is any correction, then we should look for adding some select stocks like InfoEdge or maybe Persistent, Coforge, where the overall performance, if we consider their relative performance with other stocks in the same basket, is much better. So we like Persistent, we like Coforge, as well as InfoEdge.com. So these are the stocks to buy for, but not now on dips.
Let me just pull up Eternal very quickly and see what's happening there. Reports this morning that there is some rejig on the top tech, which was expected. Stock not doing much, about 1% down. Chakri, on Eternal, do you see further upside there? Are you bullish on the stock, or you would lay off for now?
It's done its bit in the near term, and I think, the longer term concerns still remain of pricing pressure, margins, etc. So therefore, would really actually stay away from the stock from at current levels.
Then at what levels do you think it would become attractive? And the reason I ask is because there is a view that once things settle, once the dust settles, there's likely to be some sense that prevails, or people will have to exit. And a lot of people are saying Zomato may not be that, or Eternal now may not be that company that exits.
Yeah, that's a question that we don't know the answer to, and there are lots of competition, internal, external, that's happening, and in a market which is as volatile as we are in, markets don't give these kind of multiples in such highly uncertain markets. You might have positional investments every once in a while, but the longer term clearly not at current levels.
Any view on the chart, Shrikant, on Zomato? Or rather on Eternal, I keep saying, okay, so we've just about lost him. I want to pull up Samhi Hotels as well. Hiral, you have the update with you, because the stock is reacting quite a bit at the start. I believe it had to do with certain acquisitions that are being made by GIC, correct?
Absolutely. So Samhi Hotels, if you could just pull up, there you go, 6.5%. Up move is what you're seeing in terms of the 35% stake is what GIC is going to acquire in 3 subsidiaries, and this investment is nearly around 752 odd crores, which has Country Yard and Fairfield by Marriott, Hyatt Regency, and Trinity Hotels in Bangalore. So that's the basic update that we have so far. But this will benefit Samis because the management is expecting almost 580 crores in terms of debt reduction on this one, a 15 to 20% upward impact in terms of profitability, and the incremental free cash that they will get due to the reduction in annual interest expense. That is going to be a positive as well.
Okay. Samhi, keep an eye out on the Bank Nifty as well, which has shown a bit of a dip in the pre-open session. Are you going to see some amount of recovery there? You are seeing a soft opening possibly on the Nifty as far as the pre-open rates are concerned, but remember, these can be deceptive. All right, first rates hitting this Thursday morning on expiry day, and yes, that softness is there, but not half bad. 24,300 is the level that the Nifty is struggling to reach at right now. So some red, but not massively red, I would say. Not really keeping in line with what's happening in US markets or the rest of Asia, frankly. And that could be for a host of reasons. The ferocity of the run-up in the markets, also seeing a bit of consolidation and cool-off, and that's what we told you this morning, that you could see a bit of cool-off as well. I want to pull up the Nifty IT very quickly, because Nifty IT was the outlier yesterday. Does it continue to be so? Not really, completely flat. So I can't see anything exciting happening there on the Nifty IT either. The broader indices, just for a second, let's see, and they're flat, not as bad as or not as a deeper cut than the Nifty and the Sensex, but flat out there. We'll pull up the heat map this morning and look at what the first rates are taking in as far as the Nifty is concerned. Tata Consumers is clearly a downer as far as the street says. They've not liked the numbers. There were one-offs contributing to the PAT coming in. The stock has also run up a fair bit, and that's why Jefferies had a negative call on it. That was our big brokerage call this morning. Eternal, that top deck rejig, the company claims that it is something that was expected, but their food delivery head has moved on. Dipinder Goyal will be taking care of that function. Street is not quite sure what to make out of it, and negative there. Bharti also feeling a bit of the heat. What's on the winning side? Bajaj Finance ahead of that stock split. Remember, we told you first on the 1st of April, if you watched Heard on the Street, you would have heard Swami Sarkar telling you that a stock split was expected, reiterated in yesterday's episode as well. Bajaj Finance up there, Tata Motors not doing too badly, Indocent seeing some bit of bounce back. Tech Mahindra's is okay. We're waiting for the numbers and seeing what's happening there. But otherwise, a smattering of IT on the top tech. Nothing too great happening on IT either. Indocent now top lead with just about 1.5%. This is a bit of a sluggish market. This is a market waiting to consolidate and waiting to figure out what's happening next, taking a breather after a ferocious run-up, Alex.
No doubt. I wouldn't be surprised if some of the stocks on my list, Tamanna, have actually changed from the pre-open and have actually have gone down. But before we get to those stocks, let's take a look at the sectoral picture and see what is playing out. If I'm not mistaken, Pharma will be on the top of the list. There you go. But it's not gaining too much, about 1/3% or so in terms of gains for the Pharma index. Nifty defense is okay, about 1/3%. Once again, realty is up about 0.2% or thereabouts. No big movers on the upside today. Even on the downside, there's not too much really happening. The banks are under a tad bit of pressure. We told you that this was a distinct possibility based on the kind of run that they've had over the course of the last 7 sessions or so. There was expected to be a little bit of a cooling off taking place, and that indeed is playing out. It played out yesterday as well. Let's see something like an HDFC Bank, whether or not it leads to a little bit of pressure on the downside for the Nifty 50. For now, let's talk about some of the stocks from the broader end of the spectrum, and there are a few stocks that are reacting pretty sharply. Let's see if that continues to be the case. Persistent, for example, is a stock that is in focus on the back of earnings. It is a beat, or rather it is in line with the Q4 expectations. And rightly so, the street is rewarding it with a gain of about 2% at the start. LTI Mindtree on the other end of the spectrum in the IT pack has missed expectation, and therefore it is seeing a little bit of a cut, not too much. In another market scenario, or if the mood was a little different, it's not as bearish as it was even 2 weeks back. In that kind of a scenario, you might have seen a bigger knock, 1.5% or so for an LTI Mindtree. I think they'll take it. Bajaj Housing Finance is a strong operational quarter. This is Bajaj Finance. So let's try and pull up Bajaj Housing Finance if we possibly can, but that's the stock that I'm talking about. It was up and about. Yeah, there you go. So Bajaj Housing Finance is up about 2% or thereabouts on the back of a strong set of numbers in the fourth quarter. They've managed to keep their NIMs unchanged at 4%. That's pretty good in the current context. And their disbursements are actually faster than the rest of the industry. So it's seen as positive. Canfin Homes on the other end of the spectrum was a solid set of numbers, but seeing a little bit of a correction at the start. Let's see how that pans out over the course of the day. Something like a Dalmia Bharat, let's pull that up as well, reacting on the back of earnings. And a few of them, right? So Persistent once again is in the list, but we talked about this. Dalmia Bharat up about 2.3%, 2.4% or thereabouts. Strong set of numbers. There is an expansion in the EBITDA margins that took place. Thyrocare, talk about EBITDA expansion or margin expansion. It's coming at 30% in the fourth quarter, and rightly so. The street is looking at it very positively. Stock of the day so far, arguably, Thyrocare is gaining over 12%, close to 13%. I'd be curious to find out whether or not our analysts still have a buy rating on the stock. Vascon Engineering. It's a stock that is reacting very strongly to an order win. The order is worth about 225 crore rupees and seen as a significant positive. I wonder what Aztec is doing, and these are stocks reacting to earnings. A couple of them are worse than others. Something like a Syngene, we spoke about this. It's a very weak fourth quarter that the company has reported, and Rallis as well. You've seen a widening of the loss in the fourth quarter versus a comparable quarter, not seen as very positive for this particular company. We will be speaking to the management, of course, and we'll find out what they have to say. But more along expected lines here, where you're seeing individual stocks that are reacting to significant developments, and some rightly so getting beaten down because of a torrid performance in the fourth quarter, but those that have done well are doing well as well.
Absolutely. I mean, markets are rewarding the ones who are doing well. In fact, 3 other stocks what I want to mention is Asami Hotels. Rallis India. Rallis India is trading under pressure, and this is again on the back of numbers. Tamil Nadu Mercantile Bank, let's just pull up that one on the screens because it was a strong set of numbers that was reported. 2.5-3% up move there. 361 also was seeing a strong move, at least in terms of yesterday's session and pre-open. Today the stock is down around 2%. And a Supreme Petro also, which has reported numbers. So if you can just pull up a Supreme Petro, because overall the revenues were down, profits down, margins have taken a major beating, 1.5% downtick that is coming in with regards to a Supreme Petro as well. So these are a few of the names that we have been watching out for. But Chakri, let me come to you with the pharma names which are seeing a good move. Pharma or healthcare, you would call it. Thyrocare, strong set of numbers, good up move. Syngene, an absolute downtick, and that's only on the back of the way FY26 guidance that the company has given. What would your strategy be specifically with both these stocks?
No, with both these stocks, clearly, Syngene clearly is not a company to buy. Guidance is now the key for most companies. As far as Thyrocare is concerned, this is a competitive business. In that business, if the company has proved to improve its margins significantly, valuations are pretty much on its side. So, Metropolis, Thyrocare, I think are clearly worth looking at, but again, as positional investments.
Okay. And Shrikant, if I have to talk to you about a Thyrocare, are you seeing further upside from current levels? And simultaneously with a Syngene, would it be a shorting candidate now?
I think you're on mute, Shrikant. Shrikant, you might be on mute. Yeah.
Sorry, Alex. So yes, we may see some activity in Thyrocare as well as we also like Metropolis. But for Syngene, it has disappointed. Yesterday's formation was much better. It was around some 750 levels. Today it is at 678, 680. But at the same time, if we consider the long-term structure of this particular stock, then it is very close to its long-term support of 640, 650. So maybe not now, but in case if we see any reversal activity after hitting those levels, we may see some range-bound sort of activity. So at these levels, at least, it is like better if we look for taking some contra bets if there is any further more correction up to, let's say, 640 or 650. It is better not to reduce position at these panic levels. And at higher levels, again, we could see the levels of 740, 750. That's my overall view based on its technical formation. But yes, we like Thyrocare, we like Metropolis.
Thyrocare, two topics coming in from Shrikant, but that we are with the healthcare space. Let's quickly pull up a Lupin on the screens because, a couple of days ago on the back of a US court ruling, there was a setback for Lupin as well as Zydus. Today, the stock is seeing a move of up 1%, and this is mainly because sources to NDTV are indicating that clearly, they will be announcing a launch that's with regards to generic version of Tolvaptan today in the US. Now, yes, it is a tongue twister, I would say. But overall, if you talk about this launch as well, the generic Tolvaptan generic version is called Jynarque. And this is only because the exclusivity of Otsuka's comes to an end in the US. They actually received the US FDA approval, which was a tentative approval back then in October 2023. And once they launch it, they will get 180 days exclusivity in the US market. Now, if you talk about the potential revenue, FY26 opportunity for a Lupin analyst are looking at almost around $150 to $200 million on the basis of this 180 days exclusivity. And this product will actually be manufactured at Lupin's Nagpur manufacturing facility in India. The drug is mainly used to slow kidney function. And overall, if you talk about the annual sales so far, it was estimated at around $287 million in the US. And this is as per your QIAMAT August 2023 data. Chakri, very quickly, your call on a Lupin taking into consideration the recent setback that we heard in the Delaware court and now another opportunity that comes their way.
The 180-day exclusivity is usually a very important portion for them to earn the bulk of their revenues. In this case, it's about a couple of $100 million. Given the fall and tariffs and all the structure, I think net Lupin looks okay at current levels.
Broader markets have turned positive, but not too much in terms of gains, about 0.1% for the mid-cap index or so, and about the similar gain for the small-cap index. But I want to focus on the largest of the large, Shrikant, because yesterday HDFC Bank was a bit of a downer for the benchmark Nifty 50 today as well. One of the biggest contributors on the downside. Only 0.4% lower though, but would you book if you've made gains over the last 5 days, 6 days?
Yeah, definitely. I think we should look for taking some profit if we are making handsome return in the short term. If there is a very long-term view, then just hold on to it because the stock has crossed its all-time highest level and it is gradually moving upward. So it will take some time, but gradually we could see the levels of maybe 2100 or 2200 sort of level. So it will take some time. But if there is a short-term view or if there is a trading position, then certainly we should look for taking profit on trading long positions.
All right, Chakri, very quickly on HDFC Bank, while we're on the subject, we saw the Q4 and the stock has reacted to it, but some cool off right now. Is it still something that you would say is looking attractive from a long-term perspective?
Absolutely, yes. The recent RBI rate cut as well as the liquidity release by the RBI have two important things for helping HDFC. Its net interest margins are likely to benefit and improve from the current levels. Its cost of funds are going to benefit. This is something which has been plaguing HDFC Bank in the past, and now it's the opposite. And therefore, I think over the next 12 months, I think you can expect significant upside from HDFC Bank.
All right. On that note, let me thank Shrikant for joining us this morning. Shrikant, thanks as always for taking the time. Absolute pleasure having you on the program. Now, we've been speaking about various commodities, of course, and we want to talk about gold as well because it cooled off just a tad bit overnight, but it still hovers very close to all-time highs. I'm just wondering, jewelry companies of some interesting insight that came through from our colleague Pallavi's reports where apparently people are going out and exchanging their gold jewelry and they're buying lighter weight jewelry because of the gold prices as they stand right now. So Chakri, would you buy any jewelry stocks right now?
Clearly Titan is still a buy, given that the gold prices are high. There's actually a catalyst for companies to for people to come in and walk into the store and make their purchases. And this is more an investment rather than just a consumer spend. So therefore, I think Titan is clearly a buy at current. You would continue to buy for the longer term.
All right. Thank you so much for that, Chakri. And for speaking with us today, Chakri Lokpriya there on what he thinks is happening with gold. So we're going to do an interesting discussion on gold, but just before we get to that, let's just take a quick look at what's happening in the markets. And it's a day of weakness. The Bank Nifty and Nifty IT kind of holding up, but not so much on the index. In fact, let's pull up the Nifty heat map just for a sec before we move for a second and look at what's happening there. And you're seeing that extent of weakness. Another set of stocks to look at will definitely be your consumer durables, because look at the flash on your screen. And this is something we've been reporting. Government has eased import norms for AC parts amidst the summer shortage. BIS standards have changed. So they've allowed imports of AC compressors from China without BIS standards. Look at what a Voltas is doing today. Look at a Blue Star. And you're going to see some action on that end as well as we go ahead.
Tamana, interesting over here is, in spite of the government allowing imports, yesterday when I did speak to the management of Havells, and if you hear the con call, what Lloyds was indicating is when analysts were asking them about the shortage in terms of compressors, this is what is allowed. He's saying, but there is no demand. So we're not facing a concern of a shortage in terms of the parts, right? So that is going to be a concerning area.
There is no demand.
Exactly.
I'm
because the summer has
that.
been delayed. Summer season has been delayed.
I don't feel like it's been delayed, I'm sorry.
No, but that's what the numbers are indicating, and that's why your first quarter will be weak, and that's the reason why Havells was under pressure yesterday, because strong set of numbers, delayed summer, demand is weak. So any of these part shortages is not really what they're worried
this is
about.
interesting. We should actually get Blue Star and Voltas on and ask them, because when we talk to them, they keep saying demand is phenomenal, and now in a lot of parts of the country, unfortunately, all year round is so hot that an air conditioner has become not a luxury but a basic requirement. So,
so I'm not the only one that goes outside and melts.
No, everyone is, but you get to sit in air conditioned studio most of the day. Okay. So, time for our special coverage on gold. The yellow metal has soared to an unprecedented $35,000 per troy ounce, boasting a remarkable surge of over 30% just in 2025. This meteoric rise isn't happening in a vacuum. Volatility in equity markets and an escalating tariff war are shaking up gold trade, pushing investors towards this timeless safe haven asset amidst lingering economic uncertainty. Gold's allure remains stronger than ever, captivating both seasoned traders and cautious newcomers. So as gold sits at this dazzling peak, the obvious question is, what's next for investors? Can this upward momentum sustain against potential headwinds, or are there challenges on the horizon that could shift the landscape? We're going to be speaking to a whole host of people on this, but let's start off the conversation with Suvankar Sen, MD and CEO of Senco Gold. Tejas Shigrekar, Senior Technical Analyst, is also joining us. He tracks commodity and currency at Angel One. We'll also be speaking with Naresh Kataria, private investor, in just a bit, who's been tracking this space very, very closely. Welcome to all of you. Suvankar, thank you for your time this morning. And let me actually start with your take. Logic would dictate as gold prices are rising, people would be more and more hesitant to come to the store and buy jewelry. Is that what you're saying?
So see, what we have been looking in the last 2 weeks, Akshaya Tritiya is next week. So that is one of the auspicious seasons that we always have, and consumers are keen to buy something. But because of the higher gold prices, consumers are coming, but the ticket sizes, or rather the quantity of gold, is something that is getting impacted. So value terms, if we really look at it, everything will look very positive, and there will be a lot of growth, because gold itself from a year-on-year basis by more than 30%. But if we look at the volumes, I think consumers are still digesting these high prices, and they are coming, but within their budgets. So that is one aspect of it. And the second one is that the old gold exchange of it. So those who have weddings in the family, or there are consumers who are wanting to make the best out of these higher gold prices, are bringing their old jewelry into the stores and exchanging it for the new ones, which is a little slightly higher in terms of the quantity. So if they bring in 10 grams, they will buy something worth 12 grams. So this is another phenomenon that we are seeing at the stores in such prices.
Right. So, Ankar, a follow-up on this one. When you're saying that, yes, they're coming to buy in terms of their budgets, does that mean there will be an impact in terms of volumes if you have to look at this quarter? Because one, you are talking about Akshaya Tritiya. Two, there is shopping happening right now ahead of the wedding season that will come in yet again. So how is the impact that you're going to see in terms of volumes and in turn in terms of the financials?
So in terms of value, what we are seeing, it's almost, I would say, we're close to the month of April. We will see a value growth. But in the last 15-20 days, because of the price high rise, we are seeing an impact of 15 to 20% in terms of volume. So yes, volumes will take a hit. And what we are hoping and expecting is that if the gold prices corrects a little bit, that will give some energy and boost to the consumers now that they have seen the higher prices. And if it comes down and corrects a little bit, that will again automatically give a boost to the consumers. And the wedding season continues to remain. We have May and June as a peak wedding season before the non-wedding season starts in the Q2. So looking forward that if there is any correction, and the gold prices have corrected from the highs, it had gone up to $3,450, close to $3,500, and today it is at around $3,320. So I think that correction will be helpful, and if consumers sees that the prices are stabilizing in such levels, they will start coming back to buy for the Akshaya Tritiya.
I want to understand from your perspective also as a jeweler, which scenario is more profitable in a scenario where the prices have gone up as much as they have? I'm assuming that you will have a certain amount of gold inventory that you held for a period of time. You're probably not keeping low inventory, right? So from that perspective, if you're utilizing your existing inventory, is that better? Or is it when a customer comes to your store and says, I have this much gold, exchange it for me and make another set of jewelry? Which is better operationally for you?
So, operationally, we are always happy if the gold prices are stable. A little bit of increase of the gold prices year on year is good because that gives confidence to the consumers that this is a great asset, and no matter what, in crisis times, it can move a little up and down a little more, but year on year, it is moving in the marginal levels, and that's the best thing to happen because as a jeweler, we are making money out of the making charges and not out of the increasing gold price. These are kind of windfall gains or losses. And, depending on the jeweler to jeweler, inventories are hedged. Someone is hedging 100%, someone is hedging 80%, someone is hedging 60%. So therefore, based on the hedging mechanism, those who are hedged less, they will tend to get a little higher in terms of the capital gains of the increase in gold price. Those who are a little hedged more, they will get a little lower kind of a profitability because of the in movement of gold price. So personally, I think it is always good to have a more the footfalls, more the cash flows. Everything looks very stable because for us to plan for the future is also very important, right? So if the prices are too volatile, sometimes your planning goes for a toss, and you need to always be on your toes trying to figure out that yes, the right kind of inventory and the right amount is there always at the store. Plus the fact that with this increase in gold prices, we're continuously innovating that we need to give lighter gold weight jewelry. So what used to be 25, 30 grams today has to come within 20 grams. So 15, 20 grams. Wedding jewelries have to be lighter. That is one more thing. Another good part, just, out of all these challenges is that the diamond jewelry sales have also picked up because that is made in 14 karat and 18 karat jewelry, studded with diamonds. So I think consumers for their personal consumption are now seeing that, yes, now that the gold prices have gone up so much within their budgets, they can now buy diamond jewelry or platinum. So that is another good part that might add to the profitability for the company.
So there are various perspectives to what is happening with the gold rush. One is, of course, from the gold jewelry perspective, which Mr. Sen has given us very well. Naresh Kataria also joins in on our conversation. And let me get your perspective as well, Naresh. You've been speaking with us here on NDTV Profit on how bullish you are on gold prices. Now the question is, and there's a raging debate right now that have we reached the top? Are those who looked at $4,000, $6,000, being overtly optimistic, or will you see a cool off the moment things settle like they have in the last couple of days?
Yeah, my view is that one, it has run up too fast in the near term. So gold is now short-term stretched. It is 25% above its trend of 200-day moving average. But the key aspect I'll consider is whether it's a bull market like the 2000s or the 1970s. I think that's the key difference I would want to analyze. Because the 70s bull market was driven by central banks, and the 2000s bull market was driven by retail and HNIs. And this time, I think the central banks have taken the lead. Gold bull market was much stronger in 1970s. Of course, it did have a lot of corrections. So there was a correction in 2006 of 20%, 30% in 2008, and even a 40% correction in 1974-75. So maybe a breather is due, but the factors, which is the central banks trying to de-risk from the geopolitical risk of their central bank reserves, I think that's very much on.
Okay, so the de-risking factor is gone. Does it mean that the rally is stalled for now? This is why we wanted Tejas on the show today, to get a technical perspective on it. And Tejas, I'm going to ask you about silver also in a bit, but right now just gold on the charts. How high is high? Are we going to see a higher price point?
Yes, good morning, everyone. See, on the technical part, whenever we see the 1 lakh amount on the screen, the people are just keep cautious when they are expecting to trade into this area. As we see now, always the silver also, it's have the edge to cross the 1 lakh point. So whenever it's reach up to that level, it's getting sustained and volatility is comes, and again on a month-on-month basis is not able to be cross sustainably above the 1 lakh point. So when we see the gold also reaching up to that, which is a very cautious point when people are looking towards invest into the gold, they are just worried about how they can invest in a physical market. So always see the international cues where exactly is coming through and how exactly is impacting to the overall economic numbers. So definitely the Fed is took the some other intention of to keep easing on this on those points, and finally it will help the stability for the full employment also, as well as the dollar it impacting on this higher level and keep rushing out the higher points. And again, when we see the on the technical part, there is a, DMA 100 DMA, it's at 98, which took exactly the support, and yesterday it had the bounce back from that level. And the broadly the gold not able to be sustained on the higher level about the 3500 and took the barrier on the higher side, and then again it's pressurized from the higher level, and right now is reaching up to the 3200. So almost there is a support area when we see the on the technical immediate support at $30 to $20, and the targeting from the 9 DMA, and again immediate support around of $31.45.
Okay. I also want to talk about the relationship between gold and silver, and it's described, gentlemen, you will all know about this, but it's described as a gold-silver ratio. And what you look at is that 1 unit of gold is equivalent to a certain number, or 1 price of gold is equivalent to a certain value of silver. So if it used to be 70 back in the day, but as things stand right now, it's actually above 100. So if gold is at $1, you're talking about silver, or rather, sorry, explain this. If gold is at 100, silver is at 1. So that's how it works, right? Right now, it used to be 70, which means that the gap between gold and silver has widened quite considerably. In this market, Naresh, would you suggest that you should book some profits in gold and move to silver?
So how I see it is that gold is a pure monetary metal, silver is a monetary and an industrial metal. So gold-silver ratio used to be 16 50 years back, 100 years back. It used to be 1:16. Even the peak in 1980 was at 1:16 ratio. Gold peaked at 800, silver peaked at $50 in 1980. It's below that even now. More importantly, the current bull market is driven by central bank buying. And I don't see any central bank buying gold. El Salvador and one more country has announced buying Bitcoin a little, but I don't see any apologies, no central bank buying silver. So all are into gold, and central banks are pushing gold. So I think gold is showing signs of geopolitical stress, de-risking, which central banks want to do. And of course, retail also now latching on to gold. Silver only has retail going for it. I don't see other triggers. So I'm not sure, I don't analyze silver that closely, but I think the triggers which are there for gold, I don't see them for silver.
So, Naresh, I have a follow-up on this one. I mean, Alex was talking about gold and silver. Let's look at the Sensex to gold ratio then. You know, I mean, usually, if you see currently as well, we are in that bracket of around 0.86, and the long-term average has been around 0.96, if I'm not mistaken. Does this mean that gold is then overvalued as compared to equities? And if so, your equities are still the best bet at this current point in time, taking the overvaluation of gold into consideration?
So that's a good point. People miss the relation between gold and Indian markets. At a more broader level, gold going up, I think, is good for India and Indian markets, is how the relation has been. We don't have data for 70s. Actually, in 70s, gold went up 16, 17x in US, but US market struggled. But the last major bull market, which is 2001 to 2011, Indian markets did very well in that period because India has a big stock of gold. Indians have a big stock of gold, almost equal to our GDP. So gold going up does give a positive wealth effect tailwind to the Indian consumer or the Indian savings bucket. So I think gold going up, I would say, is rather beneficial for markets. And the data I've checked is whenever gold goes up 25%, And if you had invested in markets, small caps give not better than average returns when gold is up. So rather than competing gold versus markets, I'll say gold going up is a positive tailwind for Indian markets.
At the end of the day, and we have Naresh, Tejas, and of course Mr. Sen also with us. At the end of the day, people watching right now are looking at all of the conversations about how those who invested in gold or did SIPs in gold or did gold ETFs turn out to be smarter than equity investors. Does that situation still exist? I'm going to come to Naresh Kataria first on that question. Maybe it's not a straight up gold or equity, but is this still a good time to start or continue your investments in gold?
So I'll first again step back and I'll refer to analysts who are saying now gold and Indian markets do equally well over long term. And I think these analysts or investment advisors are opportunists because gold doesn't do very well long term always. If you check 90s, gold was down 30%, the decades of 91 to 2001, gold was down 30% and markets did very well. It was up 5x. Even 2011 to 21, gold was flat, $1,700 to $1,700 for 10 years, but markets were up 3x since Nifty was up 5,000 to 17,000. So, of course, gold has its own tailwinds, own factors which work for gold. And right now, it is the central banks trying to de-risk their reserve assets. And of course, I also believe, I spoke on the channel last time, that there may be a short position in terms of leasing, which happens in London and New York, and that will have to be covered eventually. So the example is a gold metal loan, which Indian jewelers take. The source of that gold is usually deposited custodial gold lying in one of the depositories in London and New York. So the tailwinds for gold have to be analyzed, and I think this looks like a structural move for gold. Of course, it can correct. As I mentioned, even in the 2001 to 2011 bull market, gold corrected 20% in 2006 and 30% in 2008. So we better be prepared for volatility, which is how any markets behave. But we need to analyze for the long-term trends, and I believe the trends are very much in place to push gold higher.
So should you buy or not, Naresh?
I think it's a simplistic question. I can't give you a very direct answer, but I think there is some sense to have gold in one's portfolio. I'll just again give you a still broader picture. The current setup, which is Brent down, interest rates down, and gold up, that's a very, very sweet spot for India because Brent down brings down our forex commitments and interest rates. Interest rates themselves are down. Gold going up gives a wealth effect. This combination is not available for too many countries, and gold itself has a far larger role to play for India. So again, I would not say equities or gold. Gold has a role to play, VB, but it is stretched. It is 25% above 200 DMA, which is where corrections usually happen. So if I was not allocated to gold, I'll wait for a slightly better entry point to allocate gold. But if what allocation I have or any investor has, I think we should just ride the bull run.
Hold, but don't buy. Naresh, we're all about the simplistic questions here. And we hope to give our viewers simple answers because that's what people want to know at the end of the day. That's what we're all here for. Tejas, I'm going to ask you that same question and then I'll come to Suvankar as well. Buy gold right now, even at these levels? Yes, no, maybe?
On the technical part, there is a correction expected. As I mentioned earlier, also it's a psychological level, 1 lakh point. So people are very cautious about how to invest, where to invest, and when we talk about it's a physical market, definitely there is a demand. But on the how exactly the tariff going on in the international market, how they're taking the step, the essential asset they are allowing from the China, and again they're taking another step to just easing out again looking forward the interest rate cut, the full employment also to be not should be harmful. So these mandatory assets had to be looked forward, and it will impact the dollar index. Again, we are if taking the support at 10 EM at $98 in a dollar index. It will take the bounce back and it will reach up to the 102 to 104. So it will impact to the overall gold prices, and we'll see the deeper connection around of 5 to 10% from the here on. So we're expecting the buy on dip, it will be the better solution.
Buy on dip. How do you look at this, Subhankar? I mean, you can't give advice on whether you should buy gold or not, and probably your advice will always be yes, please buy gold because that's what I sell. But in terms of prices going, you said Akshay Tritiya, if people are, shoring up for a big occasion in their family or even for investments, how would you look at the investment perspective?
So, I'll talk from my personal level that, when gold prices were at 75, 80,000, we thought that, the prices are quite high, and we couldn't imagine that while we can all talk of prices will go to 1 lakh rupees, but we never imagined that it will go so fast. But then, it has gone and it is going, right? So I would suggest that as an investor, you have to get into the market to, like meet SIPs or in a very kind of a staggered manner, keep buying. We will never be able to catch the lows, and we'll never know which the highs are. So you start buying little. If there is a correction, you should buy again, and that's how I think we also are doing our best to ensure that at every level you are buying gold. It should be a part of your portfolio, and that's the way to look at it. And silver is another very good commodity along with gold to buy, and I think that is another thing that investors should surely look into along with.
Naresh, what you were talking about allocation, a lot of the advisors that speak to us talk about a 15% allocation towards gold. And of course, there's no one-size-fits-all solution. You're talking about allocation towards equity, towards fixed income in a good portfolio. And if at all you don't have that 15% allocation, I think the point that you were making is very good, in that don't see this red-hot rally and think, oh, I'm missing out, so I should go and buy right now. I'm just wondering how you buy the gold that you own. Is it primarily through ETFs? And in your opinion, is that the best way to invest in gold?
So one is, before I come to how I buy, again, these allocations, people are talking 10, 15. I'll just caution you and everybody else. Most of them have latched on because gold has done well. I don't think they are coming to gold because gold will do well, because no one really has an idea, frankly. The factors moving gold are far more complex, but people, that's how investors behave. Analysts behave, or the advisors behave. They latch on to an asset which does well. So I don't know whether it's 10 or 15% is right at this stage. On how I buy, till some years back, we had far more options. We had SGBs which were extremely attractive. They are no longer there. We just have to hold on to what SGBs we have. There was one more very good proxy to ride gold, which was gold finance companies, because they do well when gold, they used to do well when gold goes up, because their NPAs come down and they have also better business and operating leverage. But RBI has tightened a lot of rules on NBFCs which give you gold loans. So primarily it is SGBs, it is gold Bs or the other ETFs. But I also have a slightly more outlandish take on this. I think if the challenges geopolitically and a scramble for physical metal plays out as I fear, then I think even some physical gold may actually be prudent to have.
So Naresh, clear question. Would you buy gold or silver or any of the precious metals, or would you advise buying a jewelry company?
So I have a problem with jewelry companies in the sense, of course, India's gold imports are kind of flattish for the last several years, and I think the price will go up, so obviously their sales will go up. But most jewelry companies are hedged, and I have a problem with that setup, in the sense, as the price goes up, they pay a mark-to-market losses on the hedges they have, either as a gold metal loan, or if some of them have even hedged on MCX. Of course, they'll realize those gains when they sell the gold to customers. But I don't think are direct beneficiaries of gold prices when gold goes up. And as I told, I have actually a big inhibition of, if there is a melt up in gold, it would create big issues for cash flow management for dwellers who have entire inventory hedged.
Naresh, thanks for that one. So, in fact, let me go to Senco on this one. How are you looking at this, Suvankar? What would your opinion be on what Naresh is saying? Because inventory management becomes crucial, hedging policy becomes crucial over here, and in turn, your cash flows.
See, hedging, as I said, that, some people are 100% hedged, some are 80, some are 60. And the cash flow, management is the most critical aspect to manage in such bull runs and when the prices move up. But, as a listed company, which is dealing with gold, quarter on quarter, if there are any volatile movements and the prices come down, then it will unnecessarily impact the balance sheet. So I think that, yes, in the long run, the bull run is there, but it is a wise thing because ultimately as a jewelry company, we are going to make money out of the making charges that keeps going up with the increase in gold or silver prices, and not so much on the gold, value that goes up. So yes, Naresh ji is right from that perspective, but risk mitigation and risk management in a downward market is also very, very important. And we do a balanced hedging for the same. But yes, the point is that it's much like the gold loan companies, jewelry companies, or those who are dealing with gold, rather than buying the physical commodity, those who are utilizing the gold for businesses, I think that is a good way to look at investing in gold as well.
Give us some more color on buyer behavior at this juncture. I know we began with that question, but I'm wondering about whether or not people are going out and buying bullion. What percentage of sales currently accounts for that?
So there are investors in the market, people who are not keen to buy gold maybe 3 years back is now more excited to buy gold and bullion. So for us, the bullion percentage is around 5%. Jewelry still continues to remain a major part of your sales. And as I said, that weddings is one aspect of it where people have to buy no matter what the prices are. And from a personal savings point of view, people are moving towards lighter weight jewelry, sleeker weight jewelry, because that is something that they can buy within their budgets. But, for us, if it is 5%, for someone else or bullion dealers, that could be a higher percentage of 10, 15%. But there are people and buyers keen to buy the commodity, and there is this fear of missing out amongst a lot of investors that we can see.
Right. So, I mean, everything that glitters, whether that is gold or not, is what everyone has to really guess from here on, because with the rates that are rising, I mean, usually, what we've seen is gold has become an investment at times of crisis. But when you're betting on economic growth, that's when the equity picture comes in. So it's a very tricky situation that India is sitting on right now as well, along with the world. But thank you so much, gentlemen, for joining us on the show to have this fantastic discussion, whether gold or equity or whether gold or silver. Thank you, Naresh. Thank you, Tejas, as well as, over Suvankar as well for joining us on the show and sharing that view. So an interesting conversation over here. And the key is, that yes, gold is on an uptick, but whether the time is right to enter the gold space right now is anyone's guess. Absolutely, the consensus right now, what's coming in is that it's absolutely overvalued.
Buy on dips. I think
exactly.
buy on dips is the consensus, and I feel that a dip will come soon enough. But if you're holding, continue to hold.
And technical view is saying that a 5 to 10% correction could be on the cards.
Watch out for the dollar index. But just to the point that he was making about analysts jumping on
ETFs.
I've been speaking to them for 7-8 years, and it's not like they've been saying this, just over the last 6 months. They've said this consistently. Don't have crazy allocations. Maintain it 10-15%, and if there is a wild fluctuation and there's a deviation from that 10-15%, it goes to 20%, because gold prices have rallied 30-40% over the last 1 year, then do take money off the table. And I think investors are doing that, Tamanna, because last month, if you look at the ETF flows data, surprise, surprise, there was a net outflow of 77 crore rupees. So people are booking profits.
Investors have become smarter than they have ever before, and hopefully we're helping out with shows like this. We'll take a very short break, but we'll be right back with the markets and more.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
second buyback is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
Welcome back. You're watching India Market Open. Let's shift focus to Rallis India on the back of the Q4 numbers that they have posted. In fact, my colleague Varsha is standing by to get us more before we speak to the management, which is Gyanendra Shukla, MD and CEO, who will be joining in. But Varsha, what is it that is not working, because the stock has been under pressure?
Yes, absolutely. Weak set of numbers that the company has posted. Now let's see the reasons behind the weak numbers. The volume and margin pressure in export market has actually impacted Q4 for the company. The EBITDA loss that you're seeing is led by the pricing pressure in domestic crop care business. Though volumes there were good. I mean, there was good volume when it comes to domestic crop care business, but pricing pressure has actually impacted that segment. And the net loss that you're seeing is led by the lower EBITDA. Just a few key numbers. Revenue was down almost 1.4%. There was an EBITDA loss of 20 crore and a net loss of rupees 32 crore versus loss of 21 crore last year. Now the key questions or the key interesting points here is what is the outlook when it comes to export business? Has company been seeing any kind of improvement in that? And as I clearly mentioned that there was a volume growth in domestic business, but the pricing pressure still persists. So have we seen any kind of good growth when it comes to pricing pressure? Have been there any improvement? And lastly, how the CSM products that the company has ventured into has been performing for the company? So these are the key highlights that we need to ask management for.
All right, thank you for that, Varsha, and we'll speak to the Rallis management in just a bit, but do keep an eye on the HUL flashes on your screen. HUL numbers are in. Net profit is coming at 2490 crores versus the NDTV profit estimate of 2482 crores. So in line really. Revenue is at 15,214 crores versus our estimate of 15,200 crores. So completely in line. Street is liking what they're seeing. You're seeing a bit of a spike in the stock as well, about 1.5% up as we speak on HUL. We'll get more of those details in as we speak on HUL. But
and that's clearly, I mean, if you see, if these numbers are in line, the key was the volume growth over here. Again, it was a very flattish number taking into consideration the market sentiment so far. The pricing growth was expected to be ahead of the volume growth as well. So that is going to be key. Margins expected to be under pressure. So the margin number is going to become absolutely crucial, because overall the poll number that we were expecting could be around 22.9%. That was on a consolidated basis, but standalone basis we were expecting a margin number of around 23%. So let's see, the EBITDA has come in at 3,466 crores versus 3,490 crores. So a marginal miss on the EBITDA front. Let's quickly have the margin picture as well, because that is going to be crucial to watch out for. Apart from that, the key from here on will be the pricing in categories which is copra, tea and palm oil. That is what we will watch out for from the analysts as well as the management. The ice cream business outlook and the recent development with regards to where the sunscreen war goes. So overall, that's the view. In fact, recently you had brokerages like JP Morgan. They had a target price of 2,259, which is lower than where HUL is trading at currently. Jefferies has a target price of 2,289, again below the current market price, and UBS, that's the only one out of the three which has a target price of 2,800 on the counter, which is above what the stock is trading at. But clearly, if you see in terms of where the revenue number goes, pretty much in line with what our estimates are indicating. In terms of the profit number as well, it's slightly above what the street was estimating, but that's just around 10 odd crores. So that number is also in line. EBITDA is a marginal miss, and if you see in terms of the margin number, 23% is the standalone margin number that the street was anticipating on a consensus basis. So that's the calculation that we will be waiting out for. But overall, clearly, I mean, a pretty much inline number, and that's what you're seeing. No major reaction, Tamanna, that's coming in terms of the stock price. It is absolutely where it is. The margin has come in at 22.8% versus a 23.1%. So that again is below what the street was estimating, because 23% is what we were looking at, 22.8, so a marginal miss. So I think the overall picture, what I think Mahima would give us over here if she was there, because she's gone for the press conference probably, or she'll be joining in, is a pretty inline number in terms of estimates.
I would say actually, so board has also approved a dividend of 24 rupees per share. I would say it's actually, it's in line, but I would say it's a positive surprise compared to how dismal people were expecting HUL's numbers to be. We'll have to wait and see what that volume growth figure comes in on. However, even as we speak, what becomes very crucial with HUL is also forward-looking commentary. So that's one metric to see. We'll get you more on HUL and a deeper analysis on what those numbers are looking like. But meanwhile, Mr. Gyanendra Shukla is with us. He's MD and CEO of Rallis India. We're speaking about his quarter gone by. Mr. Shukla, thank you so much for your time. Let's take a look at Q4. Exports seems to be the pain point.
Yes, so let me start by saying good morning. Look, we are in a business which is very seasonal in nature, so sometimes it becomes very, very difficult to judge companies in agri space on quarter basis. So it's always seasonal. Even our export business is also seasonal in nature, depending on where we export. So yes, they're soft numbers, but I mean, that's what they are.
Okay, so Mr. Shukla, how are you expecting FY26? I mean, we are at the end of April. Has the trend continued where the downtick in terms of exports may continue? And if that is the scenario, any revision in terms of your expectation for FY26?
So look at our business. I think export is about 25% of our total business. Our majority of the business is domestic, and I think that's where our large focus is. Doesn't mean export is less important. So within domestic business, we have three segments which actually are doing very well. So seed is one business we have been nurturing for 15 years, has become a positive contributor to the company, has grown significantly. There is another soil and plant nutrition business which we have been nurturing for over a period of time. That has started contributing significantly. And our domestic crop care business also has done very well. We have also identified some of the portfolio gap we had, particularly when it comes to third and fourth quarter, mostly in the herbicide category. So we're filling all those portfolio gaps. So what I can say is 75% of the business, actually there's a proper plan in place, a strategies place, which is combination of digitally driving the business, improving customer experience, as well as bringing new product. Now export is something we are actually having 4 key products, and many of them are also caught into, earlier they were caught into global excess supply. As a result, prices were very low. And now there's a new thing on the horizon, which is related to traffic. So we're still evaluating. But when I look at the export future, I think what is happening in the business is going to be long-term positive.
Just one question, Mr. Shukla, on your crop care segment, which is, your bulk. Over there also, you've seen your EBITDA drop by 77% because of pricing pressure. Can you explain to us why this extent of pressure on prices, and do you see this easing off at any point?
It should ease off. The quarter 3 and quarter 4 primarily depends on some of the pests and diseases which come in the southern part of India. 2 of our new product, for example, in chili crop, we had a very good product. In chili, there was hardly any pest pressure. As a result, volumes were low. And there's another product we have got for the rice segment, particularly for southern rice, that also has not met the expectation of the customer. As a result, you see the pressure. But what we're trying to do now is really the significant portfolio gap, which is because of the herbicide in the Rabi. In fact, in Rabi season, herbicide is the largest segment, and we are launching new product as we speak. And hopefully portfolio diversification should address some of the concern we have been facing historically on Q3 and Q4.
Okay. Thank you so much, Mr. Shukla, for speaking with us. MD and CEO of Rallis India there. They've had a tough quarter. And crop care, which is their prime component, has seen cost impacts coming in. Stock about 4.5% down. Stock that is buzzing this morning, though, is HUL. Seems to have surprised on the positive, and that has been an important one to track. EBITDA margins have been slightly down, but the segmental breakup that has come here is pointing to a pretty decent quarter, all things considered. That's what's reflecting in the stock. Mahima, I believe, is joining us. She tracks the company very closely. Mahima, you looked at what was expected. You're seeing the numbers now. This is a beat on most indications.
Right, so slight beat on most indicators, but largely numbers are in line. Revenue came at around 15,214 crores, which was expected at 15,200 odd crores. So revenue is up around 2.4%. EBITDA, however, we were expecting a negative 1%, which has come at a positive 1%. In terms of net profit, slight beat. It's up by 3.6% at 2493 crore. Margins were expected at around 23%, which have come at around 22.8%. Now, in terms of dividend, the board has declared a final dividend of 24 per share. In terms of the segmental breakup, home care has done decently. It is up by about 1.8% in terms of its revenue. Beauty and well-being has come as a surprise certainly this quarter, because beauty and well-being was something that was seeing a significant pressure in terms of competition, but it has now grown at around 4.2% this particular quarter. Personal care has also shown strength. It is up by about 3% this quarter. Foods, however, still facing headwinds and down by about 0.3% this particular quarter. We are yet to see as to how the underlying volume growth comes at, which is expected to be flat, and we'll also wait for commentary coming in with respect to the price hikes as well.
Right. That's going to be interesting. But Mahima, taking the first cut of the numbers into consideration, and that you will be meeting the management also soon, what are your key concerns or what are your key aspects that you would want to get answers to?
So the first would definitely be that since the revenue growth is just merely at 2%, which has been the case for 2 quarters, the primary question is that is the urban growth still underperforming? Is there any sort of recovery seen in the urban growth? Secondly, are they also seeing a slowdown in the rural growth is something that the management needs to answer. And secondly, in terms of price hikes, how much of a price hikes have actually coped up with the inflation is something that the management needs to be, needs to be answering. And lastly, in terms of the business update with regards to where ice cream business stands right now, and of course their commentary on the entire sunscreen war that has been taken up by Honasa versus HUL, where the court verdict was against HUL. So all of these things should be answered by the management in the press meet.
Absolutely, I think so. These are going to be key things that the management should be responding to as well. But Tamanna, as you were mentioning, though the numbers are in line with the estimates, I think the stock is reacting on the positive as well, and probably the street was what the street was looking at is that in spite of the numbers that you are expecting, there could be a disappointment in the commentary, which is not the case right now. If the management commentary is negative from a volume growth perspective, that could get a correction in the stock today.
The only thing I'd add is that HUL management tends to be on the conservative side with their commentary. They are not one to go gaga. They are one to, I mean, that's been the typical trend. They will go ahead and paint a more realistic picture rather than others, and maybe say that there could be trouble ahead. But nevertheless, HUL moving up, definitely helping the markets this morning, and a smart move on a stock that doesn't usually show that kind of a movement. But we have a very special conversation lined up for you with the Abacus Asset Manager Sunil Singhania. Our colleague Neeraj Shah spoke with him. Listen in.
I think India could have done more, yes. And as you know, human beings, we always want things to be done more at a faster pace. And, so to that extent, we could have done more. But if you actually see, now we are net exporters of mobile phones rather than importers.
True.
A lot of import substitution has started. So whether it's electronics, which is very, very evident, so all the phones and refrigerators and air conditioners and so many other electronics which we consume are all now made in India. I think there's already a laptop policy in place. Tata has already done the groundbreaking for a semiconductor fab unit, and maybe others will follow. So I think there are a lot of things which have happened. But as I said, as human beings, we want more and at a faster pace. Maybe this will be the catalyst which will spur various governments, not only India, to try and make use of that opportunity to build ecosystem where they can basically get market share, which some of the countries like China or Vietnam might see.
Okay. Before we get into that nuance, Sunil, one or two more questions on the worldview that you may have, and it would. I mean, I realize the size of capital that you manage. I mean, there is significantly large opportunities that open up for you, but also that much higher responsibility because of liquidity, etc. But if a scenario comes out wherein the US were to enter maybe a bit of an inflationary period, if not a spiral, and other countries enter into a lower inflation number, thankfully our inflation numbers are also looking a lot more healthy. What happens to the incremental global flows? Part one of my question is what's your 50,000 feet view? Part two of my question is, because you speak to a lot of large global investors who would be investing through your fund as well now, what is their view on India?
Sure. So I think India is in everyone's frame of mind. Obviously, it's not such a big allocation for them that they get too excited or too worried about it.
Okay.
But I'll give you a not so scary answer, and then maybe we'll touch upon the scary thing. So I think what was happening last 5-6 months was obviously US yields had started to come off, and currency was very strong. So global flows were going into US. Because you make money when yields go down on the upside as far as bond prices are concerned. Equity markets were doing very, very well because of huge liquidity, and were gaining in currency also. I think last month or so that has reversed. And that is very unlike what maybe Trump and his team would have envisaged. And I think that is something, maybe the most important reason why they are backing off a little bit now. So now what has happened is yields have shot up. 10-year yields are at 4.3, 4.4. 30-year yields are closer to 5%. DXY from 110 at its peak has fallen to 99. And now there's a reverse cycle. So those who are invested in US are now losing because bond prices have fallen 3-4%. Yeah. Nasdaq is down 12-14% year to date. And they're losing on currency also. If you look at US versus Swiss franc or US versus euro or US versus British pound, I think dollar is like really got butchered. And I think there is some reverse flow which has started to happen. But all said and done, I think US is still 60-65% of the world's market cap. I think that is a little scary, but at the same time, it's an opportunity. So, if you just wear the optimist hat, which we always are optimistic. So 25 years, we have always been optimistic. Even during COVID, we were optimistic. During war times, we are optimistic. And I think it's paid off well. So if 5% of the world's flow moves out, so, global flows, $20 trillion worth of equity is owned by global funds and 40 trillion by US funds and US investors. If totally 5% were to move out of US, because there it's, clear, you can move anywhere. It's $3 trillion. And now if even now 5% of that 3 trillion comes to India, it's $150 billion. And, we get very worried when $20-30 billion moves out. Yeah. But this $150 billion can come into the country over the next 2, 3, 4 years. Even if 5% move out of US, and out of what moves out of US, only 5% comes. So technically 0.25%. And I think that is not far-fetched to envisage that money can come in. So I think there will definitely be opportunity. The other thing is, obviously, there are not too many assets and too many countries where you can invest in. And I think India to that extent stands out because this is one country which can from 4 trillion go to maybe 8, 9 in the next 6, 7 years and maybe to $20-25 trillion over the next 2, 3 decades. I think the problem in India has been slower corporate profit growth and valuations which are not entirely cheap. Right. I think both will get sorted with time. And I think that would be the time when flows come back, in a big way.
So you believe a time correction could be on the anvil, if not a price correction?
It's already there. So if you see, September is when we peaked, September 24. From there, index is down 12, 13, 14%, depending on, whether it's 22.5 or 23. You have already had 7, 8 months go by. I don't think anything dramatic is going to happen in the next couple of months because there is still apprehension of what will happen after 90 days and so on and so forth. So you had 1 year of correction and 12-15% of price correction. The only problem is, normally in 1 year, your profit growth is 14-15%. So this correction of 15% technically is 30%. This time profit growth has been only 5%. True. So maybe it might last a couple of months more, but I think we are getting there. So our view is very clear. I think we have possibly hit the bottom of what we touched when tariffs were announced. But big money still has some time before we can get visibility of that to be made.
Okay. What is the scary answer?
So scary answer is something I don't know which will happen in the next 2-3 years or next 20-30 years. Okay. So US has $35 trillion of debt. Even at 4.5% interest rate, they have to provide $1.5 trillion in interest cost every year. Now, the only way problems can be solved, so this is the numerator. The problems can be solved if numerator reduces or denominator exceeds or increases. Numerator is not going to reduce because, this interest cost itself is so huge and the economy is not growing, so the denominator is not going to increase. So I don't know how this problem of this huge debt will get sorted. This Doge and reducing cost might help to the extent of maybe $300-400 billion. It's not going to be massive. But now with these tariffs coming in, I think we'll again have slowdown, job losses. It's not one-on-one that if you put tariff, you just multiply your imports by the tariff percentage and that is the income. I think that is what they're trying to presume. That doesn't happen, So I think, I don't know how that gets solved, this $35 trillion debt. How does that get solved? Frankly, that is something which is scary.
Because you straddle both the private and public markets with equal aplomb, a great sense of what's happening with the large companies, but also the mid-size or the small-size companies which are not listed. is economic activity a big issue right now, or do you reckon it's a cycle? Your view, and what is it that you glean from your portfolio companies when you talk to them?
So first the positives, and then I'll come to the challenges. So I think positives, India's macro is phenomenal. I think you mentioned about inflation, interest rates are coming off, fiscal deficit is more or less in control, tax collection is not 18-20%, but a good 12-14%, which is pretty good. Corporate balance sheets are phenomenal. Yes. You don't hear about stress, you don't hear about defaults. Bank balance sheets are pretty decent, except for some stress in microfinance or unsecured loan, which is a small portion. I think bank balance sheets are pristine and clear. We have had a new regime at RBI. 5 lakh crores has been infused back into the system. We already had 2 rate cuts. And I think the impact is already showing. It's normally a 60 to 90 days lag. So we're already seeing that. All the banks have cut their deposit rates. They're cutting their lending rates. I think it will help, bring in more capex and more growth. But so far we have not seen it, but I think that is the positive. Challenge is corporate growth and corporate profitability for some reason has been very low. September we had 3-4% growth. December we had 5-6. March there are reports which talk again of low to single mid or around 5-6% growth in corporate profit. June was supposed to be the big quarter, but now I don't know how things will pan out because of some impact on tariff. We will not be that much impacted because we are not a big exporting country, but at the margin there will be some impact.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants
Mr. Benz, welcome to the show. And just, starting off with, how was the quarter gone by? What were the misses and what were you expecting?
Thank you. So on the quarter that's just completed, this was a very strong quarter and a very good finish for the year. As you've just described, we saw strong momentum on revenue with 11% year-on-year growth, and importantly also quarterly sequential growth of 8%. That revenue growth played through into our EBITDA line, where we also saw growth in the quarter of 9% and a very healthy margin of 34%. So the operation performance and delivery has been strong. On the PAT line, while the reported number was -3, once that's been adjusted for some one-time effects in the corresponding quarter last year, that also returned to growth. So it's a very healthy quarterly performance, building on the momentum that we started to see in the second half of the year. What's gone very well in the year has been the growth that we've seen in our large molecule manufacturing business and the recovery that we've seen in our discovery services, both of which are exiting the year with strong momentum. A challenge has been in the small molecule space, but again, we've seen in the second half of the year, we've seen a good number of customer engagements, and we see that taking momentum through into the next year. A real highlight for the quarter has been the acquisition of US large molecules biologics facility in Baltimore. Strategically, that's very important for us, building on our capabilities to play into what is the fastest growing part of the global CRDMO market, which is large molecule biologics manufacturing. That acquisition positions us very well to play into that market. And of course, it gives us a strategic foothold in the United States market itself. So it's
So, Mr. Vince, now the concerning point for investors is, so many investors were actually expecting Syngene would come back to double-digit growth, maybe from FY26 or 27. But now the outlook which has been given by the management is that the revenue growth will likely be in mid-single digits because of the new biologic facilities, which will actually increase operating cost and depreciation for the company. Just wanted to have your view when Syngene can see the double-digit growth which we used to have in the past.
Sure. So let me break down those questions a little bit. So for fiscal 26, we're guiding a reported revenue growth in the mid-single digit. On an underlying basis, our expectation is broad-based growth in the early teens across all three of the major platforms. So that would be our discovery services platform, our large molecule manufacturing platform, and our small molecule manufacturing platform. So on an underlying basis, we're expecting growth in the early teens there. Now, let me explain the difference there. The difference is that we are also factoring into 26 impact of a client inventory adjustment on commercial supplies in large molecule manufacturing. So we have a client, we've been supplying commercial product for them for their global launch. And as is completely normal in the pre-launch, launch phases, the supply requirements build up, and post-launch they begin to normalize. And we're going to see that effect play through with that client in 2026. But if we adjust for that, the fundamental underlying growth across all three of our businesses will be in that early teens range. Now, you also mentioned that the
double-digit growth. So when can investors expect the double-digit growth from Syngene? Maybe from FY27?
So I think that, as the inventory adjustment plays through, that we would expect that to wash out in 27, and then the more fundamental underlying growth to emerge, and we'll guide on that later on in the year. It's too early to call, but fundamentally we would see strong momentum flowing through.
Understood. Also, Mr. Vains, just wanted to ask you a question on that. There was a concern about has Syngene lost any customers because some of the customers have switched, to their captive centers. So, any update that you can give?
No, I think we're building a broader and deeper customer base. We're seeing a lot of inquiries coming in from customers looking to rebalance their supply chains, and of course the impact of the China Plus One. The emergence of capability centers in England, I beg your pardon, in India, we see as a positive. What this will do is grow the ecosystem of life science in India, and that's an opportunity for us.
All right, so that's the management of Syngene. Stock under tremendous pressure today on the back of those numbers. Stock down as much as 9%, 10% as we speak. But let's stick to earnings, and we've got Hindustan Unilever that we've been focusing on all of this morning. In fact, numbers came through not too long back. It has given up quite a bit of the gains that it had. It was up about 1.7%. At one juncture, it's down now about 0.5% or so. More details will come through over the course of the next 15 to 20 minutes as the management speaks to reporters, and we've got Mahima at the event as well. But I'm joined right now by Priyam Tolia, who's a senior research analyst at Axis Securities. Priyam, thanks so much for taking the time. What did you make of the numbers? The initial take was that it's in line with expectations. The segment revenue has come through, and it appears as if foods is not doing particularly well. What's your initial take?
So definitely the numbers are in line with our estimate in terms of revenue as well as on the EBITDA front. Particularly if you see from a segmental perspective, so foods, yes, it has been laggard. So food, they are actually facing challenges since last many quarters, especially in the inflation in the tea category, and also in terms of the overall health food drinks, right? So overall consumption demand continues to remain in the HFD portfolio. And again, the tea portfolio, they are gaining the market share in terms of the tea, but if you see from the inflation perspective, the margins continue to remain weak in the overall food categories.
Okay, margins continue to remain weak. So, but overall, you're saying that this is in line with your own expectations, and so therefore, looking forward, Priyam, what would be the factors that you would watch out for? We're going to hear the management speak very soon. What are the key areas that you would be focusing on in terms of the commentary? Because largely we're talking about, or they're saying that they're going to focus on that volume-led growth, which means that maybe you're going to likely see continued depressed margins, right? That, I guess, is the base assumption at this stage?
Yeah, so if you see from the guidance perspective, management has given a guidance of they will be able to deliver EBITDA margins of 22 to 23%. Right, and on the overall demand perspective, what we are seeing from the FMCG as well as the overall consumption perspective, the worst is behind for the sector. So if you see from a rural perspective, right, the rural continues to remain on a recovery path. Also, apart from that, the normal monsoon outlook plus the tax benefit from the tax benefit is likely to play out. So what we believe is that the second half would be, we can see a major recovery in terms of the overall consumption perspective. From the management commentary side, we'll have to see what management comments on the urban recovery side. So it's a big challenge. So in this quarter, we anticipate that the urban is likely to remain weak, but from Q1 and Q2 onwards, we could see some recovery over there.
All right, a final take, and I heard you say that the worst is over, and so therefore the question arises, a lot of people are saying maybe FMCG is not what you would pick in the broader consumption universe, and you're going to have to wait for a little while for those numbers to really take off, if at all. So would you say that at these valuations, because HUL has not really moved anywhere for quite a while, would you say that investors can perhaps now look at picking it up?
Yeah, so if you see from the last 1 or 2 weeks back, if the investor wanted to make a position in the FMCG or the consumption space, they would have won a better return. But we anticipate that given the valuation is slightly now have been lower or in line with the 5 years average, so it's still, we'll have to see the sustained recovery in terms of the overall top line as well as the bottom line. So one should anticipate 10 to 15 kind of a return in large caps universe in terms of FMCG. But if you see from a smaller companies, one can earn a better return over there.
Okay, all right. And we'll come to you at a later date to get your view on that. But Priyam, thanks so much for joining us this morning. Pleasure speaking with you. All right, let's jump back into Ask Profit. And this, by the way, is where we get all of your questions answered. And based on what you've seen over the last 24 hours or so, I'm pretty sure that you've got questions on stocks that are in your portfolios. The number at the bottom of the screen is where you can call us, and there's a number on the top of your screen where you can send us messages. And let's in fact introduce the experts that are going to be answering your questions today. We've got Kush Bora, who's the founder of kushbora.com, as well as Nirav Ashar, who's a head equity research analyst at Latin Manharlal. Nirav as well as Kush, thanks as always for taking the time. I'm going to jump straight into it because we're already a little late. The first question is coming through from Angel, who's writing in from Mumbai. She's asking about the technicals on Hoodco, which she's got 1,000 shares of, which she's bought 1 week back at a price of 217. She's in the green. The stock is currently trading at 231. Kush, first question to you. Would you hold on to this or would you book?
Hi, Alex. No, I would continue to hold on. The stocks had a good run. The consolidation that you're seeing in the last 2 to 3 sessions is par for the course after a sharp up run. So I think you should continue to hold on since she's already in the money. It's a good idea to have a trailing stop loss. So keep a trailing stop loss around the 223 mark and hold on the upside. You could very well see the stock hitting the 242 mark, and once that is taken out, perhaps 250 as well. So it's got good momentum going for it. Hold with a trailing stop loss.
Hold with the trailing stop loss is the call on Hoodco. The stock is up as much as 11% over the last month or so. It's had quite the run. Let's talk about red tape. And this is also a shorter term question, and it's coming through from Manish Gupta, who's writing in from Faridabad. He's bought at levels of 180 and he's looking at a 3-month time horizon. Or rather, he's looking at a 6 to 9 month time horizon. He's asking whether or not it will cross the 200 mark. It's quite a long shot at this stage. Kush, what's the view?
Well, I'm afraid, at least technically it doesn't really stand on a very solid ground because, if you look at the weekly setup, it's got a falling channel, resistance that it's looking at from a near-term perspective. The 20-day moving average itself around the 148, 146 mark is proving to be a stiff resistance to cross. So my suggestion would be to hold on with a tight stop loss near the 137 zone. And if that's broken, perhaps you can push it down to 135 for volatility. But, as the stock moves higher, closer to, let's say, 155 and then about 165, I think you should start exiting. It's not got too much going for it just yet.
Okay, not got too much going for it just yet. Tamil Selvan, regular viewers asking about Tata Technology. Actually, you know what? This is another shorter term technical question. So let me take another one. Sigachi Industries. Nirav, this one's for you. The name of the account, of course, I've already told you, Sigachi Industries. Niva from Chennai has got 250 shares, which he's bought at levels of 52. Can it be held for a period of 1 to 2 years? And what would be your target based on your anticipation of the fundamentals?
Well, I think the stock has seen some correction in the recent past, and I think we can expect a modest upside with a medium-term horizon. So I think the immediate targets would be close to 75 to 80 if we are able to see an improvement in the financial performance.
So that's the view on Sigachi Industries. All right, let me go to Tamil Selvan's question. He's writing in from France, as he normally does, and he's got a question, as I said, on Tata Technologies. He's looking at adding at a price of between 710 to 715, and he's looking further to buy at 690 levels if it dips again. He says that his stop loss would be below 677. He's looking at he's asking rather for a short-term target, and also he's looking for the Q4 results. But he's planning to invest or deploy as much as 50,000 rupees. Kush, is this a good idea?
Well, I must say, that's a very detailed question,
Yes.
with all the levels very cleared out on the way up and on the way down. So, very well framed question, I must say. Look, it's not a bad idea to start considering, an investment in Tata Technologies. The reason being the stock had a sharp fall, from listing. After that also, after a brief period of consolidation, it's had a, fallen off the cliff kind of a fall. Now you're seeing a double bottom formation in place. Volumes on the way up are picking up. The stocks crossed the 20 and the 50-day moving average. So I think it's got a few things going for it. Not a bad idea to accumulate some around these levels as well, and then perhaps to consider adding more if it dips to 710, 715, his accumulation zone. I think on the way up, you could look at targets of 765. That's the first resistance band, and once that is taken out, 810. So these are the two levels that you should look for as targets on the upside.
Okay, I do want to point out fresh developments coming through. Of course, there are tensions on the border with Pakistan after the attack that took place, the dastardly attack. And then the latest that we're seeing on the screen, of course, we're waiting for further details to come through, but seemingly reports coming from NDTV are that a joint operation of Indian Army and J&K Police is underway. There has been a fresh encounter. And this is something that has resulted in the death of one soldier. Of course, there has been quite a bit that has already been announced on the diplomatic front in terms of bringing Indian representatives in the Indian embassy in Pakistan back to India and asking Pakistan representatives to leave the country, giving them time to go back to Pakistan. And there's a lot more that will also emerge in the coming hours as an all-party meeting takes place to consider the response to the attack that took place not too long back in Kashmir. We'll bring you more details as and when we get them. For now, let me turn to our next caller, and Dheeraj is calling us from Hyderabad. Hi Dheeraj, how can we help you today?
Good morning, sir. My query is regarding Tata Communications.
Yes, please go ahead.
I bought it just today, like at 1,567 rupees, 130 shares.
Okay.
So recently there is a reiterate from CLSA that the target is 2,100. So could I accumulate more or hold or sell? Is my query.
I got your question. Would it be for a longer term that you're holding this?
For the next 1 quarter, sir.
Only 1 quarter. So you're talking about 2001. I don't think that they're talking about 2,100 targets for the next 1 quarter.
I guess it is in the next 1 year, but I would like to hold it for 1 or 2 quarters.
Got it. Okay. So, but since your question is based on a report that you read, let me go across to Nirav on the fundamentals, because we saw the numbers come through, Nirav, just a short while back. If I remember correctly, it wasn't too bad, right? So would you say that you can hold on, and what are the kind of upside potential that you say is possible over the course of the next couple of quarters?
Tata Communications was an ordinary set of numbers which was helped by certain extraordinary items. So I think I would really advise that if he should shift to something better like a Bharti Airtel, or something which has got more stable and consistent growth prospects.
Okay, fair point. And when you say Bharti Airtel, I just want to follow up on that. You're saying that it can be bought at the current juncture. I think a lot of people are looking at that. A lot of foreign investors also seeing value in Bharti Airtel as things stand right now. But what is the potential upside that you see?
Yes, I think from our study, basically Bharti Airtel has been a very resilient performer. Even in tough market conditions, the stock was able to hold on, and we've seen ARPUs have been going up consistently. There are a lot of other businesses which are doing quite well. So our target for the stock is around 2129 for with a 1 year horizon.
Okay, 2129 is quite the upside that you see. It is, after all, the leader in terms of average revenue per user, and so that's certainly a metric that is tracked by a lot of people. Of course, we'll see results from Jio not too long from now, later, in fact, in the week on Friday. Is when you will see it. But let's take the next question. Hari from Chennai is asking about SG Mart, which he's bought an average price of 365. He's got an investment horizon of 3 years. He's wondering whether to hold or to sell this. And he's asking from the perspective of this being part of the APL Apollo group. What's the view on this one, Nirav?
Well, I think at this point of time, it's better to be invested in the large cap stocks, because we are seeing a very good value emerge in the large cap stocks. So I think whichever sector we are going into, it's better to be in with the leaders or the the large cap ideas. Because valuations have been very, very compelling. So I think it's better to shift to some better quality names going forward.
Couple of them?
I think one can look at better quality retail plays which are listed.
Like?
One can look at a DMart or a Trent from a medium to long term perspective.
Okay, all right, point well made. Let's take Dinesh's question. Dinesh is calling us from New Delhi. Hi Dinesh, good morning. How can we help you today?
I'm holding 50 shares of Coforge, which were bought when the results were announced 3 months ago.
Sure.
And I bought it at 9088 to be precise.
Right.
And currently I'm suffering a loss of 83,822.
Right.
Now, should I hold on? Should I consolidate, accumulate more, or because of IT meltdown and tariff war?
Yeah.
Should I switch and arbitrage to some other share?
Okay, Dinesh, help me understand, when you bought it, and it's not too long back that you bought it, you've unfortunately borne the brunt of the kind of crash that you've seen in IT as a whole. But what was the time horizon that you had in mind when you bought it?
About 6 months to a year.
Okay, so relatively short term. Kush, I'm going to come to you in this one for strategy then, because he's bought at slightly elevated levels. And he's wondering whether to switch to something else. And IT as a pack has done incredibly well. There is resilience even today. So would you suggest a switch?
So for now, I would suggest, he hold on to this, the Coforge. The reason being that, we are seeing some kind of a revival. Now, my only caveat here is that, this is the expiry week, and we've seen funny things happen in expiry week, right? So I want to just be doubly sure that this is not just an expiry play and it continues to play on, even tomorrow and then, in the following days to come. And that's why what I would suggest is continue to hold on. As you rightly said, in the last week or so, there's been a very sharp uptick on, a lot of these IT names. While I don't think the IT sector per se is out of the woods yet, but this could prove to be a very healthy bounce that could sustain for some time. And a consolidation with a positive bias is on the cards. As far as Coforge goes, I would suggest hold on. 7,200 should be your tight stop loss. That's the 20-day moving average, and you should continue to hold Coforge with that stop loss. Not sure if 9,000 his buying price would be seen, relatively soon. So the idea would be to keep booking profits along the way as the stock moves up. Let's say closer to the 7,900 mark, then perhaps the 8,300 mark. So that's how I would play it. Hold with a tight stop loss and keep booking as the stock moves higher.
Okay. All right, so that's the view. I hope that answers your question. I won't keep our next caller waiting because she's calling us from Kuwait. Vanita, thanks so much for calling us. How can we help you today?
Good morning, sir. This is Vanita Bala here.
Yes,
I bought 2 shares. First one is Ceslon. I bought it for 60 rupees a share. 1,000 numbers I got for a 3 month duration. Should I add up more, or I can just wait for another 3 months for it to go?
Got it.
How the growth would be.
Got it. All right.
Second one.
No, let me stop you there, Vanita, because unfortunately we can only take one stock per viewer. So let me get your view on Suzlon. You've got a 3 month time horizon, and so therefore it's a trading view that you're looking for on the technical levels. Let me go to Kush on this one. 60 is more or less where the stock is at right now. What is the upside potential for a period of 3 months?
Sure. So, Alex, first the view is hold because the stocks had, its round of correction, consolidation, and then a rebound. So right now, the zone at which the stock is, which also happens to be a buying price, close to the 59.60 mark, that's a bit of a resistance zone for the stock, has been for the most part of this year. So continue to hold, keep a stop loss around the 57 mark. Now, as far as on the upside, in the view on the upside goes, I think the stock is quite poised to move to levels of 65 and then 69. So I would continue holding on to this one and keep trailing my stop loss.
Okay. All right. For joining in and getting that question to us. Kush, thanks so much for answering the question. Do stay with us. We have to slip into a very quick break. We've got more on the other side, so do stay tuned.
That's huge. That is a biggie. It's on.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to around.
में रखकर एक्सपांड और अपग्रेड करना होगा। हमें अभी से फ्यूचर रेडी बनना होगा। स्टील इंडस्ट्री के इस ग्रोथ पोटेंशियल में एम्प्लॉयमेंट जनरेशन की, रोजगार के अवसर की अनंत संभावनाएं हैं। मैं प्राइवेट और पब्लिक सेक्टर दोनों से आह्वान करता हूं, आप नए आइडिया डेवलप करें, उन्हें नर्चर करें और शेयर करें। मैन्युफैक्चरिंग में, R&D में, टेक्नोलॉजी अपग्रेड में हमें मिलकर आगे बढ़ना है। देश के युवाओं के लिए ज्यादा से ज्यादा रोजगार के नए अवसर बनाने हैं। साथियों, स्टील इंडस्ट्री की विकास यात्रा में कुछ चुनौतियां भी हैं और आगे बढ़ने के लिए इनका समाधान करना भी आवश्यक है। रॉ मटेरियल सिक्योरिटी एक बड़ी चिंता है। हम अभी भी निकेल, कोकिंग कोल और मैंगनीज के लिए आयात पर निर्भर है और इसलिए हमें ग्लोबल साझेदारियों को मजबूत करना होगा, सप्लाई चेन्स को सिक्योर बनाना होगा, टेक्नोलॉजी अपग्रेड करने पर फोकस करना होगा। हमें और तेजी से एनर्जी एफिशिएंट, लो एमिशन और डिजिटली एडवांस टेक्नोलॉजी की ओर बढ़ना होगा। एआई, ऑटोमेशन, रिसाइकलिंग और बाय प्रोडक्ट यूटिलाइजेशन स्टील इंडस्ट्री का भविष्य तय करेगी। इसलिए हमें इनमें इनोवेशन के लिए अपने प्रयास बढ़ाने होंगे। हमारे ग्लोबल पार्टनर्स और भारतीय कंपनियां साथ मिलकर इस दिशा में काम करेंगे तो इन चुनौतियों का और तेजी से समाधान होगा। साथियों, आप सभी जानते हैं, कोल आयात, खासकर कोकिंग कोल आयात का असर कॉस्ट और इकोनॉमी दोनों पर पड़ता है। हमें इसके ऑल्टरनेटिव तलाशने होंगे। आज डीआरआई रूट और अन्य आधुनिक टेक्नोलॉजीज उपलब्ध है। हम इन्हें और बढ़ावा देने का प्रयास कर रहे हैं। इसके लिए हम कोल गैसिफिकेशन का भी इस्तेमाल कर सकते हैं। कोल गैसिफिकेशन के जरिए हम देश के कोल संसाधनों का बेहतर इस्तेमाल कर सकते हैं, आयात पर निर्भरता कम कर सकते हैं। मैं चाहूंगा स्टील इंडस्ट्री के सभी प्लेयर्स इस प्रयास का हिस्सा बने, इस दिशा में जरूरी कदम उठाएं। साथियों, एक और अहम विषय।
Okay, so the Prime Minister speaking at the India Steel 2025 event and exhorting steel manufacturers to participate in India's growth story. There's a lot to talk about, of course, from that event, and we'll bring you updates through the day, not least of which what the Prime Minister is speaking about. But let me go across to Sunil D'Souza, who's Managing Director and Chief Executive Officer of Tata Consumer, to speak about their numbers. Mr. D'Souza, thanks so much for taking the time. The street has looked at the numbers. A lot of people, a lot of analysts already saying that the numbers were in line with their expectations. But some of the details that you've already disclosed in terms of the implication of inflation in tea, how much has been passed through in terms of price increases, and what the mix is in terms of the volume. So let me start with that. Seemingly, there's a pickup in demand in the lower end of the spectrum. Do you expect that that's the trend that will continue heading into the new financial year as well? Or do you see a slight change in that as consumption picks up?
So a couple of points on that. I mean, first of all, I think we were quite pleased with the results that we declared. In fact, EBITDA numbers, I think, were better than what we thought we would deliver. And that's because we saw volume growth across. Top line was good, 17% total, 12% organic. We've had volume growth across all our businesses. Even tea was 2% volume growth, salt 5%. International overall for the year was 5% top line. RTD, which was a problem in the beginning of the year, we delivered a 10% top line. The US is back on 4% revenue growth. So overall, I think we're in a decent place. EBITDA was the one place where we were negative 1.1 versus last year for the quarter. But if I add back, if I take out the tea cost and price increases that we've taken, then actually our EBITDA margins have improved by 80 bips. I would have delivered a 16.1 for the year versus the 15.3 of last year. So we would have actually improved versus where we have actually softened this year. And that's primarily because of the tea prices. About 30% of the cost for the full year has been passed on. We're passing on gradually. So for the quarter, it was 50. For the full year, it was 30. And here's the thing on what happens in a typical commodity when prices go up very sharply. Normally, there is a bit of down trading. And if I dial back 6 months back, or maybe about 4 months back, we did see a bit of down trading happening. The lower end, our mass portfolio growing far faster than the mid to premium. But now, as we come towards end of quarter 4, we've seen growth across all the segments. I do think if there is a normal crop, which I mean right now seemingly looks like for this year, then as supply normalizes, I think we will see a moderation in tea costs, and therefore I would see a sort of benign pricing environment overall for the year. We will take a little bit of calibrated pricing, but not as steep as what we took last year. And therefore, I would see all the 3 tiers, mass premium, and premium, all coming to play. So overall, we remain pretty confident about getting both volume and revenue growth. Revenue, we've guided for a double-digit top line, and margin expansion and EBITDA margins growing ahead of the top line.
Great. Thanks for that clarification. Mr. D'Souza, just a follow-up on that then. Assuming that what you're saying on the cost of tea comes true, the pricing, as you've pointed out, you might still have to do some action. Will that take place in the early part of the year, or will you have to spread it out over a longer period?
I would say we would have to probably spread it out on a longer period, for a very simple fact that it is a fine balance, right, between delivering margin, top line growth, maintaining market share, and a competitive position. And we've got to be very, very careful about it. That's one of the prime reasons why we've only passed on 50%, and 50% we've still decided not to pass on, and it's hitting the margins. So it's a calibrated approach that we would take, number one. Number two, raw material prices can be volatile. Last year, we didn't expect the tea price. When we started the year, we didn't expect tea prices to go up so sharply. So if we have ups and downs, we will react to those ups and downs as we go forward into the next year.
Okay. Mr. D'Souza, good morning. This is Hira on this side. So when you talk about the price hikes in tea and salt, both of that is what you're passing on to the consumers on the back of the cost inflation. Taking that into consideration, when are you expecting the profitability to then improve? Because now the price hikes, as you're saying, will be limited.
So number one, for salt, we took a price increase, I think, about 6 months back. And despite that, we've delivered a 5% volume and a 13% revenue growth. So we remain pretty confident about salt. As of now, we don't see a big move in salt prices. And therefore, currently, we don't see a reason to take salt price increases. We would drive volume growth and top line growth on the backs of the price that we've already taken. And of course, the portfolio expansion that we're doing, the premiumization of salt that we're doing, we would focus on those pieces. Margins per se, as I said, if I had netted off tea cost and price from last year's numbers, FY25 numbers, my margins would have been up by 80 bips versus FY24. And therefore, in the coming year, we do expect to see margin expansion. We've guided for 50 to 100 bips expansion in the short term, and we remain committed to that.
Right. Mr. D'Souza, the other aspect is with the kind of recent acquisitions that the company has done, the clear signal that the street currently is taking is the aggression that the company has to build a high growth F&B portfolio. Now, with everything said and done, growth business scale up, premiumization in the India business, that is going to be key to see sustainability with regards to margin gains and to reduce your dependence on the core business, which is nearly around 25% of your portfolio now. What is going to be the strategy from here on?
Tata Consumer, we've always said we want to be a premier FMCG, starting with F&B now, but a FMCG business which will deliver good financial metrics. We will grow both organically and inorganically. And I think we've demonstrated that as well. We've done 6 transactions in 4 years. And it's not that we've lost focus on the core. Despite doing the acquisition this year, for last quarter, for example, we've delivered a top line of 12% organically. And if I add the acquisitions back, it's 17%. The good part is we've got a pretty good portfolio mix today. So we've got 3 distinct pieces in the portfolio. A is my steady margin business, as you called in, the mid single-digit growth businesses, mid to high single-digit growth businesses, tea, salt, and international. They're delivering steady margins for us. Then we've got a very high growth, slightly lower margins in terms of ready to drink and sampan. That's the top line play for us. And then we've got these businesses which are very high growths, relatively lower TAMs, but significantly accretive margins, which is Soulful, Capital Foods, Organic India. So the good part is we've got a portfolio mix which is right up there. I think the key piece is now to focus on delivering growth with these three pieces of the portfolio focused on 3 levers: distribution, branding, and innovation. And we remain committed on all these 3 pieces. Distribution, we are now at 2 million direct reach, 4.4 million numeric. We've continued to power the businesses. Our A&P continues to be in the 7.5% 7.1 to 7.3, 7.5 range, which is a comfortable range for us. And innovation, I would say we're almost best in class at a 5.2% to sales.
Sir, one of the points that you just made, and you've given us a whole gamut of the strategy going forward, but I want to focus on the inorganic growth. And the reason I want to do that is I want to clarify, is that the reason why you are seemingly bolstering the cash that you have? Is that a war chest that you're building that you will deploy? And can you give us some sense of how you're going to be utilizing it?
So let me say, we've always said we will grow organically and inorganically. We will, if we see the right options in the market, we will definitely go after it. As I say, what we like is not for sale. What is for sale, we don't like. So that's the only reason why we're holding back. We were sitting with close to 3,000 crores of cash, but we went after significantly larger targets. And we did do a rights issue last year to make sure we are financially structured right. Again, we've got about 1,800 crores of cash on the balance sheet. Right now, we're focused on making sure we button down the 2 acquisitions that we've done of Capital Foods and Organic India. I think we're doing a decent job. The growth businesses, as I say, organic growth businesses, which we already had, grew by 24% last quarter. If I add Capital Foods and Organic India, they're 66, and we've guided for 30% of our business coming out of growth businesses, which will grow at 30%. So that is very clear. Going forward, I mean, once we settle down Organic India and Capital Foods, if there is value accretion that we see with the inorganic asset, and it has to fit both strategically and financially, there's no reason we would shy away from that.
Mr. D'Souza, your view in terms of Starbucks, I mean, almost a sales growth of around 6% on a year-on-year basis. And this is despite 6 new store additions that we've seen, which takes your total store count to almost around 479, if I'm not mistaken. This does somewhere indicate a negative same-store sales growth, in my opinion. Are you expecting further weakness in the near term? And if so, what is the strategy to improve this?
So overall, if you look at it, the QSR segment in India has been under a slight bit of stress. Overall, discretionary spending has been in stress, and therefore you would see that action across all the different players in the market. And Starbucks has not been a complete outlier on that piece. The good part is where we had close to double-digit same-store sales growth in the beginning of the financial year, we've almost come to a 0. So by both macros improving as well as actions which the team has done, including activating different events, celebrating 100 stores in Mumbai and making a big event out of it, activating the classic menu, which appeals more to the Indian consumer, both in terms of price and value, as well as taste. I think multiple factors at play. For the full year, we've still added 58 stores. We are now in 80 cities across the country. We are the largest coffee chain operator now in India with 479 stores. So we feel pretty good about where we are, but we remain committed to the FY28 goal that we set out of 1,000 stores in India. I do think India coffee, both in-home as well as out-of-home, is a secular opportunity which will be there for a few years, and we've got to take full advantage of that.
Just a quick clarification on that. Then the indication or the interpretation that you're going a little slower on store opening in Starbucks is incorrect?
No, it is correct, because we have, I mean, let me say, I like this saying from a dear boss of mine who said emerging markets is a snake in a pipe. The pipe is directionally pointed upwards, but the way the snake moves, there is a bit of yo-yos, and we are seeing a bit of that. And we will calibrate in the short term ups and downs depending on what we see in the macro environment. We opened 58 stores for the year. We would have liked to open more if the going had been very good. We tempered it a bit, but longer term 1,000 store number remains.
You've tempered it a little bit, and taking those cues into consideration, Mr. D'Souza, I know, I mean, valuations is not something that I should be asking you or talking to you about, but clearly the street has given Tata Consumers a rich valuation. Now, this clearly leaves the company very little room for execution missteps. Any commentary on that front as to how targeted it could be, taking into consideration the kind of urban slowdown that still is on the cards?
So let me answer your question on urban slowdown first, right? Actually speaking, if you look at my general trade alone in isolation, rural grew by about 7.2% and urban grew close to 2%. But here's the thing, I don't address the urban consumer through general trade alone. If I add back my modern trade, which is primarily urban, and if I add back my quick com, which is primarily urban, and just take a number saying 50% of e-commerce, if I assume it as urban, then my urban business has grown by 14.5%. So I'm not sure urban slowdown at a 14.5 is definitely not a slowdown. And this is organic. I'm not counting my new acquisitions into the number. I'm doing a like for like, right? So from that perspective, we remain pretty bullish on the overall India trend. And overall also, my gut feel is that we bottomed out in October, November. And from there on, the going has been easier, if I say so. On the valuation front, management's job is not to drive valuation. Management job is to lay very specific targets and deliver against them. I do think we've delivered a pretty good FY25 in the face of what we were given. And we remain focused on making sure whether it is distribution, branding, innovation, digital, all these pieces we remain focused on to deliver. Valuation ultimately is for the street and the investors to decide.
Mr. D'Souza, sticking with the snake in the pipe analogy, hope that it turns a corner very quickly and moves up and the pipe remains straight. Thanks so much for joining us today.
Thank you. My pleasure.
Right, sticking with FMCG, we're talking about HUL. It's, of course, announced its results. We've spoken about it. The management is speaking at a press conference. Let's go across and see what they're saying.
While absolute volume tonnage grew in mid-single digit, it was partially offset by negative mix. We delivered a competitive performance, further strengthening our market share. Gross margin was at 50.3%. EBITDA margin remained healthy at 23.5%. Albeit lower 30 bps year-on-year. Profit after tax before exceptional items grew 1%, while profit after tax increased 5% year-on-year, led out of profits received from disposal of Pureit. During the year, we continued on our journey of sharply executing the Aspire strategy to unlock 1 billion aspirations. We have segmented our portfolio into core, future core, and market makers. Our segmented portfolio approach facilitates better allocation of resources to maximize overall organizational growth. In financial year 25, we continue to modernize our core portfolio with relaunch of Lifebuoy and Glow & Lovely, strengthened our market position in future core, and delivered double-digit growth in market makers portfolio. Our focus on transforming our business into high-growth spaces has led to a 200 bps shift from core to future core and market makers. We have accelerated our pace of transformation with sharper where-to-play choices. We acquired a majority stake in Oziva, a health and well-being business, in January 23. The business has since scaled up from an annual run rate of 100 crores to 400 crores. Last quarter, we announced the acquisition of 90.5% stake in Minimalist. I am pleased to inform you that we have completed the closing formalities as of 21st of April 25. We look forward to unlock the next phase of growth with Minimalist, which is now a part of larger HUL ecosystem. Pureit business divestment was completed, unlocking value of circa 600 crores. The demerger of ice cream business is progressing on track with regulatory requirements, and we expect it to be completed by end of financial year 26. In line with our strategy to strengthen business resilience, we announced the acquisition of palm undertaking from Vishwatej Oil Private Industries and announced our investment in Lucro Plastic E-Cycle Private Limited. The former will aid our palm localization strategy, while the latter is a step towards developing flexible plastics circularity. Considering our performance for the year, the Board of Directors have proposed a final dividend of Rs 24 per share, subject to approvals of shareholders at the AGM. Together with interim dividend of Rs 19 per share and special dividend of Rs 10 per share that we announced in October 24, the total dividend payout for this year will be 12,453 crores. Moving on to March quarter 25 results. Underlying sales growth was 3% and with an underlying volume growth of 2%. Gross margin at 49.8% was lower by 160 bps year-on-year. This contraction in gross margin was driven by commodity inflation across palm oil, tea and coffee that wasn't fully priced for. EBITDA margin remained healthy at 23.1%, lower by 30 bps year-on-year. Profit after tax before exceptional items and profit after tax both grew at 4%, including the benefit of interest income on prior period tax adjustment. Coming to performance across the four business segments, Home Care delivered a robust mid-single-digit UVG, which translated to 3% USG as we continue to pass on the benefits of deflationary commodity prices to our consumers. Beauty and Wellbeing grew at 3% USG, led by volume. While Hair Care delivered double-digit growth, Skincare was impacted by mass skin performance. Personal Care delivered 3% price-led growth, while UVG declined in low single-digit. Skin Cleansing, led by non-hygiene segment, continued its positive growth momentum. Oral Care delivered price-led growth. Foods turnover declined by 1% on the back of mid-single-digit decline in volume. Robust performance in beverage, ice cream and packaged food was impacted by performance in nutrition drinks. Margins in all four segments remain healthy, with Home Care at 18%, Beauty and Wellbeing at 33%, Personal Care at 18%, and Foods at 16%. Moving to our near to mid-term outlook, we expect growth to gradually improve as a result of our accelerated portfolio transformation actions and improving underlying macro conditions. We anticipate first half of financial year 26 to be better than second half of financial year 25. If commodities remain where they are, we expect price growth to be in low single digit. Gross margin is expected to further moderate due to commodity inflation and our continued commitment to provide consumers with the right price-value equation. We will step up investments behind our multi-year market-making platforms, channels of the future, and strategic capabilities to successfully land our portfolio transformation. As a result, EBITDA margin will be maintained in the range of 22 to 23%. We believe this is the right time to accelerate investments as we chart the future course of growth for the company in the backdrop of portfolio transformation actions and improving macro environment. With this, we conclude our prepared remarks and I will take questions.
Hi, thank you so much, gentlemen, for speaking. If I could just quickly touch upon the urban demand scenario, can you give us a little more clarity on how the improvement's been there? Are you seeing any rebound in the urban growth and also a little bit of in the rural demand also? Give us a little more sense on the inflationary scenario also. You said low single-digit price growth is what you're expecting. Going forward also then, how do you see the volume to price mix also changing for the fiscal that we're entering into? And then on the same lines, then how do we look at the margin profile as well?
So maybe I can cover off the broad market shapes and then Ritesh can talk through some of the more nuanced points you asked about the price and mix. So broadly speaking, we've seen market growth subduing over the last few quarters, largely led by urban. Rural, on the other hand, is resilient and robust, and we see that holding up. And we do expect going forwards, macro triggers are positive. We see, of course, the food inflation coming down sharply. We see the interest rates also being reduced. That will impact the EMIs and therefore lots of urban households. The crude oil being softer also does impact the entire economy. The agricultural output is strong. The monsoons have been good after a long period of difficult weather conditions. The reservoirs are full, the granaries are full. We believe that the rural areas would remain robust. We as a company, of course, have or will compete in all market conditions, but we do expect that the macro drivers are positive going forwards, and we expect the urban demand therefore to start, inching back up. Therefore, on the whole, we do see gradual improvement in the macro. Importantly, for our own business, we are very committed. We have been, going where the growth is, despite what the market conditions were in the last few years, and we've been strengthening our portfolio, moving it to faster growth spaces, getting channels of the future, building capabilities, innovating quite intensely, acquiring brands, launching brands. So we feel quite confident at this point that we have a strong investable portfolio. We are operationally quite robust. Our brand powers are strong and getting stronger. Our penetration growths are good. So we expect that as tailwinds come in, we are best prepared for this turn. And therefore, we feel confident at this point to lean in and invest for the future. There'll be categories that are price sensitive, where there's high level of competitive intensity. We are going to unblinkingly defend those categories. We're also going to make sure that our price value equation is absolutely on dot. That gives us the best chance to actually improve our competitiveness further. So we are being quite active and I would say leaning in aggressively on investing on our business. We believe this is the good time to do that, and it's a very opportune time to invest for the future of the FMCG in this country, which, as you know, is a long game, is a great place to be in.
Right.
So let me just add and pick up the other questions you had. So as Rohit mentioned, both we look at external atmosphere of macro conditions and what we have done internally to drive our portfolio transformation. Put together, there's a pretty strong case for us to further dial up investments going forward. Coming to pricing, there are two different group of commodities. When I look at crude oil and related commodities, which impacts by and large home care, we are seeing deflationary scenario there. In fact, crude oil back to back for the last 2 years has been deflationary. But we see a group of commodities like palm oil and tea where we have seen inflation. And hence, there are reasons where certain categories will see price increase, certain categories we will have some price decrease. On a net basis, we expect low single-digit price range going forward. To your question, where do you see the balance between volume growth and price growth going forward? It's a healthy mix as we speak this point in time, but as the year will progress, if commodities remain where they are, volume growth will be ahead of price growth.
Right. But which are these categories, Ritesh, if you could say, where can we expect the price decreases and where can we expect the price increases?
Yeah, so home care is a category which gets largely impacted because of the crude oil. This is where, as we speak, in the quarter we had a negative price, and this is where the momentum of pricing will be negative, unless again the signals of commodities end up changing. And price increase will be essentially in skin cleansing, which is where crude palm oil has increased, and tea category. Of course, tea, I'm very mindful. We are now not in season for tea production. The new crop will come in May and June, and we'll have a different signal, if at all, and we'll determine basis that what happens later on in time.
If you could also just touch upon the margins bit that I was talking about. How do we look at
Yeah, so margins, what we had explained that we are now investing behind more, given both the right time to invest because of internal dialing up of the portfolio and because of external improving conditions. Because of that increased investment, we will go to a little lower EBITDA range of 22 to 23%. This guidance is for next few quarters for us. Now, of course, few quarters later, we'll determine into what guidance we end up operating at, looking into market conditions. As Rohit mentioned, we always maintain between growth and profit, it's unblinking growth as a priority for us. And we have very strong levers to manage margins. This is more investment-focused decision where the margins will be a little lower compared to where we are today. Our machinery, our reflex muscles on driving savings across all lines of the P&L, that remains very strongly installed. And it will keep helping us to keep driving more amount of investments across the board.
Just to confirm on last time the guidance was between 23 to 24% of margin. So right now the guidance is 22 to 23% and on the lower end of that band. Is that correct?
So let me clarify. Last time we had spoken about a guidance of 20 to 23 and we said we'll be the lower end of that range. So more towards 23 is what our last guidance was. Okay. Today what we're speaking about that we are lowering that number to a range of 22 to 23 because we believe now is the right time for us to dial up further investment to drive growth.
Okay. And in terms of one more thing, there's a trend that I observed yesterday in one of your peers that came out with the numbers. They said that they've seen more traction in the lower end of products, and of course the small packaging trend has always been there. But something that came out in their commentary was that there was more traction seen in lower end of products as compared to premium products. Is that something that you have also observed?
First of all, we speak from what we see in our own business, and I just restrict my commentary to that. We have seen premiumization, as I mentioned to you, and we must always keep our lens a bit wide. Zoom out first of all, then zoom in.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise and dealers are indicating that a preferential issue to the UBS.
Hello and welcome. You're watching KYC. Today we're going to speak and break down a very interesting company. Zagel is what we're going to try and get deeper insights on. Let's talk about why we're looking at this company and what is it that I'd want to know about this company first off. It's a platform company and therefore both IT as well as platform is largely how the business can be described. I want to understand whether it's a unique business. Are there deep moats in it? Because when you're looking at the way in which the stock price has moved and how it's currently valued, it's valued extremely richly. And therefore, is it a unique business and are there deeper moats, or can someone come in and replace this business very, very quickly? And if that were to happen, you could well see that as one of the largest risks. Second is with regard to the growth guidance that they've given. They've given, again, very, very strong growth guidances. They've been able to beat it, at least in FY25. Can they continue to do that? Is there upside, downside risk to that? Third is what's the likelihood of customers staying with the platform? So one is to try and get new customers. That is going to be one concern. The other one is whether the existing customer base will remain with the platform. What is the contract tenure like, and how sustainable is it for the customer to stay back? Fourth is, can margins expand? They've guided for very strong margin expansion. Can they really expand or not? Fifth is there a concern with regard to receivables? Now, why is this a concern? When we're looking at the cash flow, the cash flow from operations hasn't gone up despite profit before taxes rising extremely sharply. That is not a good sign, because that means there are certain receivables sitting in the cash flow statement, which is creating an issue with regard to cash flow from operations. I want to understand whether there is a concern there. And lastly, what are they looking for when they make acquisitions? What's the end goal, and how do they expect and what exactly are they expecting when they're making acquisitions? Is it going to be margin accretive? Are they looking only for geographic growth? Are they looking for product growth? What is it that they're looking for? So all of this we'll try and understand better. Acquisitions, largely the way in which they're deploying cash. So fresh cash largely getting deployed in acquisitions. So that's the sum and substance of it. Let's though talk about the company now. Let's talk and let's zoom in to what the company is actually about. First one, it's a fintech plus a SaaS company, right? And I'll break both these terminologies down a little bit better. So it helps businesses manage expenses. So it provides software as a service to businesses. So it's a B2B, 2C company, but mainly a B2B company. It's a business-to-business company. It's the #1 prepaid card issuer in the country. So once they onboard a company onto their platform, they are then able to provide the customer with better products to help manage the expenses of their employees. And that's probably how they do it. One of the ways is through issuing cards. They serve corporates, SMEs, as well as startups, so they have that entire cohort. They have around 3,300 corporate clients at this point. They have over 30 lakh users of their platform, and they have an in-house digital payment technology. Whether this is replicable or not is one of those risks that I was talking about. They were founded in 2011 in Hyderabad. So this is all about Zagel. Now let's talk about what exactly it does. So it offers prepaid gift credit cards for the employees of their customers. They provide a software for expense tracking for their customers, and it allows customers to provide employee rewards with better ease, automate bill payments, and just manage expenses in a better fashion. They have 4 key products. I mean, they have plenty more, but the Propel Save, the Zoyer, and the EMS are the largest products at this point, with Zoyer growing the fastest in terms of product. Now, I'm going to try and also give you a description of what each of these products do. So Zoyer is the accounting software. So all your vendor payments are routed through Zoyer. That's one of their prime products at this point. They also have Zagel Propel, Zagel Save, Zagel International Payments, Zagel Fleet Management, and Zagel Zatix. All of these perform different functions with regard to expenses. One is for reimbursement for employees. One is to help employees make sales. One is for analyzing business expenditure. One is for fleet management, and one is for international payments. So you've got all of these different products which they work with. They have currently over 5 crore cards issued as part of their product stack. And in terms of how it operates, it sells to businesses mainly and not to individuals. It uses automation. There's a current software platform which it sells. It partners with banks, travel firms. It cross-sells multiple products once a customer is onboarded. It helps monitor spending. It's sector agnostic. It has around 400 odd employees in India, and it listed in 2023. So it's a publicly listed company since just about 2023. So 2 years there. Now, in terms of how it helps the customer, it saves business time, money, it reduces errors, it improves cash flow, it offers tax-saving employee benefits. The customer churn is extremely low. It's less than 1.5%. It's a unique business in the fintech space. Can it be replicated is really the question. They do make acquisitions on and off, and currently sits at a market cap of around 4,900 odd crore. So that's how it kind of all stacks up. Currently, trailing 12 months, 1,165 crore is the top line of the company. So this is all about Zagel. Let's now dive deeper into the metrics that we always talk about. And I'll start off first with some of the user metrics and customers that Zagel has worked with, and how that has grown. If we can quickly pull that up. That's how the total number of users has gone up by. So from just about 9 lakhs, it's gone up to around 31 odd lakhs over the last 4.5 odd years. The total customers also have gone up from 1,092 to around 3,337 in the last 4 years. So you're seeing that kind of inch up with regard to performance metrics and customers, which helps the company grow. We will have Avinash Godkhindi, who's the MD and CEO, shortly to talk to us about how he sees risks play out and what's the guidance like going forward, thereby giving us some bit of color on what to expect and how to value this one. Let's look at the metrics now. Let's talk about the income statement. The growth has been strong with regard to this company. Of course, it's a software company, smaller base as well. So it's grown at nearly a 48% 3-year CAGR in terms of how the income statement has grown. Look at it, double in terms of revenue just in the last 2 years. EBITDA also has been phenomenally sharp in terms of its uptick. You've seen EBITDA go up by nearly 37% 3 years. It's fallen a bit in FY23, but we've seen a bounce back in FY24 in terms of EBITDA. The EBITDA margins, which are traditionally higher, have come off because the company is investing in new and newer features within their platform. And now they are expecting a steady inch up in terms of EBITDA margin going forward. But at this point, margins are a shade below 10%. Profitability has been extremely strong. It's up at roughly a 47% CAGR over the last 3 odd years. So it's a thumbs up across the board in that sense. Let's look at the 9-month numbers as well, and we'll get better context here rather than the last 3 years. Just look at the way in which some of those numbers have gone up by. You've seen revenue go up 77% YOY. EBITDA is up 81%. EBITDA margin is up 20 bips or thereabouts, and profit is up 56% YOY on the 9-month period in terms of FY25. Let's switch over, and clear thumbs up with regard to some of these numbers. Let's switch over to the balance sheet. It's a low debt company, just about 60 crore rupees of debt. And as I did mention, nearly 5,000 crore in terms of market cap. So I won't talk much about debt, but look at shareholders' equity. Shareholders' equity has gone up over the last maybe couple of years because there have been a couple of fresh issues that they've done. The reserves number has also inched up. And the cash, and that may not reflect because there has been a recent fundraise that Zagel has done. But you look at the cash and bank balance, it sits pretty at 200 odd crore. So you're sitting at a decent level of cash balances. So we'll give this one a thumbs up as well. They're going to deploy cash in new acquisitions, and we'll talk a little bit about that as well. Currently, no risk, at least on the balance sheet. They're doing some bit of equity dilution, yes, but nothing major expected in terms of equity dilution going forward. Let's look at cash flow. And this is where some concern creeps in. While the negative 35 crore cash flow has come down to negative 1 crore, but you've seen, and one of the reasons why there could be a concern here is the receivables have gone up sharply when you're looking at it over the last 2 to 3 years. So the receivables number, because of the sharp inch up, you are starting to see some bit of pressure on cash flow from operations. Can that go away is the question. Can receivables flatten out over the next 2 to 3 years while maintaining that PBT, very strong PBT growth for the company that we've seen over the last 2 to 3 years? And if that were to happen, this will even out. Cash flow from operations will show a solid positive number. Net cash flow, though, still positive because borrowing, which was made in FY24, and equity raise, which has been made in FY25, currently taking care of the net cash flow number. Let's talk about return ratios. Now, again, it's fascinating. The return ratios are on a tapering trend because of the new investments that they've made. This is as per Bloomberg numbers, mind you. The return ratios have come off and therefore something to look out for. A thumbs down. We'll have to wait and watch for those return ratios to bounce back up. Let's talk about shareholding pattern very, very quickly. Now, in terms of the way in which the shareholding pattern has gone, you've seen promoter buying, which is happening here, which is the one key positive, right? You want a company where promoters are interested and wish to buy. Of course, there's been some bit of equity dilution, but promoter buying is the one thing which is positive. In fact, commentary also seems to suggest that promoters will keep increasing their stake in the company, which shows some bit of confidence that the promoters have in the business, and therefore a clear thumbs up. Let's look at the street cred now. The last 6 months or so have been difficult for the company, but the last 1 year returns have still been positive at 26 odd %. So decentish in terms of their 1 year returns. We'll give this a thumbs up. We'll give them that benefit of doubt because the near term has been tough, especially for small and mid-cap companies. And this one is within that basket of small cap companies, and even in fact one of the smaller ones even within that basket. Now, in terms of outlook, what can we expect? And that's the other metric we are looking at. They're expecting a 63% growth in FY25. Around a 45 to 50% growth is what they had guided for. They've overachieved on that count likely. They've done 77% for 9 months FY25. Mind you, we looked at that number. And therefore, it's a positive with regard to if they are able to continue to grow at this clip. If we look at the way in which customer count has increased, if we look at the way in which all their metrics are lining up in that sense, and how many new customers they continue to onboard, we get regular updates on the exchanges that they have been adding customers on a regular basis as well, and that kind of keeps that confidence that you could see this kind of growth being clocked. Expect margins to go to mid-teens in the next 3 to 4 years. That's at least the outlook that they've given. They're looking at acquisitions, so they're deploying fresh cash into acquisitions. They will use the spare money to buy more companies and to try and grow their market. Now, that's all of that is positive, because you would want a fast-growing company to continue to reinvest the money at a higher return ratio. So we'll also have to look at that, whether that return ratio can come back up, can bounce back up. Now, in terms of valuations, and let's break this down, again, slightly more nuanced, and we've, of course, followed the kind of guidance and outlook that management has given to try and arrive at a valuation. The current market cap is roughly 4,800 crore odd. Your FY25 revenue is expected at roughly 1,250 odd crore. The FY26 revenue at a 50% growth clip is expected around 1,900 crore, and the FY27 top line is expected around 2,800 crore. We've not gone beyond that. It's likely that growth may taper because the base gets higher. We'll quiz the management as to what gives them the comfort, if at all any, that growth may actually stay elevated even at those levels. But let's take FY27 as the base year. Now, they've guided that in the next 3 to 4 years, margins will go to mid-teens, so say 15% by FY28 or FY29. So let's assume a 12% margin in FY27, because that will be a journey which they'll take. EBITDA will roughly be at 340 crore. That means that the stock, which is at 4,800 crore in terms of market cap, will be trading at 14 times EBITDA at that point of time. Also, that will mean, let's factor in maybe 20 to 30 crore of interest payments and depreciation, which has largely been the case over the last few years. And therefore, your profit before tax will roughly, and of course, you'll have to add other income as well. So your profit before tax, we've assumed at 320 crore, and profit after tax is around 240 crore. So it's trading at a price to earnings multiple FY27 of 20 times. Currently trades at 65 times trailing 12 months. So be careful of that. What the risk could be? Execution, growth, and margins. Those are some big factors that we've assumed in as part of our assumptions, and therefore those could have downside risks. And of course, we'll try and get perspective as to whether those risks will translate or not. And we'll speak straight to the management in just a minute. But first off, on the ratings, how does it stack up? Let's pull up the ratings very, very quickly. You have the income statement, balance sheet, thumbs up, very strong growth, cash flow, more to be seen, return ratios, a thumbs down because it's just sub 13% as of now, but you could well see an inch up there as well. With regard to shareholding, street cred, outlook, and valuations, no negatives there at all. So 5.5 is what Zagel gets on our KYC ratings at this point. Let's quickly look and speak with Avinash Godkhindi, who's joining us, co-promoter, managing director, and CEO at Zagel Prepaid Ocean Services. Welcome, Avinash. Good speaking with you.
Good morning.
Good morning. I want to first understand from you what really helps Zagel stand out in terms of competition. Do you believe that the services that you offer are easily replicable?
Great question, Harshan. It's the reality of these businesses is that there is no one thing that stands out. There's always a combination of factors. And we've also had a lot of luck along the way. So I have to be honest that, if we were to try and set up this business today, it's extremely hard because we have three pillars in our business. There's software, there's bank partnerships, as well as corporate relationships. And we believe unless you've all these three bases covered, you can't build a profitable spend management business, at least in India. Right? And today, for somebody to come in and try to stitch all these three pieces up is incredibly hard because it takes a lot of time and you can't buy your way into bank partnerships or even enterprise contracts. So that's the big moat. The fact that we probably started this business at a little before time, but not too before time, 13 years ago. And at that time, getting the bank partnerships was far easier. Banks were a lot more, it was an innocent phase, is how I would call it, of the fintech industry, 2011-12. And we worked with banks and we built our credibility. So today we work with 16 banks, all the major banks in the country are partners with us. HDFC, ICICI, SBI, Axis, Kotak, Yes Bank, IndusInd. All the major banks work with us and a couple of international banks, DBS, HSBC. So today, for somebody to come in and try to replicate across these three pillars, we believe is going to be extremely hard.
Understood. And what's the likelihood of your customers staying on your platform? I know I've asked you this question before as well, but give us perspective because we've broken this down from a know your company perspective.
Yes, so look, our historical churn rates for customers is less than 1.5% per year. So customers don't leave us. And there are many reasons for that. One, we have a high quality solution and it's incredibly difficult to be able to move away once you have a ERP integration, once you have an HRMS integration. There are customers where we have a CRM integration with their Salesforce, etc. So then, the whole ecosystem is a well-oiled machine. Why would you want to move away? Secondly, we are also a partner who brings tremendous value to them. We reduce fraud and leakage, we increase their compliance, we reduce their human capital that gets deployed in mundane tasks. We leverage AI heavily today. We are continuing to do that so that benefit gets passed on to our customers. And they are able to make sure that their teams are more meaningfully used rather than doing mundane reconciliations or checking, receipts, etc. And that is a big value for corporate customers. And secondly, additionally, we are very competitively priced. So that also works in our favor.
Okay, point taken. Now, one thing, Avinash, that stood out for me was your cash flow from operations. It's not going up in the same clip as your profit before tax, which is growing at a very healthy clip. Why do you reckon that's so, and what is it going to take for you to start your cash flow from operations to start turning very solid?
Good question, Harsh. And this is something that we are constantly working on. This is something that's a focus area for us. And we are seeing improvement. You'll see improvement in the full year numbers as well. We track it as a percentage of our revenue. And the reality is the way most businesses operate, you first grow your revenues, then you grow your EBITDA, and then that translates into cash flow. We are in two different, and there is a slight lag there. There's also a fact that we work with large banks and large enterprise customers. And while we work with them to streamline their payout periods, there is certain lag there. And these are receivables largely from partner banks, some of the biggest banks in the country like SBI Cards and others, ICICI. So we are working with our partner banks, we are working with our corporates, and I don't need to say much. You can see the improvement from last year to H1, and now the full year for this year, you'll see numbers improve.
Okay, and what are the factors which are weighing it down currently? Is it receivables, and why is that a bit of a tepid number?
See, Harsh, as we raised capital in September 2023, right? We've always historically been cash flow positive. As a largely bootstrap company, you don't have a choice. Otherwise, you don't survive. So the DNA of the business and the organization is to be very cash focused, and we continue to retain that. When we raised the capital, the whole idea was to raise that capital and deploy it to grow and to grow fast. And we've been doing that quite successfully, in my view. In that period, it was bound to be that there would be a certain amount of cash that would get deployed, and that would generate the profits, and eventually, the cash comes back to the business. So that was always the plan, and that's how we've been operating, and we're seeing the whole trajectory move as more or less as we had envisaged.
Okay, point taken. What should we look at in terms of growth? Because you've guided for a 45 to 50% growth clip for at least the next 2 to 3 years. Can we extrapolate that and push it forward by maybe a year or two? And the reason why I ask you is because you've guided for margins to reach mid-teens, 15, 16% in the next 3 to 4 years maybe. And therefore, will be valuable from a viewer perspective as to what the upside or downside risk is to the kind of growth, top line growth guidance that you're guiding for.
So Harsh, we've said that we're aiming in the next 5 to 7 years to reach a $1 billion revenue. That's our goal, assuming that the dollar-rupee ratio stays in a reasonable range, right? But that's what the target is, and we are on track to do that. In fact, if you see last year, we had started off the year giving the guidance in the range of 45 to 55% growth. We've consistently upped that, and we had given a guidance last of 58 to 63% growth. Happy to share that we've looks like we've crossed that 63% mark as well by a bit. So growth has been very strong, simply because market leadership helps you attract a lot more business, a lot more contracts, a lot more traction. And being listed helps because there's a certain amount of credibility that comes to you as a listed entity. And that brings a lot of comfort to our customers and partner banks.
Okay. All right, Avinash. Would love to have quizzed you even with regard to acquisitions, but unfortunately out of time on this one. But thank you so much for joining us, giving us all of that perspective. Great to speak as always, and wishing you all the very best for FY26 and beyond.
Thank you. Thank you so much, Ash.
Right. Right. With that, we're out of time on this edition of KYC. From myself, everyone who puts the show together, thanks so much for watching. Hope this was helpful. Stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The second buyback is a Naukri Info Edge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Markets trade range bound, but in the red. Pharma and metals gain. Realty and FMCG drag the indices. FMCG major Hindustan Unilever's fourth quarter earnings meet estimates. The company says urban demand continues to be under pressure. Nestle as well came up with their Q4 numbers. Revenue rises 4.5% to 5,504 crore rupees. Net profit though slides 6.6% in line with estimates. Pharma major Lupin shines today as a generic version of a drug that treats kidney function is all set to be launched in America. The countdown has begun for Pakistani nationals to leave India. The Atari-Wagah border is closed. The Pakistan government's official handle on X.com is withheld in India, and one soldier is killed in an encounter with terrorists in Kashmir's Udhampur. Hello and welcome. Good afternoon, viewers. This is Malika Mishra and you're watching Markets at 12. Two big numbers. FMCG giants Hindustan Unilever and Nestle have announced their fourth quarter earnings in line with estimates. My colleague Mahima, who closely tracks the space and is at the venue of the HUL press at the moment, is going to tell us more about how these FMCG companies have fared so far.
Right, so Mike, I'll start with HUL first. In terms of HUL, the numbers definitely were in line. Revenue was up 2%. Net profit saw a growth of around 3.6%. In terms of segment-wise growth, home care was up 1.8%. Beauty and personal care was a surpriser where the growth came in at 4.2%. Personal care was up around 3%. Foods still continues to see pressure, down by about 0.3%. The underlying volume growth was at 2%, but the stock actually seeing significant pressure in trade today, and this is on the back of company lowering its margin guidance. The earlier guidance was 23 to 24%, which is now lowered to 22 to 23%, and the management has also said that the margins will be on the lower end of the band. Now, in terms of the commentary coming on rural and urban recovery. Rural, they are seeing recovery. Urban continues to see pressure. In terms of Pureit demerger, it has been completed. The growth will gradually be better in first half of FY26 as compared to first half of FY25. In fact, even second half of FY25. Gross margins will further moderate is what the company has said. And overall volume growth will be ahead of pricing growth in FY26 if the overall raw material price ranges remain in the same range. Next, Nestle. Well, Nestle is slightly ahead of what the street was estimating in terms of revenue growth, came at 4.5%. EBITDA came at 3% growth. Margins were a surprise because margins were expected to be lower, but they came at 25.5%, similar to what it was in Q4 FY24 as well. Net profit was down 6%, which was expected to be down around 8%. So a little surprise there. In terms of domestic sales, it was up 4%. Export sales was down by around 8.7%. In terms of management commentary, Q4 saw double-digit growth in both beverages as well as confectionery. Powdered and liquid beverages saw the largest growth and was the largest contributor in FY25 overall. Nescafe has strengthened its position so far. Milk products and nutrition was backed by launches, and pet care business saw high double-digit growth, and this was highest since the integration of this business has taken place. In terms of the comments, business comments coming in from the management, e-commerce has again strengthened its availability. Organized trade saw a strong broad-based growth across category driven by store expansion. Out-of-home continued to accelerate, led by driving penetration across focus channels as well as portfolio. And lastly, export expanded their footprint in Maldives as well as New Guinea, and Maggi noodles introduced new markets in Middle East as well as South Africa. So this is everything that you need to know right now so far that the company has announced for both HUL as well as Nestle results.
Right, Mahima, thank you so much for giving us those updates with regards to these results of two big FMCG giants. And viewers, let's quickly take a look at how HUL as well as Nestle have been reacting to their quarterly results. If we can pull up the HUL chart and see, yes, HUL is down about 3.5%, over 3.5%, and has guided for a better second half as compared to what has already taken place for the company. And let's take a look at Nestle as well. Nestle has recorded an 8% drop in its export sales, and Nestle is down about 1.5% as well. Moving on, viewers, Persistent Systems as well is in focus on the back of their quarterly numbers, and they've come largely in line with estimates, with revenue and profit rising by 6%. My colleague Hiral spoke to Sandeep Kalra, CEO of Persistent Systems, to make sense of these numbers. Let's listen into a slice of that chat.
One stock that is in focus on the back of earnings is a Persistent System. The results have met the street estimates. However, the dollar revenue has seen a sequential growth of around 4.2%. Deal wins have been strong. The con call commentary from the management has also been strong. But let's also welcome in Sandeep Kalra, CEO at Persistent, to understand more. Mr. Kalra, welcome to the show. My first question coming to you is, the street wants to know the kind of growth that you've seen in the fourth quarter. Is that trajectory expected to continue in terms of FY26 as well?
Yeah, good morning, and first of all, thank you for having me. Let me just summarize the quarterly and the yearly thing, and then I can build on it for the future. So as you rightly said, we delivered $375.2 million. On a sequential basis, this is 4.2% quarter on quarter and 20.7% on year basis in growth terms, in dollar terms. Now, if you look at the full year, we achieved 1.409 billion. That gives us 18.8% year-on-year growth. Now, if you look at the last 4 years, our CAGR, compounded annual growth rate, translates to roughly upwards of 24%. If we look at the order book has also been fairly healthy. There are macro headwinds that are there on the horizon, and one only wishes that these tariff-related discussions, the DOGE discussions, and all of these things kind of settled in. And even with the environment being tough, the IT services industry has a good opportunity in terms of helping our customers do the cost optimization part of it. And several of our deals over the last 2-3 quarters also have been cost optimization led. So we are optimistic. We are cautiously watching the macro. But if you look at the order wins, if you look at our growth trajectory, it should bode well for a relative outperformance in the sector going ahead as well.
Mr. Kalra, good morning, and thanks so much for joining in today. It's Puneet this side. I just wanted to, go across the business and just look at the segmental performance as well. While banking, BFSI essentially as a vertical has done decently, I was going to just talk about an emerging segment for you, which is healthcare. Now, for across IT majors, we've seen that for healthcare there has been some conservative commentary in terms of what's happening on the ground. If you could just fill us in for you specifically, how is that vertical looking at right now? Is this an opportunity for someone like you who's building on this vertical over the last few years, and now is the time to hit the nail on the head? Anything that you can give us with client commentary? Has there been some delays? What are you looking at the ground?
Sure. So if you look at the bigger picture for Persistent in healthcare life sciences, for us, this has been, if I look at the full year basis, it has been a 33% plus growth on a year-on-year basis. If we look at the vertical for the last 6 quarters, this has been the vertical that has been kicking in high gear for us. And for the last quarter itself, if you look at it, the quarterly growth was led by BFSI, which was 5.9%. High tech and emerging on a quarter-on-quarter basis was 5.2%, and healthcare was 0.6%. Now, a number of the initiatives that, if you look at the DOGE side of it, the USAID side of it, and so on and so forth, they are basically clamping down on the spend that is there in certain parts of the ecosystem. The government funded payers, the research organizations that do a lot of clinical research, and otherwise the spend in the human health services and so on. So there's a bit of clampdown there that may impact the growth rate for certain quarters. But overall, if I look at the entire ecosystem across scientific instruments, medical devices, pharma, payer and provider, we are reasonably confident over the year it will pan out in terms of good growth for overall the industry and for Persistent within that.
Mr. Kalra, if you can also just comment on, a lot of the upcoming healthcare as well as vertical companies in the US as well as the developed economies, there was a lot of funding essentially from, agencies as well as governments, and we've seen, like some pressure there, at least in the US from Dodge coming in as well right now. What is happening with those kind of companies? Is it, that the spending for them specifically has now been delayed because they are largely funded by the government, and anything that you can fill us in at least in that aspect?
Yeah, sure. So you are on the right track. There is a significant amount of cut down that has happened on the research organizations. So, for example, various universities in the US, they were conducting clinical research not only in the US but even in countries like India that was funded by the government through US aid or other funding programs. That has been clamped down. There is a certain impact of that on the full value chain. So if, for example, these universities or NGOs were conducting, let's say, clinical research, they were consuming the products from scientific instruments and diagnostic companies, they were buying software from enterprise software companies and so on. So it does have a ripple effect, but over a period of time, all of this should settle down. And overall, if you look at the US economy, the healthcare spending is a big part of that. And this is a secular spending. People need healthcare in a good economy or bad. So this sector will settle down with these adjustments, and it should, in a few quarters, come back to reasonable growth for all of us.
Right. Mr. Kalra, then overall, if you have to look at the tariff impact as well, let's take sectors like communication, energy, utilities, manufacturing, logistics, retail, all of this put together, would there be pressure on any of these segments, and in turn, there could be a risk to the kind of targets that you have for FY 26-27?
Sure. So first, a clarification for you and your viewers. The three major segments for us are tech, followed by BFSI, followed by healthcare life sciences. We don't have a big play in manufacturing or in retail or in energy, utilities and so on. Having said that, even within the sectors that we play in, if there is a cost pressure, that's another reason for our customers and prospects to work with us to contain the cost, both by offshoring and by using the platforms that we have built on AI part, which can help do the same work for lesser expense. So we have a software product engineering / application development maintenance platform called SASVA. So overall, even if the cost pressures kind of go much bigger from where we are, that should bode in a reasonable way well for us, helping our customers and prospects optimize for the newer regime that may exist in the newer kind of tariff or other scenarios.
A follow-up with all of this is in terms of the kind of discretionary spends, client spends that you're looking out for. In terms of a conference call, you categorically mentioned that things have been fluid. However, you've not seen any cancellations in terms of orders or deals. There is a slowdown as of now. How would you want to explain that to the viewers and investors? I mean, slowdown in terms of deal wins or slowdown in terms of spends, in terms of execution? How would you want to put that?
So the slowdown is in decision making for the forward looking part.
Okay.
Every company has a business to run. Whether you are in whatever sector, small or big, you're serving your customers, you're trying to become better compared to competition and so on. So you don't stop running your companies. You look at discretionary spend, which is a good to have spend. And we have very clearly said that Persistent is not necessarily, a discretionary spend oriented company. When the going is good, yeah, we do help our customers in their revenue enhancement initiatives. And when the going is not good in terms of the macro being tight, we are right up there in terms of, helping our customers with the cost equation, whether it is doing vendor consolidation, more offshoring, bringing more technology to optimize for processes using AI or otherwise. So we are fairly confident, whether it is a good, upturn in the economy that happens over the next several quarters, or even if it remains soft, we are confident of growth, which will be a relative outperformance to the industry. And as I said, in the last 4 years, if you look at our CAGR, the compounded annual growth rate, it's upwards of 24, more like 25% plus, whereas the industry has grown less than 8% in the same, CAGR parlance. So we are relatively confident. Good or bad macro, we'll adjust. and we'll work closely with our customers to deliver value to them.
Mr. Kala, just one question, on which we've seen in deal wins as well as, your clients which are over 5 million. Now, if I see FY24, and you highlighted this in the presentation as well, your count for more than 5 million clients went from 38 to 40 in FY24 in the 4 quarters. In this year, it's gone from 41 to 55. What has been one of the key changes in this aspect? And I'm sure there has been work going on over the last 5 years on this, but specifically, is this largely in BFSI that the 3 segments that you highlighted in, and what can we expect over the next, at least the next 3 to 4 quarters on the large client deal additions?
Yeah. So if you look at the last several years, and just building on what I said earlier, our compounded annual growth rate has been in range of 25% for the last 4 years. The industry has been growing at less than 8%. What that means is we have been garnering market share from our competitors for the new business that is outsourced or the renewals that are happening. That is clearly reflected. Now tie it up with what you just said. Our count of customers greater than $5 million has increased. Our customers greater than $75 million, we have 4 customers today as compared to an year back where the number was lesser. So overall, we are getting market share, gaining market share against our competition, both from our capability perspective, whether it is GenAI led or otherwise. GenAI revenues are about to pick up. It is also leading to a lot of data modernization projects. So overall, the capability led growth that we have and our customers, based on our quality of delivery, they're giving us more business. All of that is there. Now, we don't give forward-looking guidance, but if you were to extrapolate our last several years' growth and the order book that we have given, it should bode well for us.
Last question, Mr. Kalra, coming from my side is 8 quarters to reach the $2 billion mark is what you're seeing. $5 billion in terms of revenue by 2031. A 250 basis point margin improvement by FY27. To achieve these 3, yes, you will see acquisitions that could come your way as well in the BFSI space. What is the kind of timeline that you're looking at? Number 1, I'm sure you're not going to speak to us about what are the potentials, but the timeline and the size of the acquisition that could be in the offing from a Persistent and any other segments that will drive growth.
Sure. So first of all, let me work the things on the margin side first for you. So if you look at the full year, last year, if I look at FY24, we were at 14.4% range, 14.4 to 14.5. This year, full year, we were at 14.7, but our exit quarter was at 15.6%. That bodes very well for us because that gives us a starting base of 15.6%. So on a full year basis, we are already having a head start on margin improvement. If we keep the operational discipline, if we grow consistently, then margin should give us the uplift that we want directionally towards where we want to build. Second, if you look at where we delivered the Q4, we delivered $375.2 million. You multiply that by 4, it is $1.5 billion. Halfway, we are already there. We have 2 years. Last 4 years, CAGR is 24%. Even if we were to deliver lesser than that, the $2 billion is line of sight, give or take a quarter here or there. That is the second part. Third part, we have never said about any acquisitions. So I don't know where you got the BFSI acquisition, but we have just said our acquisition strategy is threefold. We want to expand in Europe. We may do a reasonable size acquisition in Europe. We want to build on our capabilities, whether it is AI, GenAI, or otherwise in domains in our verticals that we play or sub-verticals. Within the US, that is the second part. And third part, there are horizontal use cases like the contact center acquisition we did with Starfish. So those are our acquisition criteria. We are at any point in time evaluating acquisitions. If there is anything, we'll come to you and to your viewers and announce. So that is where it is. And we are reasonably confident within our organic and inorganic part, the $2 billion is line of sight, and we'll build it up to 5. We have 5+ years to deliver to it. And we are, if you look at our history, track record, we are confident we'll get to there.
And that was Sandeep Kalra's commentary on the performance of Persistent Systems. Let's now take a quick look at the markets. The Sensex and the Nifty snapped a 7-day winning streak to open a bit lower this morning. The Nifty 50 has been trading in a limited range with cuts of about 0.2 to 0.3%, but maintaining to be above 24,000 levels as we speak. The 30-pack Sensex dropped from 80,000 and is now hanging around 79,700 levels, in fact 800. The broader markets appear to be outperforming the benchmark indices. indices, with the Nifty small cap 250 showing some more strength than the Nifty mid cap 150. If you look at the top contributors to the current pressure on the index, you'd see a couple of banking names like ICICI and HDFC dragging the Nifty 50 basket by over 30 points. HUL too is among the big losers as it may be reacting to the subdued quarterly numbers. Bharti Airtel and Reliance too are seen to be adding to the overall drag. On the other hand though, ITC, Infosys, Indusin, Grasim and Ultratech are contributing to the gains. Let's take a look at the sectoral picture, and we see more reds than greens definitely, with realty, FMCG, consumption, rural, finance and auto as the top sectoral losers. In fact, only Pharma, IT and metal seem to be happy and gaining. And since we're entrenched in the results season, there are some significant stocks reacting to their quarterly results. Let's begin with checking how Persistent Systems is doing, since we also interviewed the management. The company reported a 6% increase in its net profit, and the stock is up about 2% in trade today. Let's also see how Nestle is reacting to its 4% dip in net profit. And yeah, again, it's flat now. Let's also look at Tata Consumer, as the company's fourth quarter margins took a beating due to higher tea costs, and that's about 0.86% high in trade. Lastly, let's also get a sense of the market breadth, and the advanced decline ratio currently stands highly skewed in favor of the bulls, with about 1,300 stocks advancing. Now, moving on, Vascon Engineering, Popular Vehicles and Panacea Biotech and NHPC are in our radar on the back of order wins and project development. Let's go across to my colleague Mihika for more details on each of them.
I'll start off with the Vascon Engineers. It's received a letter of intent worth 225 crores, and this is an order from Royal Rights for the construction of 2 terminal buildings in 2 different sites, development sites in Goa. The work is expected to be completed within 36 months. The second stock is a Popular Vehicles and Services. The arm has actually received 4 letter of intents to set up Ather 3S facilities in Maharashtra, and this expansion signifies the company's entry into a new state along with Ather, and this facilities will have warehouse and service centers as well, and operations of the facilities are expected by Q2 of FY26. Then we have Panacea Biotech, which received an additional award from UNICEF worth 44 crores. This award is to supply 40 million doses of bivalent oral polio vaccine, and it's key to know that the company had already received a 127 crore order from UNICEF for the same vaccine supply in December of 2024. So now the total supply of vaccine that the company will be doing will be of 155 million doses to the UNICEF. And lastly, you have NHPC. They've approved the development of a 1,200 megawatt solar park in Uttar Pradesh, and this will be developed by NHPC's JV subsidiary. The estimated cost of the project is around 796 odd crores, and this includes an equity investment of almost 240 crores.
Right. Thank you so much for that, Mehika. Let us now focus on Rallis India. They came out with their earnings report yesterday, and their fourth quarter revenue was marginally down by 1.4%, and the net loss stood at around 32 crore rupees. We will speak to Gyanendra Shukla, MD and CEO of Rallis India, but before that, Varsha is joining us to set it up.
Thank you for that. So, weak set of numbers that the company has seen. Let's see the key highlights why a company has seen these weak numbers. If you see, volume and margin pressure in export market has actually impacted Q4 performance, and the EBITDA loss that the company has seen is led by pricing pressure in the domestic crop care business. Though there was a volume growth in domestic crop care business, but the pressure in pricing has actually impacted this business. The net loss that you're seeing is led by the lower EBITDA that the company has seen. If I were to talk about the numbers, the revenue was down 1.4%, and there was an EBITDA loss of 20 crore, and the net loss, if you see, was at 32 crore versus loss of 21 crore last year. So the key interesting points here to look at in future is how will export market will be recovered, and also the domestic crop care business, where how will be the improvement when it comes to the pricing pressure that the company has seen, and because of that the numbers have been subdued. So these are the 2 key things which which investors have to watch out in future.
Varsha. Now, we've also heard that Pharma major Lupin received an approval to launch a new drug in the US. In fact, the stock is also upward of % today. Could you give us more details on what this drug is and what are the estimated sales from this drug?
launched G-tolvaptan today in the US, which is a generic version of Gynarc. Now, if you see, they've already received the tentative approval for this product in 2023, and for this now the Lupin will get 180 days exclusivity post-launch of this product. Now, Lupin is the exclusive first to file for this product, and the potential FY26 revenue opportunity is estimated at $150 to $200 million. Now, this product will be manufactured at Lupin's Nagpur facility in India, and the tolvaptan, if you see, is used to slow kidney function, and these tablets had an estimated annual sale of almost $1,467 million in US for year ended December 31st, 2024.
Okay, thanks for that, Varsha. And viewers, that's all the time we have on the show, but do stay tuned to NDTV Profit, as there's a lot more lined up for you right on the other side.
That's huge. That is a biggie. It's out of it.
गोल्ड ग्लास क्लियर ग्लास, कार हो या नियर, सब कुछ दिखे क्लियर.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest?
Hello and welcome. You're watching Profit Buzzers. I am Puneet Zaveri, and let's take a very quick look at how the markets are doing. We've seen, some downward pressure on the Nifty as well as, across the mid caps as well. Let's pull up the Nifty first and look at how the index is now faring. Down about 72 odd points. The day's low is almost 24,213, and we are trading in a very narrow range of about 100 points from the day's highs as well of 24,347. Let's look at the top contributors as well to the Nifty and look at what's benefiting it on the upside as well as on the downside. We're seeing some pressure on ICICI Bank today. The banking as well as the IT index was one of the most forefront contributing index yesterday as well as across the stocks that we've seen, both the Nifty as well as on the mid caps. Today seeing some pressure. HUL after the company's results as well as press conference has been a dampener, and we look at it in this particular show as well. While Bharti Airtel also seeing some pressure on the positive side, while not much to talk about, we are seeing IndusInd as well as Ultratech. Let's also look at the sectoral indices as well and see, we might of course see the banking sector under pressure, but Nifty Realty is also the biggest loser today, down 1.4%. FMCG, of course, after Nestle also came out with its earnings today, has been in the downward pressure. While Nestle's earnings were largely, in line, I think the commentary is what's dragging the stock down today. While on the positive side, seen some action across, some pharma names today. We'll be discussing those, Lupin being one of them. Nifty Pharma up almost 1.3%. Let's also look at the mid cap as well as the small cap indices. Seeing if we can, if we can see if it is actually outperforming the benchmarks. Not so much, just absolutely flat in terms of the mid cap 150 with a tinge of red. The small cap as well will likely be similar. Not really. It's up almost 66 points right now. Some solids there. Let's also finally look at the BSE 500, see how the stocks are faring today. And we've seen a bunch of earnings being reported today. And while, something like Sonata Software is up 12%, despite the company coming out with a warning for Q4 that they are expecting a higher decline in terms of revenue of more than 3.5%. We saw the stock tank last week. Seeing some, forward buying today, I think potentially because of persistence system and its results. Divis is also up 6% after the Citi note, and we'll talk about that in the show as well. On the other side, a lot of pressure on stocks like Syngene International, another one which is buzzing on the back of earnings as well for the company, and the guidance being one of the key dampeners. Macrotech also down, but Sterlite Tech is also down 25% in trade, amongst others, seeing some pressure on Amber as well. But let's welcome in Prashant Apse as well, the Senior Vice President Research Analyst at Mehta Equities. Prashant, welcome to the show. Thanks so much for joining, and a very good afternoon to you. How are you seeing currently? Let's start off first with the Nifty Bank, because we've seen very positive buying flows across the last week and this week as well, led by the earnings from ICICI as well as HDFC. Seeing some cuts in trade today. What do you see? What is your view specifically on the banking stocks?
Yes, good afternoon, Puneet. Yes, from last 7 days, there have been a continuous rally in the market, which was led by banking stocks. And now I think there is some kind of profit booking attempt seen in those sector. So I think going forward, again, one should focus more on the PSU set of banks, which will be delivering their results very soon in the coming weeks. Private banks have done well with respect to HDFC Bank as well as ICICI as well as Axis also. I think so. More focus would be on the PSU bank, but there is some kind of profit booking attempt seen in the banking space. But again, IT and pharma, those two sectors again are taking care of the market's volatility right now.
Got the view, Prashant. But let's also look at the FMCG, and let's pull up HUL as well as something like a Nestle. Which has been, HUL seeing a negative downtick post its results, but these two giants have come out with this fourth quarter earnings today in the morning. Let's bring in my colleague Mahima, who was at the venue of the HUL presser. Mahima, tell us more about how the FMCG companies have fared in Q4.
I'll start with HUL first. In terms of HUL, the numbers definitely were in line. Revenue was up 2%. Net profit saw a growth of around 3.6%. In terms of segment-wise growth, home care was up 1.8%. Beauty and personal care was a surpriser where the growth came in at 4.2%. Personal care was up around 3%. Foods still continues to see pressure, down by about 0.3%. The underlying volume growth was at 2%, but the stock actually seeing significant pressure in trade today, and this is on the back of company lowering its margin guidance. The earlier guidance was 23 to 24%, which is now lower to 22 to 23%, and the management has also said that the margins will be on the lower end of the band. Now, in terms of the commentary coming on rural and urban recovery. Rural, they are seeing recovery. Urban continues to see pressure. In terms of Pureit demerger, it has been completed. The growth will gradually be better in first half of FY26 as compared to first half of FY25. In fact, even second half of FY25. Gross margins will further moderate is what the company has said. And overall volume growth will be ahead of pricing growth in FY26 if the overall raw material price ranges remain in the same range. Next, Nestle. Well, Nestle is slightly ahead of what the street was estimating in terms of revenue growth, came at 4.5%. EBITDA came at 3% growth. Margins were a surprise because margins were expected to be lower, but they came at 25.5%, similar to what it was in Q4 FY24 as well. Net profit was down 6%, which was expected to be down around 8%. So a little surprise there. In terms of domestic sales, it was up 4%. Export sales was down by around 8.7%. In terms of management commentary, Q4 saw double-digit growth in both beverages as well as confectionery. Powdered and liquid beverages saw the largest growth and was the largest contributor in FY25 overall. Nescafe has strengthened its position so far. Milk products and nutrition was backed by launches, and pet care business saw high double-digit growth, and this was highest since the integration of this business has taken place. In terms of the comments, business comments coming in from the management, e-commerce has again strengthened its availability. Organized trade saw a strong broad-based growth across category driven by store expansion. Out-of-home continued to accelerate, led by driving penetration across focus channels as well as portfolio. And lastly, export expanded their footprint in Maldives as well as New Guinea, and Maggi noodles introduced new markets in Middle East as well as South Africa. So this is everything that you need to know right now so far that the company has announced for both HUL as well as Nestle results.
Well, Mahima was actually also there at the press meet post the company's Q4 earnings for HUL. And she also asked the management about the company's margin trajectory, growth guidance for various segments going forward as well. Listen into that chunk of the conversation.
Last time the guidance was between 23 to 24% of margin. So right now the guidance is 22 to 23% and on the lower end of that band. Is that correct?
So let me clarify. Last time we had spoken about a guidance of 22 to 23, and we said we'll be the lower end of that range. So more towards 23 is what our last guidance was. Okay. Today, what we're speaking about, that we are lowering that number to a range of 22 to 23 because we believe now is the right time for us to dial up further investment to drive growth.
Okay. And in terms of one more thing, there's a trend that I observed yesterday in one of your peers that came out with the numbers. They said that they've seen more traction in the lower end of products, and of course the small packaging trend has always been there. But something that came out in their commentary was that there was more traction seen in lower end of products as compared to premium products. Is that something that you have also observed?
First of all, we speak from what we see in our own business, and I just restrict my commentary to that. We have seen premiumization, as I mentioned to you, and we must always keep our lens a bit wide. Zoom out first of all, then zoom in. On zooming out, this is a market that premiumizes. In the long term, people are upgrading. They quality of life, they want better products, and I'm not talking of extremely privileged or luxury products, but people climb up to a better quality of product and experience at every level. That trend is secular. We do see that trend continuing this quarter and last quarter, although it's compressed a little bit. So instead of premium going much faster, it's sort of come down a little bit, but it's still faster. So there is a general upgradation trend, although it's muted compared to the past few quarters. We must not make too much of it and stick focused on the long term, because eventually the market has upgraded, we upgrade. We are a very, very low per capita consumption market at this point. Right. So that's number one. On the pack sizing, the large packs still are growing a little bit ahead. There is a trend towards downsizing. People are probably managing their budgets. Of course, as rural is growing now in the last few quarters ahead of urban, and rural consumption generally tends to be on the lower pack size, that also weighted average makes an impact. So there are these twists and turns, but I would not overly focus on them. I think the market in all categories is at a very low per capita consumption, and market development is the main thesis of growth. Innovation, improving quality of our products, getting people to use something more better is the main thesis of growth in this market, and we stick to that in medium and the short.
Right. And any guidance with respect to growth where minimalist is concerned, because beauty and personal care has done very well this quarter. What are the kind of targets that you are looking at right now?
See, we had mentioned as we acquired the business now, we completed the whole transaction 21st of April. We are very focused to unlock both growth synergies and cost synergies. Leveraging the R&D entire process and capability that we have as Hindustan Unilever, we will benefit the business of Minimalist with that. Our supply chain network of production capacities and our expertise in that space will end up giving synergies to Minimalist business. We will also aid international expansion of the business. And last but not least, Minimalist is by and large an online brand, and we'll end up leveraging the offline distribution. So these are the four elements of synergies with which we will now start running the business, and we'll keep you updated in times to come how those synergies are going to look like. But we are very optimistic. It's a fabulous brand, very well positioned in the masstige skincare category, and we do believe now within the family of Hindustan Unilever, it will have a very bright future.
Well, that was the management of HUL. But Prashant, let me come back to you. What is your view specifically on HUL as well as Nestle? Do you see that while the companies have pointed out to some course correction, is this a good time to get into these stocks?
Firstly, the numbers were largely in line with our expectations also. We were not expecting any margin improvement in the stock. We know the costs were really high and there was some kind of commodity prices very high, and which has hit their margins obviously. But again, the commentary from the HUL was a little bit surprise for the market, and hence the price is showing some kind of correction of almost 100 rupees from the day high. But if you see the right level to buy, I think one should wait and watch. Again, 2200 can be a level where I'm expecting some kind of good level to start buying this stock for a long-term investment. But overall, again, a wait and watch strategy should be maintained. We need to watch how Q1 earnings will turn out to be once the consumption story comes into a volume driver for FMCG stocks.
Well, let's stick with the FMCG theme for now, because Tata Consumer's fourth quarter earnings were also announced yesterday, and they were largely in line with what the estimates were. And we also caught up with the management MD and CEO of the company, Mr. Sunil D'Souza, this morning, and he explains why margins were under pressure in this quarter. Listen in.
The street has looked at the numbers. A lot of people, a lot of analysts already saying that the numbers were in line with their expectations. But some of the details that you've already disclosed in terms of the implication of inflation in tea, how much has been passed through in terms of price increases, and what the mix is in terms of the volume. So let me start with that. Seemingly, there's a pickup in demand in the lower end of the spectrum. Do you expect that that's the trend that will continue heading into the new financial year as well? Or do you see a slight change in that as consumption picks up?
So a couple of points on that. I mean, first of all, I think we were quite pleased with the results that we declared. In fact, EBITDA numbers, I think, were better than what we thought we would deliver. And that's because we saw volume growth across. Top line was good, 17% total, 12% organic. We've had volume growth across all our businesses. Even tea was 2% volume growth, salt 5%. International overall for the year was 5% top line. RTD, which was a problem in the beginning of the year, we delivered a 10% top line. The US is back on 4% revenue growth. So overall, I think we're in a decent place. EBITDA was the one place where we were negative 1.1 versus last year for the quarter. But if I add back, if I take out the tea cost and price increases that we've taken, then actually our EBITDA margins have improved by 80 bips. I would have delivered a 16.1 for the year versus the 15.3 of last year. So we would have actually improved versus where we have actually softened this year. And that's primarily because of the tea prices. About 30% of the cost for the full year has been passed on. We're passing on gradually. So for the quarter, it was 50. For the full year, it was 30. And here's the thing on what happens in a typical commodity when prices go up very sharply. normally there is a bit of down trading. And if I dial back 6 months back, or maybe about 4 months back, we did see a bit of down trading happening. The lower end, our mass portfolio growing far faster than the mid to premium. But now, as we come towards end of quarter 4, we've seen growth across all the segments. I do think if there is a normal crop, which I mean right now seemingly looks like for this year, then as supply normalizes, I think we will see a moderation in tea costs, and therefore I would see a sort of benign pricing environment overall for the year. We will take a little bit of calibrated pricing, but not as steep as what we took last year. And therefore, I would see all the 3 tiers, mass premium and premium, all coming to play. So overall, we remain pretty confident about getting both volume and revenue growth. Revenue we've guided for double-digit top line, and margin expansion and EBITDA margins growing ahead of the top line.
Well, but let's also take a brokerage view now on Tata Consumer. Jefferies has actually downgraded the stock to now a hold rating with a target price of 1100 rupees per share. Harsh joins in with more details on this. Harsh.
Yeah, predominantly on the back of numbers, a softer set of margins coming through due to higher tea prices, and therefore seeing a slight bit of tepidness with regard to the way the numbers have panned out. Even though going forward, maybe in a quarter or two, prices are expected to come off, and therefore that should aid margins. But what Jefferies is really saying is the way in which the stock has moved. The stock is up 24% over in the year-to-date period, and 18% in the last 1 month. They believe that this move is taking things a little bit too far, and therefore they are calling this out and saying that the 70 times FY26 price to earnings looks expensive to them, therefore downgrading this to a hold. The structural story though, they are quite positive on in that sense. They just believe that valuations have run away.
Well, thanks for that, Harsh. Prashant, you spoke about HUL as well as Nestle. On Tata Consumers, what is your current view? Because we've seen brokerages either downgrade or maintain their view on the stock. Do you also have a similar view on Tata Consumers?
Yes, structurally I'm very much positive because of the consumption story which will drive Q1 as well as Q2 in this financial year. That is, I'm expecting more positive growth in terms of volume for H1 FY26. But with respect to valuation, again, I agree with the other brokerage houses. Again, the valuations are very expensive at this point of time, which is almost trading at a 60-70 P on the valuation, and price to book value is almost like 5 to 6. So I think in valuation terms, I'm not comfortable to go and buy at this point of time. Any correction would be a good opportunity. Anywhere between 1080 can be a good level to buy for a long-term investors on a dip.
And Prashant, do you see that any other, slightly smaller FMCG company apart from Tata Consumers that you like currently?
No, one should focus more on the large cap only. I think HUL, Nestle and Tata Consumer. I think if you want to choose one, I think I will choose Nestle as a little bit of comfort level, because the management is very aggressive in terms of giving a very comfortable positive growth guidance. But again, HUL has concern with respect to their growth margins in terms of EBITDA. But again, Tata Consumers because of valuation. So in these large caps, I will go with Nestle as a best pick.
Well, UBS has turned slightly bullish on India as it has upgraded it to a neutral from an underweight rating earlier. However, it still prefers China over India. What are some of the key aspects of this particular report? Somit now joins in with more details on this. Somit.
Well, yes, UBS has come out with this big strategy report, not only on India, but also on the Asian markets, and they have upgraded their rating overall on India to neutral from an underweight rating. But the brokerage house continues to say that they continue to remain overweight on China, and they still prefer China over the Indian market. However, what are the reasons why they have turned bullish on India and upgrade the rating? Firstly, they are expecting a consumption-led recovery in FY26 and FY27. They also say that the lower oil prices will aid the GDP growth and help in lower inflation inflation. They also say that India continues to look better placed compared to other Asian peers to weather the US tariff impact and the global growth slowdown that we are expecting. And the valuations now remain reasonable for the Indian markets post the sharp fall that we have seen overall in the markets. Now they prefer financials, consumption, auto, and they are cautious on sectors like industrial, IT and pharma. They are expecting a 8% upside for the Nifty, and their target for the next 1 year for Nifty is at around 26,000. Now they have also given some stock specific names. Now top 6 buys are more focused on domestic market, consumption driven, and are likely to win market shares, have margin expansion potential, and their industry trend is also improving. And the top 6 key buys for UBS are HUL, ICICI Bank, Indigo, Sun Pharma, Trent and TVS Motors. On the flip side, their top sell stocks have the potential for consensus earnings downgrade and are pricing in unrealistic assumptions or earnings growth assumptions as per UBS. And the top key sells are Asian Paints, Bajaj Finance, Cummins India and Jubilant Foodworks.
Well, thanks for that, Samit. Prashant, let me come to you because a very interesting set of stocks there. Any view that you have firstly on key buys, anything on TVS as well as Trent, if I can pick those two, because you spoke about consumption as a basket. Do you have a similar view on Trent as well, and anything on TVS Motors as well, because it's a very expensive stock now, but the only one which is showing decent growth over the next 2 years as well?
I think Trent would be the one pick. One should focus more on the consumption story. I think the way they are expanding, and recently they have opened almost the 1,004th store in India. So I think the expansion is good. I think that would drive a lot of the unorganized market to organized market into sales. And I think the way they are doing it with respect to margin growth and with respect to their sales growth, I think Trend would be the one stock one should focus more on the consumption story. Second stock should be again SBI card also. I think the consumption story will drive a lot of card businesses. I think that is also part of consumption story. So we are very, very much bullish on SBI card as well.
Any view on TVS as well, Prashant, in the two-wheeler space? Do you have any preference?
I think not for TVS Motors. I am a little bit confident on Bajaj Auto. That would be a good driver for me because I would like to go more on the pan-India aggressive sales. Bajaj has that kind of networking. TVS is strong in South India, but I think in the northern part of the India, I think Bajaj Auto plays a very well role with respect to the distribution network. So that would be the better stock for me to go ahead in the two-wheeler space.
Got the view, Prashant, and seen some valuation comfort on something like Bajaj Auto as well. Bajaj Auto, I think, trading at around 22 to 23 times FY26 price to earnings. TVS is at 37 now. But let's focus on the tech sector now. We have two companies, LTI Mindtree as well as Persistent, that came out with its results. Persistent came out with its result today. LTIM came out with its results yesterday. Let's focus first on LTIM. The stock under pressure today, not so much, but largely under pressure because of earnings. Now, the company's reported actually a weak performance in this particular quarter. Revenue was, all the 4 parameters in the income statement missed estimates, and we've seen a weak operating performance. Revenue growth was slowed down due to a delay in the ramp up of deals in this particular quarter, as well as some kind of cautious client spending. Essentially, revenue was up, coming at 9,772 crores versus estimates of about 9,887, with the EBIT margins coming in at 13.8 versus estimates of 14.45%. Now, this was the quarter where it was expected to have some margin expansion, and the key reason being that there was some benefit of operating efficiencies that they were expected to show. But the deal ramp-up slowdown has largely impacted the stock as well. And we've seen verticals such as healthcare fall by almost 14% in this particular quarter in terms of segmental performance. The other ones like banking has grown up by roughly about 1.2%, but largely it's a disappointing numbers. And we've seen brokerages also not be very bullish on the stocks like Goldman Sachs. The other one's Persistent. Now, it came out with its earnings this morning actually, and while revenue results have largely met the estimates as well, I think the company's commentary as well going forward is a big positive. We also spoke to the management as well, and they did affirm that while the healthcare vertical has seen some pressure, which is common across the large cap IT stocks as well as the mid cap ones, Persistent is a small player there, and that could be an opportunity for them going forward. He did acknowledge, though, that the research funding, which is from government agencies as well as multilateral agencies in the US, have now been clamped down. So essentially, those companies will be affected, and that will affect the healthcare verticals for all IT companies. But he is more positive and has maintained his view of a $2 billion revenue mark by FY27. Currently, they are at about a $1.2, $1.3 billion mark. and $5 billion by 2031. So both these stocks in focus. And Prashant, I wanted to talk to you about the IT back as well, because we've seen TCS, Wipro, Infosys, HCL Tech come out with its results. Now it's the other two ones. Any view that you have specifically? Do you feel more comfortable with the large cap IT players, or is it the mid cap ones that you have a preference for?
I think in this current market, considering the tariff and the Western country spending culture, I think one should go for large caps only. I am very much comfortable to have Infosys in my portfolio at this point of time, comfortable with respect to valuation as well as some kind of worst is behind the stock in terms of correction. So I think large cap should be highly focused, mid cap only because of surprises like Persistence, which has delivered a very beaten stock in terms of their results. That has been a very surprising number for us, so its stock is up today. But again, IT as a sector, one should remain still cautious because the larger companies like Accenture and other big worldwide IT companies, they have shown some kind of cautious with respect to their client spending on the IT space. So overall, it will be a cautious approach, but one should go with large cap, and I like Infosys at this point of time.
Well, so Prashant likes Infosys, that's the sector. But, also just want to mention very quickly on Tech Mahindra as well, because the company is expected to report its results today, along with three other IT companies now, Cyient, Mphasis, and as well as L&T Tech. Now, for Persistence, for Tech Mahindra specifically, we're expecting about a percentage point rise in terms of revenue, while margins are expected to rise by 17 basis points to come in at 10.33%, specifically versus 10.16% in the same time last year. Net profit also expected to rise almost 9%, crossing the 1,000 crore mark. And there will be a couple of things that you need to know about the company. They have mentioned that some brokerages are anticipating ongoing cost optimization measures to help margins, but that will largely be offset by headwinds that are seen in the high-tech vertical. Now, in terms of deal wins, Kotak has come out with a note. They've mentioned that they are anticipating roughly $750 million in terms of deal wins compared to 745 in the previous quarter, and roughly 500 million on a year-on-year basis. So they're expecting a sharp year-on-year growth actually, and some commentary to watch out for in terms of FY27 revenue as well as margin guidance as well. Now, apart from that, let me just, Prashant, we spoke about, the IT pack as a whole. Any view that you have specifically on Tech Mahindra and their FY27 growth outlook?
I think yes, very positive on that. Again, with respect to the price action, I think the Q4 earnings and numbers will be at least better than the street estimations, and I think the way how street is expecting with respect to their deal size as well as the margin improvement, I think that will be very positive. With respect to stock specific action, I think a 1500 can be a target on the expectation of a better than street estimation in terms of Q4 earnings. But again, commentary will be highly watched and the guidance will also be highly focused. So anything above 1500 can be a profit booking attempt in Tech Mahindra.
I just want to address, the flashes on the bottom of your screen right now coming from Eternal, which is essentially Zomato. Now, they have come out with a exchange filing saying that there has been no resignation tendered by Rakesh Ranjan. He still continues to be part of the leadership team. And this is a key clarification because from the morning, there has been some speculation that Mr. Rakesh Ranjan, who heads the Zomato team, has, tendered his resignation. He's come out with the company has now come out with an exchange filing specifically mentioning that that's not the case. And it's actually a difficult time for something like a Zomato because we've seen, heightened competition in the quick commerce segment, and that's been putting pressure on margins. And if this were to be, this would have been another key negative for something like a Zomato, which has seen some pressure in terms of stock performance as well as analyst coverage as well. In terms of analysts, they have come out with a conservative, while a growth outlook in terms of revenue, some margin impact is expected in this particular quarter at a time where food delivery business has also started to falter slightly in terms of growth as well. But it's a very key clarification coming in from Eternal saying that there has been no resignation from the CEO, Mr. Rakesh Ranjan as well. We'll be, tracking this space very closely because in Q4, I think it's going to be a very interesting time for Swiggy as well as Zomato in terms of earnings as well as commentary for FY26. But with that, let's just slip into a very short break. Prashant, stay with us. We'll be back on Profit Buzzers with lots more news on the other side. Stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow. And the
इच्छा शक्ति अब आतंक के आकाओं की कमर तोड़ कर रहेगी। Friends, today, from the soil of Bihar, I say to the whole world, India will identify, track, and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished. Every effort will be made to ensure that justice is done. The entire nation is firm in this resolve. Everyone who believes in humanity is with us. I thank the people of various countries and their leaders who have stood with us in these times. साथियों, शांति और सुरक्षा ये तेज विकास की सबसे जरूरी शर्त है। विकसित भारत के लिए विकसित बिहार जरूरी है। बिहार में विकास हो और विकास का लाभ यहां हर वर्ग, हर क्षेत्र तक पहुंचे, ये हम सभी का प्रयास है। पंचायती राज दिवस पर इस कार्यक्रम से जुड़ने के लिए मैं एक बार फिर आप सभी का आभार व्यक्त करता हूं। बहुत बहुत धन्यवाद। मेरे साथ बोल
Well, that was PM Narendra Modi speaking in Bihar specifically, about a few issues that has been, about Bihar as well. But the main talking point currently, and our hearts go to everybody who's been affected because of what's happened in Pahalgam, and the Kashmir terror attacks, specifically trying to be resolute at a time of certain difficulty by Mr. Narendra Modi as well. He has mentioned that there is no place for terrorism in India or anywhere at a time where growth is the primary factor as well. But let's shift our focus back to the markets now. Pharma major Lupin has got an approval to launch a new drug in the US. The stock is up over 1% today, almost, just a little bit down, 14 points up now. Let's get my colleague Varsha to understand more about this. Varsha.
Yes, thank you for that. So, yes, Lupin is going to launch a product called Tolvaptan in US. Now, this is a generic version of one of the products which is used to treat, it is basically used for treating certain kind of cancer. Now, the Tolvaptan Lupin will have actually 180 days of exclusivity post-launch, and Lupin is exclusive first to file for this product. Now, potential FY26 revenue opportunity for the company is estimated at $150 to $200 million. Now, this product will be manufactured in Lupin's Nagpur facility in India, and the Tolvaptan, as I was saying, is used to treat or to slow the kidney function. And Tolvaptan tablets, if you see, has an estimate annual sale of around $1,467 million in US. Now, this is as per the fiscal year ended December 31, 2024. So good uptake when it comes to the revenue prospect that the company will have from this product.
Got the view, Varsha. Thanks for that. But let's also welcome in Vikas Jain, Head of Research at Reliance Securities, now joining us on the show. We also have Prashant as well. Vikas, let me come across to you first on Lupin. What do the charts suggest? Any kind of bullish momentum to look at in the particular stock?
Over the last few days, the pharma sector, it's been bullish momentum. And in fact, Lupin has been the leader of this current up move because the stock has witnessed good amount of bounce back above those 1850, 1900 support area levels. And the stock is witnessing and piercing crossing all its multi-band of averages. So I believe the momentum would continue to remain. Maybe on the higher side, the stock has the potential to test 2250, 2300 levels. And as the tariff announcement is most 90 days delayed from here on, so the momentum board on the pharma space would continue to do well.
Got the view, Vikas. And let's also look at a few key more earnings in the pharma space. Thyrocare, Syngene, as well as Aztec Life Sciences is in focus. Varsha, tell us more about these particular earnings. What was something to watch out for?
Yes, so starting with Thyrocare, a good set of numbers, solid margin beat. Now revenue was up almost 21%, EBITDA was up 71%. Margins were at 31% versus 22% last year. Net profit was up 22%. Now if you see, the pathology and radiology segment grew 23% and 7% year on year respectively, while revenue from franchisees surged by 22% and partnership revenue also saw growth of 24% year on year. The profit growth that you're seeing was driven by improved operating performance and also steady rise in the number of diagnostics tests conducted by the company. Next on the list is Syngene International, wherein though the weak set of numbers, but the more concerning point is the outlook which has been given by the management. Well, the key highlights for the Q4 earnings were they've crossed 1,000 crores of revenue in quarter threshold for the first time, and the revenue growth that is of 11% is driven by biologics, CDMO and commercial projects, and the high pilot project conversion has actually boosted their research division growth. And the EBITDA margin, if you see, has been declined 80 basis points due to lower gross margin, of course higher employee cost, and the net profit impact that you are seeing is due to higher tax outgo that the company has seen. Now what to expect in FY26? Now this is actually very interesting or very crucial point due to which the stock is down. FY26 guidance has been significantly below expectation. Company is going to report revenue growth likely in mid single digits, and the adjustment will be due to client inventory balancing. A midterm outlook when it comes to CDMO business is positive, but the new biologic facilities will increase operating costs and depreciation for the company. And that's the reason, if you see, this will moderate EBITDA margin to mid-20s. The current EBITDA margin for the company is around 29%, but because of this, the margin will be under pressure. And of course, the year-on-year, there will be a year-on-year decline in profit after tax, which has been anticipated and which has been clearly highlighted by the management. Last on the list is Aztec Life Sciences, wherein if you see sequentially good growth, but year-on-year, the growth is under pressure. Volumes in enterprises business grew 2x year on year. Profit impact that you're seeing is due to sharp decline in prices, and there was a significant drop in CDMO volumes, and that's the reason you're seeing revenue is down 22% and margin at 4.6% versus 8.3% last year, and there was a net loss of 16 crore versus net loss of 1 crore last year.
Thanks for that, Varsha. But Prashant, let me come across to you, and if you can pull up all the three stocks on the screen. We've seen, a very positive move on Thyrocare in terms of quarter 4 performance. Syngene down almost 13%. Any view do you have on both these stocks?
I think yes, Thyrocare has surprised the street recently after the correction from 1,000 rupees towards 680, 700 rupees. I think these numbers were not expected by the street, and that has really surprised. And that reaction we are seeing in the screen today. But overall, I think margins should sustain. We need to even wait and watch for Q4 earnings, where the margins will see some kind of similar. Then only the stock looks good towards its new high, like almost like 1,000 rupees plus. But time being, I am waiting and watching the stock for Q4 earnings. That will be only one thing one should focus more on. With respect to the Syngene International, obviously, yes, the reasons are already pointed out. But again, the commentary was little bit concerning to the investors with respect to pressure in the margin, as well as the growth outlook going forward would be very much muted or negative. So those two data points has helped the stock to come down to less than 10%.
But let's also got the view, Prashant. Actually, very interesting because stock Thyrocare had seen a lot of correction, and definitely these numbers have surprised the street. But Varsha is still with us, focused on Rallis India now. Came out with his earnings report yesterday. Fourth quarter revenue was marginally down by about a percentage, and net loss also was there. But Varsha, talk to us about what was the key aspects of these particular results and something to focus on.
Yes, so actually weak set of numbers that the company has seen, let's see what are the key reasons or key highlights. If you see, there was a volume and margin pressure in export market which actually impacted Q4 numbers for the company. EBITDA loss that you're seeing is led by pricing pressure in domestic crop care business. Though there was a volume growth in domestic crop care business, but the pricing pressure that the crop care business has seen has actually impacted the performance in Q4, and the net loss that you are seeing is led by lower EBITDA, and that's the reason. If you see, revenue was down 1.4%. There was an EBITDA loss of 20 crore versus loss of 6 crore last year, and there was a net loss of rupees 32 crore versus loss of 21 crore last year. But we will actually speak to Gyanendra Shukla, who's an MD and CEO of Rallis India, who have actually given us a view when it comes to growth prospects of the company and what has been the disappointment when it comes to Q4.
So look at our business. I think export is about 25% of our total business. Our majority of the business is domestic, and I think that's where our large focus is. Doesn't mean export is less important. So within domestic business, we have three segments which actually are doing very well. So seed is one business we have been nurturing for 15 years, has become a positive contributor to the company, has grown significantly. There is another soil and plant nutrition business which we have been nurturing for over a period of time. That has started contributing significantly. And our domestic crop care business also has done very well. We have also identified some of the portfolio gap we had, particularly when it comes to third and fourth quarter, mostly in the herbicide category. So we're filling all those portfolio gaps. So what I can say is 75% of the business, actually there's a proper plan in place, a strategy in place, which is combination of digitally driving the business, improving customer experience, as well as bringing new product. Now export is something we are actually having 4 key products, and many of them are also caught into, earlier they were caught into global excess supply. As a result, prices were very low, and now there's a new thing on the horizon which is related to traffic. So we're still evaluating. But when I look at the export future, I think what is happening in the business is going to be long-term positive.
That was the management of Rallis India, seeing some pressure definitely in trade today as well. But Vikas, on Rallis India, stocks seen some correction. Do the charts suggest getting into it or staying away from the stock?
Well, getting into it in the sense, no doubt, the numbers were being pretty weak. The stock has declined by 4%. But again, 230 to 40 is a multi-year, multi-month lows. So even if you draw back and slow down near to 3 or 4 year charts, 235 to 40 is a strong support area. So it is near to the support area. So maybe price-wise, it is a good entry point, but it will take some time to recoup the losses what it has achieved today. So 230 to 40 good entry point. On the high side, crossover of 265 to 70 will give us a sustained amount of profit.
Got the view, Vikas. Prashant, would you have a similar view on something something like Rallis? Because these agrochemical stocks, as well as fertilizer stocks, while they have been under pressure and valuations are in favor, any kind of view that you have on these?
I think yes, I'm very much positive. See, if you see every March quarter, there has been dip in the EBITDA margins. So that trend has been continued. If you see 2023 March, there was an operating margin loss of 12%. If you see again March 2024, there was an operating margin loss of 1%, and even now the 5% loss in the EBITDA margin. So I think every March there is some kind of pressure in terms of booking everything in the same financial year. So that will be continuing. So any dip, as Vikas said, I think it will be a great opportunity for any investors to add this stock for at least for 1 year plus from the current levels.
Got the view, Prashant. Another stock that's in focus is Spandana Spurti. Now, this is after the companies announced the resignation of Chief Executive Officer Mr. Shalabh Saxena and has appointed the Chief Financial Officer, Mr. Ashish Kumar Dawani, as the interim CEO. Harsh joins us with more perspective on this stock and how this could change, how this change in power essentially could impact the company. Harsh.
That's a big move, actually, and they had an analyst call last evening as well, where they reiterated that this is on the basis of certain personal preferences due to which Shalabh Saxena will be moving on. It's a significant development because we've seen headwinds in microfinance in the portfolio as a whole across lenders, but Spandana in specific also has faced its set of concerns with regard to microfinance. Recovery is expected in a quarter or two, with a leadership change plus a recovery at play that somewhere in some form delays things. So that's probably one larger overhang which is getting created now. The other piece is also with regard to how analysts are viewing this. So what analysts are saying is that Shalabh was instrumental in stabilizing the franchise post the exit of erstwhile promoter Padmaja Reddy, and Shalabh's exit might well lead to senior level team members also leaving. They're also saying that Shalabh's exit would make the bounce back journey for the MFI NBFC more difficult, and therefore some bit of skepticism around this.
Prashant, let me come to you on this because, fundamentally we've seen a lot of pressure on the microfinance stocks in the NBFC space as well as the MFI space as well. On Spandana specifically, if you have a view first and any preference within the mid-size as well as the small finance banks that you have currently?
Yes, but I have been continuously been negative on the microfinance companies from last 2 years. The trouble in the growth margins with respect to credit growth and all, I think that will continue. So the new promoter or new management which will be taking place in Spandana Spurti, I think that will have some kind of positive impact, but we have to wait and watch and then think how things will change going forward. But in this space again, if you were to have one stock which would be good, would be again Ujjwal Finance can be one stock which can be a clear positive view for at least for short term to long term. But Spandana, I am not tracking the stock on a fundamental basis. But again, with respect to industry pressure, I am still negative on the sector.
Got that view, Prashant, but very important updates coming at the bottom of your screen again in terms of a circular which has come out from NSE revising eligibility criteria for migration from the NSE SME portfolio as to the NSE main board platform. Now, essentially, we've seen a lot of stocks that have come under pressure because of this, and we've seen continuous moves by the NSE as well as SEBI essentially in limiting the volatility that is seen in the stocks of the SME portfolio as well. Now, there has been some new updates coming in that new eligibility criteria will be there applicable from 1st of May, and we'll of course get you a lot more details on what these eligibility criteria are. But essentially, it's a positive move for all of these companies that will be eventually moved to the NSE main board platform. And one of the key reasons will, of course, addressing volatility, but also, ensuring that, investors' interest is at the main focus for both SEBI as well as NSE. Now, this circular has been one of the key, which has been, a key operation. Now, revenue from operation should be over 100 crores. Now, that was one of the key flashes, and if we can put it on the main screen as well, because that is one of the key criteria going forward now, because, the NSE, they have mentioned that SME platform of the exchange should be at least for 3 years, and that is one of the key ones in terms of, approval ratings that is coming in now. And there you go, should have been listed on the SME platform of the exchange for at least 3 years. I think there was also something that I read on the revenue criteria as well of 100 crores. Paid up equity share capital could also be not less than 10 crores as well. So definitely a key positive. But one more stock that's actually been in focus essentially is Gensol Engineering, and not for any good reason. We've seen, there has been multiple news reports on, the funding as well as, fraud essentially that the promoters have taken at this point of time. ICII has now decided to probe both this Gensol as well as, the Blue Smart fiasco. Let's get in my colleague Agni first to tell us a little bit more about this. Agni.
So the Institute of Chartered Accountants of India has set up a financial review board to look into the whole Gensol Blue Smart fiasco. Now the ICAI has taken suo motu cognizance of the whole thing that is going on, and now they are going to set up a panel of 7 to 8 members to look into the financials of both Gensol and Blue Smart from as early as financial year 2023. Now the review board will be headed by Vishal Doshi of KC Mehta and Company, and the case might be referred to ICAI's disciplinary committee for potential action against the auditors if anything is found amiss. Now to put some context to this, Gensol's statutory auditor for the period under consideration was Ahmedabad-based KC Parekh and Associate. Now in September they had approved a shift to Mumbai-based Suresh Surana and Associates as their auditors, and even their internal auditors who were responsible for evaluating the financial statements of the company was Talati and LLP. So these are the companies which might come under the ICAI scanner, and potential action can be taken ahead beyond this, because remember, ICAI directly comes under the Ministry of Corporate Affairs.
Well, thanks for that, Agni. But Vikas, let me come to you. Not on Gensol, but I wanted to just talk about gold a bit, because it's crossed the $3,500 per ounce mark. Any view that you actually have on gold as a chart? Do you think that we might see some pullback from this level, Vikas?
Look at the volatility has been pretty high over the last 10 trading sessions, where you saw us move near to 3150, 3170 levels, and then it declined by almost 5-7% near to 3,000. So from 3,000 to 3,500 was pretty swift. So now it seems that the 1 lakh number which was been there in the domestic market has been achieved through, which is a round number. So it resisted there. So some amount of volatility would be there. But with the way the bond yields and the gold prices have declined over the last 2-3 days, we believe the top has been made on an intermediate basis, unless until some major news flow comes in through. On the downside, we believe 3150, 3170, which was the previous top, now would act as a strong support area.
And Prashant, do you have a similar view on gold? Because we've seen a lot of up moves specifically on that, and that's benefited the gold financing as the gold stocks as well, like Titan and all. Anything that you have on gold right now? Do you see that this is a good time to just book some profits?
Yes, obviously, yes, one should try to book some profits at this point of time. But again, long-term trend will be intact on a positive side. But again, this year, there may not be some kind of 25% kind of return, which it has done last year. But it may be like 10-12% can be on the risk of geopolitical tension. So I think going forward, post 90 days of this tariff war, I think geopolitical tensions will remain very much flat. So gold will see some kind of very flat or profit booking sessions in the second half of the financial year. So overall, booking profit should be the strategy. And with respect to stocks, again, I don't recommend any stocks to which are dealing with the gold. I think because of the high volatility, a lot of stocks or a lot of companies like Kalyan Jewelers or anything, they will be booking a lot of inventory losses. So there will be some kind of pressure in the stocks as well. So I will not recommend any gold related stocks at this point of time.
Got the view, Prashant. So Prashant, Vikas, both, thank you so much for joining in and give us the views across a whole host of stocks. We'll leave it at that with you. Thanks so much for joining in though. But now for a latest on the Kashmir terror strike, we've seen Prime Minister Narendra Modi has promised the nation unimaginable action to avenge the killing of 26 tourists in Pahalgam in Kashmir. Now he has issued a stern warning to terrorists at his first public rally in Bihar post the terror attack. Meanwhile, in Kashmir, search operations are underway to find the perpetrators. The police has announced a reward of 20 lakh rupees for information leading to the arrest of Pakistan nationals and LET terrorists Adil Hussain Thogar, Ali Bhai and Hashim Musa. NDTV's Shiv Arur is on the ground in Kashmir and he gets us the latest on this.
An endless lineup of empty houseboats, no customers, no tourists, because they've all completely left Srinagar. They've left Kashmir, and who can really blame them? Ashwini Mehra and I arrived here in Srinagar, the capital of Jammu and Kashmir, on a virtually empty aircraft, and that's become completely a norm right now. When we arrived here at the Dal Lake a little earlier, scores of tourists who'd come here just to get a last glimpse of the lake. Many of them are actually leaving now. But what you see here on the lake itself, perhaps the most iconic symbol of Srinagar itself, is this. All of these houseboats had people in them yesterday and the day before. All of these houseboats had customers who were bringing in money for Kashmir's fragile economy. The Dal Lake itself is a nerve center for what Kashmir has really been all about, as it has opened up after the abrogation of Article 370. And now this becomes that representative image. Not a houseboat, not a shikara with smiling faces from different parts of the country, but completely empty and forlorn and just sitting there on the lake.
Well, that's all the time that we have on this edition of Profit Buzzers. Stay tuned to NDTV Profit for more.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The second buy pick is in Naukri Info Edge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.
Hello and welcome to Gold Rush, our special coverage on gold, the yellow metal that has soared to an unprecedented $3,500 per troy ounce, boasting a remarkable surge of over 30% in 2025 alone. This meteoric rise isn't happening in a vacuum. Volatility in equity markets and an escalating tariff war are shaking up global trade, pushing investors towards this timeless safe haven asset amidst lingering economic uncertainty. Gold's allure remains stronger than ever, captivating both seasoned traders and cautious newcomers. So as gold sits at this dazzling peak, the obvious question is what's next for investors and can this upward momentum sustain? Should you continue buying gold or buy even now? To speak on this, we're joined today by Suvankar Sen, MD and CEO of Senco Gold, Tejas Shigurekar, Senior Tech Analyst, Commodity and Currency at Angel One, as well as Naresh Kataria, Private Investor. Suvankar, thank you for your time this morning. Let me actually start with your take. You know, logic would dictate as gold prices are rising, people would be more and more hesitant to come to the store and buy jewelry. Is that what you're saying?
So see, what we have been looking in the last 2 weeks, Akshaya Tritiya is next week. So that is one of the auspicious seasons that we always have, and consumers are keen to buy something. But because of the higher gold prices, consumers are coming, but the ticket sizes, or rather the quantity of gold, is something that is getting impacted. So value terms, if we really look at it, everything will look very positive, and there will be a lot of growth because gold itself from a year-on-year basis by more than 30%. But if we look at the volumes, I think consumers are still digesting these high prices and they are coming, but within their budgets. So that is one aspect of it. And the second one is that the old gold exchange of it. So those who have weddings in the family, or there are consumers who are wanting to make the best out of these higher gold prices, are bringing their old jewelry into the stores and exchanging it for the new ones, which is a little slightly higher in terms of the quantity. So if they bring in 10 grams, they will buy something worth 12 grams. So this is another phenomenon that we are seeing at the stores in such prices.
Right. So, Ankar, a follow-up on this one. When you're saying that, yes, they're coming to buy in terms of their budgets, does that mean there will be an impact in terms of volumes if you have to look at this quarter? Because one, you are talking about Akshaya Tritiya. Two, there is shopping happening right now ahead of the wedding season that will come in yet again. So how is the impact that you're going to see in terms of volumes and in turn in terms of the financials?
So in terms of value, what we are seeing, it's almost, I would say, we're close to the month of April. We will see a value growth. But in the last 15-20 days, because of the price high rise, we are seeing an impact of 15 to 20% in terms of volume. So yes, volumes will take a hit. And what we are hoping and expecting is that if the gold prices corrects a little bit, that will give some energy and boost to the consumers now that they have seen the higher prices, and if it comes down and corrects a little bit, that will again automatically give a boost to the consumers. And the wedding season continues to remain. We have May and June as a peak wedding season before the non-wedding season starts in the Q2. So looking forward that if there is any correction, and the gold prices have corrected from the highs, it had gone up to $3,450, close to 3,500, and today it is at around $3,320. So I think that correction will be helpful, and if consumers sees that the prices are stabilizing in such levels, they will start coming back to buy for the Akshay Tritiya.
I want to understand from your perspective also as a jeweler, which scenario is more profitable in a scenario where the prices have gone up as much as they have? I'm assuming that you will have a certain amount of gold inventory that you held for a period of time. You're probably not keeping low inventory, right? So from that perspective, if you're utilizing your existing inventory, is that better? Or is it when a customer comes to your store and says, I have this much gold, exchange it for me and make another set of jewelry? Which is better operationally for you?
So operationally, we are always happy if the gold prices are stable. A little bit of increase of the gold prices year on year is good, because that gives confidence to the consumers that this is a great asset, and no matter what, in crisis times, it can move a little up and down a little more, but year on year, it is moving in the marginal levels, and that's the best thing to happen, because as a jeweler, we are making money out of the making charges and not out of the increasing gold price. These are kind of windfall gains or losses. And, depending on the jeweler to jeweler, inventories are hedged. Someone is hedging 100%, someone is hedging 80%, someone is hedging 60%. So therefore, based on the hedging mechanism, those who are hedged less, they will tend to get a little higher in terms of the capital gains of the increase in gold price. Those who are a little hedged more, they will get a little lower kind of a profitability because of the in movement of gold price. So personally, I think it is always good to have a more the footfalls, more the cash flows. Everything looks very stable, because for us to plan for the future is also very important, right? So if the prices are too volatile, sometimes your planning goes for a toss, and you need to always be on your toes trying to figure out that, yes, the right kind of inventory and the right amount is there always at the store. Plus the fact that with this increase in gold prices, we're continuously innovating that we need to give lighter gold weight jewelry. So what used to be 25, 30 grams today has to come within 20 grams. So 15, 20 grams. Wedding jewelries have to be lighter. That is one more thing. Another good part, just, out of all these challenges, is that the diamond jewelry sales have also picked up, because that is made in 14 karat and 18 karat jewelry, studded with diamonds. So I think consumers for their personal consumption are now seeing that, yes, now that the gold prices have gone up so much within their budgets, they can now buy diamond jewelry or platinum. So that is another good part that might add to the profitability for the company.
So there are various perspectives to what is happening with the gold rush. One is, of course, from the gold jewelry perspective, which Mr. Sen has given us very well. Naresh Kataria also joins in on our conversation. And let me get your perspective as well, Naresh. You've been speaking with us here on NDTV Profit on how bullish you are on gold prices. Now the question is, and there's a raging debate right now, that have we reached the top? Are those who looked at $4,000, $6,000, being overtly optimistic, or will you see a cool off the moment things settle like they have in the last couple of days?
Yeah, my view is that one, it has run up too fast in the near term. So gold is now short term stretched. It is 25% above its trend of 200-day moving average. But the key aspect I'll consider is whether it's a bull market like the 2000s or the 1970s. I think that's the key difference I would want to analyze. Because the 70s bull market was driven by central banks, and the 2000s bull market was driven by retail and HNIs. And this time, I think the central banks have taken the lead. Gold bull market was much stronger in 1970s. Of course, it did have a lot of corrections. So there was a correction in 2006 of 20%, 30% in 2008, and even a 40% correction in 1974-75. So maybe a breather is due, but the factors, which is the central banks trying to de-risk from the geopolitical risk of their central bank reserves, I think that's very much on.
Okay, so the de-risking factor is gone. Does it mean that the rally is stalled for now? This is why we wanted Tejas on the show today, to get a technical perspective on it. And Tejas, I'm going to ask you about silver also in a bit, but right now just gold On the charts, how high is high? Are we going to see a higher price point?
Yes, good morning, everyone. See, as the on the technical part, whenever we see the 1 lakh amount on the screen, the people are just keep cautious when they are expecting to trade into this area. As we see now, always the silver also it's have the edge to cross the 1 lakh point. So whenever it's reach up to that level, it's getting sustained and volatility is comes, and again on a month-on-month basis is not able to be crossed sustainably above the 1 lakh point. So when we see the gold also reaching up to that, which is a very cautious point when people are looking towards invest into the gold, they are just worried about how they can invest in a physical market. So always see the international cues where exactly is coming through and how exactly is impacting to the overall economic numbers. So definitely the Fed is took the some other intention of to keep easing on this on those points, and finally it will help the stability for the full employment also, as well as the dollar it impacting on this higher level and keep rushing out the higher points. And again, when we see the on the technical part, there is a DMA 100 DMA it's at 98, which took exactly the support, and yesterday it had the bounce back from that level. And the broadly the gold not able to be sustained on the higher level about the 3500 and took the barrier on the higher side, and then again it's pressurized from the higher level, and right now is reaching up to the 3200. So almost there is the support area when we see the on the technical immediate support at $30 to $20, and the targeting from the 9 DMA, and again immediate support around of $31.45.
Okay. I also want to talk about the relationship between gold and silver, and it's described, gentlemen, you will all know about this, but it's described as a gold-silver ratio. And what you look at is that 1 unit of gold is equivalent to a certain number, or 1 price of gold is equivalent to a certain value of silver. So if it used to be 70 back in the day, but as things stand right now, it's actually above 100. So if gold is at $1, you're talking about silver, or rather, sorry, explain this. If gold is at 100, silver is at 1. So that's how it works, right? Right now, it used to be 70, which means that the gap between gold and silver has widened quite considerably. In this market, Naresh, would you suggest that you should book some profits in gold and move to silver?
So how I see it is that gold is a pure monetary metal. Silver is a monetary and an industrial metal. So gold-silver ratio used to be 16 50 years back, 100 years back. It used to be 1:16. Even the peak in 1980 was at 1:16 ratio. Gold peaked at 800, silver peaked at $50 in 1980. It's below that even now. More importantly, the current bull market is driven by central bank buying. And I don't see any central bank buying gold. El Salvador and one more country has announced buying Bitcoin a little, but I don't see any apologies, no central bank buying silver. So all are into gold, and central banks are pushing gold. So I think gold is showing signs of geopolitical stress, de-risking, which central banks want to do. And of course, retail also now latching on to gold. Silver only has retail going for it. I don't see other triggers. So I'm not sure, I don't analyze silver that closely, but I think the triggers which are there for gold, I don't see them for silver.
So, Naresh, I have a follow-up on this one. I mean, Alex was talking about gold and silver. Let's look at the Sensex to gold ratio then. You know, I mean, usually, if you see currently as well, we are in that bracket of around 0.86, and the long-term average has been around 0.96, if I'm not mistaken. Does this mean that gold is then overvalued as compared to equities? And if so, your equities are still the best bet at this current point in time, taking the overvaluation of gold into consideration?
So that's a good point. People miss the relation between gold and Indian markets. At a more broader level, gold going up, I think, is good for India and Indian markets, is how the relation has been. We don't have data for 70s. Actually, in 70s, gold went up 16, 17x in US, but US market struggled. But the last major bull market, which is 2001 to 2011, Indian markets did very well in that period. because India has a big stock of gold. Indians have a big stock of gold, almost equal to our GDP. So gold going up does give a positive wealth effect tailwind to the Indian consumer or the Indian savings bucket. So I think gold going up, I would say, is rather beneficial for markets. And the data I've checked is whenever gold goes up 25%, and if you had invested in markets, small caps give not better than average returns when gold is up. So rather than competing gold versus markets, I'll say gold going up is a positive tailwind for Indian markets.
At the end of the day, and we have Naresh, Tejas, and of course Mr. Sen also with us. At the end of the day, people watching right now are looking at all of the conversations about how those who invested in gold or did SIPs in gold or did gold ETFs turn out to be smarter than equity investors. Does that situation still exist? I'm going to come to Naresh Kataria first on that question. Maybe it's not a straight up gold or equity, but is this still a good time to start or continue your investments in gold?
So I'll first again step back and I'll refer to analysts who are saying now gold and Indian markets do equally well over long term. And I think these analysts or investment advisors are opportunists, because gold doesn't do very well long term always. If you check 90s, gold was down 30%, the decades of 91 to 2001, gold was down 30% and markets did very well. It was up 5x. Even 2011 to 21, gold was flat, $1,700 to $1,700 for 10 years, but markets were up 3x, since Nifty was up 5,000 to 17,000. So, of course, gold has its own tailwinds, own factors which work for gold. And right now, it is the central banks trying to de-risk their reserve assets. And of course, I also believe, I spoke on the channel last time, that there may be a short position in terms of leasing, which happens in London and New York, and that will have to be covered eventually. So the example is a gold metal loan which Indian jewelers take. The source of that gold is usually deposited custodial gold lying in one of the depositories in London and New York. So the tailwinds for gold have to be analyzed, and I think this looks like a structural move for gold. Of course, it can correct. As I mentioned, even in the 2001 to 2011 bull market, gold corrected 20% in 2006 and 30% in 2008. So we better be prepared for volatility, which is how any markets behave. But we need to analyze for the long-term trends, and I believe the trends are very much in place to push gold higher.
So should you buy or not, Naresh?
I think it's a simplistic question. I can't give you a very direct answer, but I think there is some sense to have gold in one's portfolio. I'll just again give you a still broader picture. The current setup, which is Brent down, interest rates down, and gold up, that's a very, very sweet spot for India, because Brent down brings down our forex commitments and interest rates. Interest rates themselves are down. Gold going up gives a wealth effect. This combination is not available for too many countries, and gold itself has a far larger role to play for India. So again, I would not say equities or gold. Gold has a role to play, but it is stretched. It is 25% above 200 DMA, which is where corrections usually happen. So if I was not allocated to gold, I'll wait for a slightly better entry point to allocate gold. But if what allocation I have or any investor has, I think we should just ride the bull run.
Hold, but don't buy. Naresh, we're all about the simplistic questions here. And we hope to give our viewers simple answers, because that's what people want to know at the end of the day. That's what we're all here for. Tejas, I'm going to ask you that same question, and then I'll come to Suvankar as well. Buy gold right now, even at these levels? Yes, no, maybe?
On the technical part, there is a correction expected. As I mentioned earlier, also it's a psychological level, 1 lakh point. So people are very cautious about how to invest, where to invest. And when we talk about it's a physical market, definitely there is a demand. But on the how exactly the tariff going on in the international market, how they're taking the step, the essential, I said, they are allowing from the China. And again, they're taking another step to just easing out, again, looking forward the interest rate cut. the full employment also to be not should be harmful. So these mandatory assets had to be looked forward, and it will impact the dollar index. Again, we are if taking the support at the 10 EM at 98 dollar in a dollar index, it will take the bounce back, and it will reach up to the 102 to 104. So it will impact to the overall gold prices, and we'll see the deeper connection around of 5 to 10% from the here on. So we're expecting the buy on dip, it will be the better solution.
Buy on dip. How do you look at this, Suvankar? I mean, you can't give advice on whether you should buy gold or not, and probably your advice will always be yes, please buy gold because that's what I sell. But in terms of prices going, you said Akshay Tritiya, if people are, shoring up for a big occasion in their family or even for investments, how would you look at the investment perspective?
So, I'll talk from my personal level that, when gold prices were at 75, 80,000, we thought that, the prices are quite high, and we couldn't imagine that while we can all talk of prices will go to 1 lakh rupees, but we never imagined that it will go so fast. But then, it has gone and it is going, right? So I would suggest that as an investor, you have to get into the market to, like meet SIPs or in a very a kind of a staggered manner, keep buying. We will never be able to catch the lows, and we'll never know which the highs are. So you start buying little. If there is a correction, you should buy again, and that's how I think we also are doing our best to ensure that at every level you are buying gold. It should be a part of your portfolio, and that's the way to look at it. And silver is another very good commodity along with gold to buy, and I think that is another thing that investors should surely look into along with.
Naresh, what you were talking about allocation, a lot of the advisors that speak to us talk about a 15% allocation towards gold. And of course, there's no one-size-fits-all solution. You're talking about allocation towards equity, towards fixed income in a good portfolio. And if at all you don't have that 15% allocation, I think the point that you were making is very good. In that don't see this red-hot rally and think, oh, I'm missing out, so I should go and buy right now. I'm just wondering how you buy the gold that you own. Is it primarily through ETFs? And in your opinion, is that the best way to invest in gold?
So one is, before I come to how I buy, again, these allocations, people are talking 10, 15. I'll just caution you and everybody else. Most of them have latched on because gold has done well. I don't think they are coming to gold because gold will do well, because no one really has an idea, frankly. The factors moving gold are far more complex, but people, that's how investors behave, analysts behave, or the advisors behave. They latch on to an asset which does well. So I don't know whether it's 10 or 15% is right at this stage. On how I buy, till some years back, we had far more options. We had SGBs which were extremely attractive. They are no longer there. We just have to hold on to what SGBs we have. There was one more very good proxy to ride gold, which was gold finance companies, because they do well when gold, they used to do well when gold goes up, because their NPAs come down and they have also better business and operating leverage. But RBI has tightened a lot of rules on NBFCs which give you gold loans. So primarily it is SGBs, it is gold Bs or the other ETFs. But I also have a slightly more outlandish take on this. I think if the challenges geopolitically and a scramble for physical metal plays out as I fear, then I think even some physical gold may actually be prudent to have.
So Naresh, clear question. Would you buy gold or silver or any of the precious metals, or would you advise buying a jewelry company?
So I have a problem with jewelry companies in the sense, of course, India's gold imports are kind of flattish for the last several years, and I think the price will go up, so obviously their sales will go up. But most jewelry companies are hedged, and I have a problem with that setup, in the sense, as the price goes up, they pay a mark-to-market losses on the hedges they have, either as a gold metal loan, or if some of them have even hedged on MCX. Of course, they'll realize those gains when they sell the gold to customers. But I don't think are direct beneficiaries of gold prices when gold goes up. And as I told, I have actually a big inhibition of, if there is a melt up in gold, it would create big issues for cash flow management for dwellers who have entire inventory hedged.
Naresh, thanks for that one. So, in fact, let me go to Senco on this one. How are you looking at this, Suvankar? What would your opinion be on what Naresh is saying? Because inventory management becomes crucial, hedging policy becomes crucial over here, and in turn, your cash flows.
See, hedging, as I said, that, some people are 100% hedged, some are 80, some are 60. And the cash flow, management is the most critical aspect to manage in such bull runs and when the prices move up. But as a listed company, which is dealing with gold, quarter on quarter, if there are any volatile movements and the prices come down, then it will unnecessarily impact the balance sheet. So I think that yes, in the long run, the bull run is there, but it is a wise thing because ultimately, as a jewelry company, we are going to make money out of the making charges that keeps going up with the increase in gold or silver prices, and not so much on the gold value that goes up. So yes, Naresh ji is right from that perspective, but risk mitigation and risk management in a downward market is also very, very important, and we do a balanced hedging for the same. But yes, the point is that much like the gold loan companies, jewelry companies, or those who are dealing with gold, rather than buying the physical commodity, those who are utilizing the gold for businesses, I think that is a good way to look at investing in gold as well.
Give us some more color on buyer behavior at this juncture. I know we began with that question, but I'm wondering about whether or not people are going out and buying bullion. What percentage of sales currently accounts for that?
So there are investors in the market. People who are not keen to buy gold maybe 3 years back is now more excited to buy gold and bullion. So for us, the bullion percentage is around 5%. Jewelry still continues to remain a major part of your sales. And as I said, that weddings is one aspect of it where people have to buy no matter what the prices are. And from a personal savings point of view, people are moving towards lighter weight jewelry, sleeker weight jewelry, because that is something that they can buy within their budgets. But, for us, if it is 5%, for someone else or bullion dealers, that could be a higher percentage of 10, 15%. But there are people and buyers keen to buy the commodity, and there is this fear of missing out amongst a lot of investors that we can see.
Right. So, I mean, everything that glitters, whether that is gold or not, is what everyone has to really guess from here on, because with the rates that are rising, I mean, usually, what we've seen is gold has become an investment at times of crisis. But when you're betting on economic growth, that's when the equity picture comes in. So it's a very tricky situation that India is sitting on right now as well, along with the world. But thank you so much, gentlemen, for joining us on the show to have this fantastic discussion, whether gold or equity or whether gold or silver. Thank you, Naresh. Thank you, Tejas, as well as, over Suvankar as well for joining us on the show and sharing.
That's huge. That is a biggie. It's out of there.
Gold Plus Clear Glass. Far हो या near, सब कुछ दिखे clear.
These second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 6770, 6780 odd range for the day, it can give you a good range breakout. And the targets would be towards 6900 to 7000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore. Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Mahima Vajrajani. Quickly on to where we are, where markets are at. Now, seeing a bit of a cool off. 7 straight sessions in the green is where we closed yesterday. Down around 1/3%. Nothing major, and therefore, would we really complain? Well, I would perhaps want to believe not. Let's look at the intraday chart as well on the Nifty. It's been a fairly steady ride pretty much through the day. We've operated in a very, very tight band of just about 112 odd points or 108 odd points, and therefore even from that perspective, we are holding in good stead. Let's look at the heat map on the Nifty in terms of stocks which are doing well. Fairly even Steven where the breadth is concerned on the Nifty. IndusInd leading 4.5% higher, but what's not doing as well is some of the FMCG names, and those especially that have come out with numbers. Something like a Nestle was one of them. HUL is the other one, and we'll talk about a little bit about that part of the market and what we're making of it. Tata Consumer though relatively okay on the back of its numbers, up 1% or thereabouts. Of course, SBI Life, we are expecting numbers of that one also to come out today, and you'll also have an Axis Bank. So maybe 3-4 Nifty companies expected to come out with numbers, and we'll discuss some of those aspects as well today. Let's look at the contributors on the Nifty if we can. And there you go. So that's how the contributor chart is looking. And ICICI Bharti actually contributing sharply negatively to the Nifty. In fact, nearly half the negative points on the Nifty contributed by only those two. So it's skewed in that sense as well. But otherwise, just mild losses is what certain pockets are trading at. Let's look at the sectors and thereafter the advanced decline before I hand it over to Mahima to take us possibly through broader markets. Nifty Pharma is up 1%, and that's the only possible bright spot in everything that's playing out. Metals, all right, doing okay. Realty is the one which is really taking it on the chin, along with FMCG on the back of the numbers. IT down 0.5% thereabouts. The Nifty Bank not doing much, frankly, absolutely flat. The Nifty PSU Bank as well, slightly, mildly in the negative, if at all. Let's quickly zoom into the Nifty Pharma, because that's the one index which is standing out. Look at the constituents. And something like a Divi's Labs really stands out. Natco Pharma up 9% as well. Ajanta, Sanofi, plenty of buzzers within that pack. And there are some losers as well. And Ipca, Biocon down 1.5% plus as well. But let's look at the advanced decline very quickly if we can. Just try and assess the breadth. It's turning difficult very, very quickly, even though for a predominant part of the day we've been doing okay where the breadth is concerned. We're suddenly turning negative. Mind you, the exact reverse of likely what happened yesterday, where towards the fag end of the session, the breadth turned positive. Currently, slight bit of negativity creeping in. Mahima, broader markets.
Right, absolutely. So, we've observed in the advanced decline ratio as well, we are, inching towards declines being more than advances. But in terms of the broader markets, there are mixed cues. In terms of the mid-cap 150, it's down by about 0.08% versus the small cap 250, seeing some gains of about 0.1%. Stock specific, well, some counters which are really romping in trade today. There's something like Sami Hotels, there's MMTC, Newgen Software, Natco Pharma, Sonata Software as well, VIP Industries, all these counters, seeing significant gains. MMTC up by 15%, Sami up by 12%, Newgen up 14%, Natco Pharma as well as VIP Industries and Sonata Software up by about 8%. Some counters like Triveni Engineering, Maxon Pharma, also doing well in trade today, up by about 7%. Some counters which are languishing in trade, there is Sterlite Tech, which is not doing very well, facing a significant amount of pressure. Let's in fact pull up the BSE 500 and see what are those counters which are feeling the heat in trade today. There you go. There's Sterlite, there's Syngene International, Rallis India on the back of its earnings, Macrotech, 361 WAM, HUL again on the back of its earnings, because management has in fact reduced their margin guidance. Earlier it was around 24 to 23%. Now they've said they will do 23 to 22%, and that will come at the lower end of that band is what the management has said. Canfin Homes also down by about 3%. So all of these counters to keep an eye on in trade today. With that, let's also discuss Sami Hotels a little in detail. The stock has been buzzing in trade today, and this is on the back of significant updates coming in for the hotel. GIC is set to acquire around 35% stake in 3 subsidiaries of Sami Hotels, and this will be nearly for 752 odd crores. Subsidiaries that own Courtyard and Fairfield by Marriott in Bengaluru, Hyatt Regency in Pune, as well as Trinity Hotel in Bengaluru. And these 3 subsidiaries, just to give context, Ascent Hotels, around 12% of revenues comes from that particular hotel, and it's around 11% of the total net worth. In terms of Inma Tourism, around 2% revenue comes from that particular subsidiary, and around 3.5% of total net worth is that particular subsidiary. And lastly, Samhi JV Business Hotels, around 16% of the revenue comes from this particular counter. But the second update is that GIC is also set to establish a JV platform to upscale the hotel assets, and the company is in pact with GIC to also build a hotel investment platform, and around $300 million is the investment plan here. And lastly, they are also in pact with GIC to incubate around 5 hotels. The total enterprise value for the entire D will be around 2,200 odd crores. Now, how does this benefit Sami, and why the stock is seeing significant up moves in trade today is because management expects to repay of 580 crores of debt using this amount that will come in, and around 50 to 20% upward impact of PAT is something that the management has guided for. And lastly, an incremental free cash flow will also be seen, and this will be on the back of reduction of annual interest expenses on the debt that will be repaid. So this is the overall view as to what has happened with Sami and why it is buzzing in trade today. With that, let's also welcome in our guest for the day, Kush Bora, founder of kushbora.com, joining us now. Kush, very good morning, very good afternoon to you. Before I move on to the markets right now, I just talked about Sami. What are the charts indicating? Is this the right time still to enter after 12% of gains?
Hi, a very good afternoon indeed. Well, I don't think it's a good idea to go out and buy now. Stocks actually had a good run. It's had a breakout about 4 or 5 sessions ago from those 150 levels, consolidated for 2 or 3 sessions, and then a breakout again today. Now I think it's at a point where you might want to see some cool off. If you have an existing position, you might want to continue holding on to that with the trailing stop loss around the 185, 187 mark. But any fresh positions I suppose should be considered near the 180 level. That's where the support zone is, 178 to be precise. So closer to those support levels, the risk reward ratio will turn favorable again. So while this is a good move, the momentum significantly high now. But for fresh positions, it's best to enter on declines.
Wait for declines on Sampi is Kush's view. Kush, what's the sense like on the index, the Nifty, Bank Nifty?
I think pretty much similar, Harsh, isn't it? I've been saying the same thing for the last couple of sessions now.
We'd like you to repeat it.
With pleasure.
And give us levels, Kush. Give us levels because
absolutely.
Hopefully that will also give us better perspective on what to expect. We've got one trading session left in the week, and thereafter we'll have a fresh week as well. So.
Absolutely, yes. So, look, as I said, let me start with this, that the overall view on the index is bullish. The medium trend is positive, and you are looking at Nifty closer to 24,800, perhaps even 25,000 in the coming months. So that's the broad setup. But from a very near-term perspective, as I have maintained that, the indices were overstretched. You're starting to see some negative RSI divergence on the Nifty on the daily chart, some cooling off today. This is more on account of expiry, more than anything else. As far as levels go, a good entry point for Nifty will be the 24,000 to 23,800 band. Anywhere closer to this, the risk reward ratio will turn favorable from a near-term perspective. You could keep your stop losses near the 23,500 mark and stay long for another 1,000 points upside on the Nifty. As far as Bank Nifty goes, that zone, that buying zone is 54,700 to 54,400. Doesn't have to be precisely within that range, but somewhere closer to that. So the 54,500 zone is where you might want to accumulate. Also, if you look at the components, SBI, ICICI after that stellar run are showing some negative divergence. So some cooling off on those names also is perhaps on the cards, which could drag the Bank Nifty a little lower, closer to that buying level. So as I said, the medium-term trend for both the indices, Nifty and Bank Nifty, is bullish. It's just that I'll be more comfortable buying, near those support zones rather than at the current levels.
Okay. And Kush, your picks for this afternoon?
Sure. Still going with a long and a short. So CDSL makes the cut today on the long side. A good move on the upside. There was some resistance around the 1350 mark that's been cleared today on the back of decent volumes. This up move could well continue towards 1415 and 1455 mark, 1335 being your stop loss. On the short side today, I've got IGL. We did see the stock bump up quite a bit, but hasn't really been able to cross the 20 and the 50-day moving average congestion zone near the 190 mark. Some selling pressure, very clearly emerging on the stock. While it's a little flattish today, I think in the coming days it could resume its downturn. On the downside, you've got targets of 181 and 177, 189 being your stop loss.
Okay. Kush, anything that you're observing on the charts for HUL? It's down on the back of its earnings, of course, but what are the charts indicating? Any positive hope there?
I mean, there's always hope, but I wouldn't keep at the moment for something like an HUL. The reason being that the stock was in an uptrend. If you see the high for the day, has been at the 200-day moving average, precisely at the 200-day moving average, and the stock starting to, see cracks from there. So I think from a near-term perspective, it's run its course. I think yesterday was it when we discussed the FMCG names, and I said I prefer the likes of Britannia and Colgate over, something like an HUL. Britannia is seeing some profit booking today, but mind you, this is after a very good run, and this is also still above the support zone of 53.50. So if you want to consider anything in the FMCG pack, I think you should look at Britannia and Colgate. HUL might perhaps see some more cooling off in the coming days.
Okay. Thanks for that, Kush. Time for our management conversation this afternoon, and we have with us Suresh Iyer, Managing Director and CEO at Canfin Homes, to talk to us about Q4 numbers and possibly what to expect going forward. Welcome. Good afternoon, Suresh. Just quick check with regard to how the growth journey is expected to be, maybe over the next year or two. What's the anticipation like? You've clocked a 9% odd growth on a YOY basis for FY25. It's slightly on the softer side. More dark clouds, or you expect things to get better going into FY26?
No, I think Q4 itself is reflecting improvement because Q3 we had issues in Karnataka mainly because of the e-Khata.
Yes.
But Q4 things are improving, and we've had a 31% growth in disbursements in Q4 compared to Q3. So that itself is reflective of that the things are coming back on track. For FY26, we are looking at a 20% growth in disbursements, which should result somewhere around 13% to 15% of AUM growth. So I feel that it should be very much possible, and definitely we don't see a problem in that.
Point taken. Where do margins go, Suresh? It's a fast evolving environment. You've got the repo rate cut, which has come through now 50 basis points. How quickly does that translate, and are you able to retain some amount of margin from that cut?
See, in the repo rate cut, in fact, it is more applicable for banks in the immediate, as an immediate result because they are in the EBLR regime. Whereas in our case, since we don't have the EBLR compulsion, we will be passing on to our customers only post the impact on our liability side. So we have a little buffer or a time lag that will happen on the asset side, passing on or transmission of the interest rates. But what normally happens is as our bank term loans, the rate cut or the impact comes only at the time of the next interest payment, which is at the quarterly levels. So the February rate cut that was there, we got the benefit, and once we paid the interest on the last week of March. But the April rate cut, we will probably get the impact or benefit only when we make the next interest payment at the end of June.
Okay. And therefore, margins, Suresh, should be in around the 3.65% range, which you've been at.
Yes. So we are basically, giving a guidance of 3.5% NIM and 2.5% spread, and that I think should continue. We've of course been having a NIM greater than 3.5, closer to 3.65, 3.7, but we've been guiding for 3.5 and 2.5 with the whole of last year and current year also. We continue the same guidance.
Got it. Suresh, see, your ROAs have touched 2.6%. You've guided for a lower number, but at 2.6%, you believe that at the higher growth clip of 20%, you can sustain 2.6, or what would you go towards therefore?
No, in case of our ROA, it is 2.24. Our spreads are around 2.55, 2.6.
Okay.
So ROA, we have also been guiding for 2.1 plus. And the whole of last year also, we have been able to maintain at around 2.15, 2.2. And so we will continue to have that kind of a thing. And I don't see much of an issue because our ROAs are also high. And our gearing also with that, the rate of growth of 15% that we are talking about should be actually accretive to us.
Suresh, unless I'm getting something wrong, ROA for Q4 was 2.59.
Q4, yeah,
correct.
Q4, but for the full year it is 2.24.
Absolutely agree. So you believe that 2.1 to 2.2 should be the band you'll continue to operate in, and the 2.6% is a bit of an anomaly. Just trying to kind of get that.
Yeah, that is correct.
Perfect. Okay. Suresh, how should one look at OPEX within the larger scheme of things? It's grown at a decent clip. Therefore, where should it go from here? Do you expect some amount of OPEX advantages to flow through FY26?
Not really. In fact, our OPEX will be kind of range bound. Our cost to income ratios are already very, very low and quite to the bone. We in fact expect for next financial year, that is FY27, an increase because we'll be investing in our IT and all the expenses will start kicking in. But for FY26, we expect it to be in the same range kind of. No major expenses which are expected in the current year. And we do have some branch expansion, but they are not going to be a major impact on the expenses.
Got it. And Suresh, this 20% growth clip that we're speaking about, you expect that kind of tailwind to continue maybe a year or two ahead as well? Or is this just because FY25 has been a difficult year with regard to growth and therefore you're going to see a bounce back in FY26? What's the trend looking like?
Actually, this last couple of years, we've had a lot of changes on our processes into our internal controls and all those things. So actually, the 2 years have been an aberration, whereas actually the 15-17% AUM growth on a consistent basis is what will be the normal for the next few years, I believe.
Okay. And
what do you believe in terms of processes that has changed and should therefore really aid in terms of the tailwind for Can Fin Homes? Is it a turnaround story of sorts, and therefore, even from an investor perspective, and many of our viewers will be, is this something that has deep value, is what I'm trying to understand. What changes fundamentally, and what's the glide path going forward?
Okay, so there are two things I would say. One is in terms of the processes that we have already changed, is more in the sense of adding controls, improving the processes, strengthening the oversight mechanism, strengthening the assurance functions, and all those things, which are more towards providing a very solid base for the future growth. The second part, which is the IT transformation, which is currently going on and which we expect to be implemented by end of November 25, that is going to be something which is going to give us a good amount of leverage, because that's one, it will add much more nimbler and robust LOS LMS for us. Second thing is, it is going to have an additional feature of digital onboarding and digital business, which currently we are not focusing, which is not presently there in our system. So basically that is where the economies will, our efficiencies will set in, that improvement will come in. The redundancy, some of the processes which are redundant will get eliminated, and some automation will also further kick in. So that is when the next phase, which will bring in some change, will come post November.
Geographic concentration, Suresh, does that change?
Geographic concentration, we are already moving towards a little more towards west and north, where we have added branches.
How quickly does it happen? Sorry, just as a loan mix change, how quickly does that happen for perspective?
So actually, we've had almost like 72% was the 5 southern states, which has come down to about 70. We expect in the next 3 years to bring it down to 65%, 65-35, 65 for south, 5 southern states, and 35% for the rest of the country. So it's something which, even with the incremental change, will obviously not change so fast. So we are looking at from a 72 to 28, which was 2 years back. We are already at 70-30. We would like to move it to around 65-35.
And any risks with regard to asset quality that you see? Of course, the system looks quite clean, but anything at all?
No, absolutely not. In fact, whatever has been there, we have kind of, I think the entire impact of the restructuring portfolio is already built in. There is no further surprises. We had in the third quarter a small blip in our SMA 0, which also has been corrected in this quarter. In fact, we've had a substantial reduction in our SMA 0, and as a result of which in this Q4, we had a 10 crore ECL provision right back.
Yes, absolutely. And that also, to some extent, aided the profit after tax and the ROA number. So yes. But thank you so much, Suresh. It's good speaking with you. Again, very interesting. Something to keep in mind. And just in terms of valuation, when I'm pulling it up, it's trading at around 1.41 times FY27 book value per share, as per Nirmal Bang. So maybe something to keep in mind. Thanks so much, Suresh, for that conversation. Kush, let me come across quickly to you. Do you have a view on Can Fin Homes? Of course, the stock not doing too well today, but from a technical perspective, give us your quick take.
Well, I would suggest, wait for the stock to settle, might settle somewhere close to the 705 mark, and that's when you should perhaps consider re-entering, the stock. It's had a good run over the last, 2.5 months. It's taken its pauses along the way, but on the whole, the medium-term trend has turned positive. So close to the 705 mark, with the stop loss around the 659 mark, a long trade can be considered. The 650 level has turned out to be a bit of a stiff resistance. So on the way up, this will again act as a resistance and a target. But on the whole, as I said, the structure looks good. Wait for the dip to settle, and then you can consider a re-entry or a fresh long position in Can Fin Homes.
Okay, so that's of course the take with regard to Can Fin Homes. But we're going to take a very, very quick break. But before that, one piece for viewers. In his first public rally since the Kashmir terror attack, Prime Minister Narendra Modi has vowed unimaginable punishment to the Pahalgam terrorists. Listen in to what the PM had to say. We'll slip into a break thereafter and we'll see you on the other side of that break.
Today, from the soil of Bihar, I say to the whole world, India will identify, track and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished. Every effort will be made to ensure that justice is done. The entire nation is firm in this resolve. Everyone who believes in humanity is with us. I thank the people of various countries and their leaders who have stood with us in these times.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buyback is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 6770, 6780 odd range for the day, it can give you a good range breakout, and the targets would be towards 6900 to 7000 levels.
Welcome back. You've tuned into India Market Close. Thanks for staying with us. We still have Kush with us. I want to quickly take a couple of questions with Kush. Kush, an IndusInd Bank is up 4.5% in trade today. From a fundamental perspective, I know from a technical perspective, my apologies. I know that you're not too keen with regard to giving out a view this way or that on IndusInd. Just wanting to know, does that view continue to stand, or has anything changed, at least this week?
Well, I think marginally you could say it's turned favorable, but ever so. The reason is that the stock's actually now gaining ground. It's made that base very lightly put. It sort of paid its dues. The correction has been pretty steep, but the base formation around the 640 mark, has come about. The stock's actually now hitting the 50-day moving average close to the 855 mark. So I think once that is taken out, you could safely say that at least the near-term issues for the stock are done. Do I still favor it over, the likes of ICICI, SBIs of the world, perhaps even a Canara Bank? Not really. But nevertheless, if anyone does want to consider, then once it is in the clear of the 850 mark, you could consider going long. The risk reward ratio, as we all know, since the fall has been rather steep, still remains very favorable. A deep stop loss, a positional deep stop loss is close to the 750 mark. And on the upside, you're looking at targets of about 940 as the first level, which could prove to be quite a resistance. But once that is taken out, perhaps even 1040 is on the cards. So you might want to just wait it out a little, see if this rally indeed continues after the expiry week. So 850 is the level to watch for. Beyond that, I think the stock could make further continue the up move that it is undergoing currently.
No, sure, healthy upside even post 850. So believe that it makes sense for us to wait till that point. Thanks so much, Kush, for the view. Let's go across to Somit, who's standing by with regard to everything that he's hearing from trading rooms and dealing rooms. Somit, what are you hearing today? Anything on IndusInd, by the way? 4.5% move.
Well, nothing much on the IndusInd. I guess there was some reports which suggested that some issues with MFI, but nothing so far on the dealing room when it comes to IndusInd Bank.
Sure.
But few stocks that have been in focus. Firstly, it's Emphasis. Now, if you look at the Nifty IT index, that has cooled off from the day's highest point, but dealers indicate that Emphasis is one stock that there has been some accumulations by large HNIs at lower levels for this counter. The second stock on the list is Maruti Suzuki. Dealers are saying that there are sell-offs on a DI desk when it comes to Maruti Suzuki at higher levels. In fact, the stock was much higher at one point of time. Now it's just flat around 11,900 mark. Third stock on the list is APJ Surrender Park or the Park Hotels. Dealers indicate that a leading mutual fund has been a buyer in trade for this counter today, and hence we are seeing such kind of a move. The stock is up around 7%. Dealers also indicate that the fourth quarter numbers can be very strong for Park Hotels. And lastly, it's CDSL and Intellect Design. A clutch of smart investors have started to accumulate both these stocks in trade. In fact, there was some buying done yesterday as well in trade, and the positional buy trades is what multiple dealing rooms have suggested to their clients as well when it comes to CDSL and Intellect Design. So keep an eye out for these couple of stocks.
Well, we will, Swami. Thank you so much. You made it mandatory for us to keep a track of everything that you say, so we will do that. Thanks. Let's quickly go across to Avinash though. Avinash, a view with regard to hotel stocks in particular, because you had a Sami Hotels, Mahima, which announced a couple of deals today with regard to GIC investing in it. So plenty of interest. By the way, Avinash Gorakshekar also joining us. Apologies. Let me quickly introduce Profit Mart Securities. Avinash, let me quickly take your view. APJ Surrender Park is what Somit is suggesting, and the Sami Hotels move that we saw today is also sharp. What's your view with regard to hotels? And while you are at it, ACC's numbers flashing at the bottom of your screen. We'll give you a quick take on that immediately after Avinash's view on hotels. Avinash.
Yeah, I think Harsh, talking about Sami Hotels, I think it's a major development. I think it's definitely positive for the company. My sense is, we had already suggested this stock earlier on your channel, and I think we continue to remain constructive here. Our sense is that within the second tier kind of hotel categories, Sami Hotels definitely should do well. In fact, they already have a lot of marquee investors from the time they went public. So I think the stock is definitely well positioned. I think investors could even look at buying the stock on declines. Today, the stock has moved up on this news. But overall, I think within the hospitality space, the kind of inventories they are building, and now with this new association, I'm quite sure that the earnings impact and the revenue impact and the overall business flow impact would get reflected in the year FY26. As far as I think which was Park Hotels is concerned, This is one of those stocks, Harsh, which has actually struggled after its public issue. Normally we have seen most of the hotel company stocks doing pretty well, but this was one stock which was lying ignored for a very long time. And I think they have a very strong property in Calcutta. Plus, they are now developing 2, 3 large hotels. So, the inventory pipeline is going to be pretty strong from the second half of FY26 onwards. So, hopefully, as you reported now that if the fourth quarter numbers are much better than what the street expects, which traditionally, the fourth quarter and the third quarter for hotel companies is quite solid, there could definitely be a significant amount of re-rating for Park Hotels because, unlike the other companies like Indian Hotels, Lemon Tree, Sami Hotels, Chalet Hotels, this stock has remained virtually lackluster with no moment. In fact, I think our technical guest, could definitely tell you on the technical side, what was the issue here. But today, 6% move is definitely a good move. I think investors could definitely hang on here if they can stay invested for the next 12-15 months.
All right. So if I'm quickly going to look at the numbers of ACC, which is flashing on your screen, the average estimate with regard to profit after tax was 500 crore. PAT has come in, strong beat on that count, 750 crore number. Largely in line top line, 5992 crore on the top line count. So largely it will be the margin which has really moved, which has aided that that number versus estimates. It's a very strong number. So of course, not much of a reaction on the counter. It's off the day's highs, but was trading in pretty much the same stead, even just immediately before the number. So that's how it's playing out, at least ACC. And we'll, of course, get you more on that one. Avinash, any view with regard to cement, and is there a preference within cement as well in any of the names?
No, I think cement, we believe that, Ambuja Cements and typically Ultratech, these are large players which should do significantly better. I think on the ACC numbers, Harsh, I would like to know whether, there is any extraordinary other income, but otherwise the numbers which have come in have actually been quite solid. I think, as you rightly mentioned, the markets were expecting a number of around 500 crores plus. So something more than that, and that too in such a significant way, clearly indicates that operating level, benefits have come in if they are, from the operating profits totally. But otherwise, if it's from some exceptional item, then I think we'll have to see the numbers. But otherwise, we are positive on the cement space. But our sense is that maybe the April to June quarter could be a good period because, last June and September was the election period. So there was hardly any buying done by government. Spending had completely stopped. So the June quarter this time and the September quarter, I believe the government is going to spend in a very aggressive way. So once, that kind of spending kicks in, I think you're going to see cement as a very large kind of beneficiary. And within that, I think Ambuja, Ultratech, these are the large players which should benefit first.
Right, we have more numbers coming in. EBITDA at 755 crore versus that of estimate of 760 odd crores. Margins also largely in line at 12.6% versus estimate of 12.8%. But it's also important to note that there's a one-off gain in the P&L which is roughly of 135 odd crores. Kush, any view on the charts with respect to any of the cement counters that you're looking at right now and anything that looks attractive?
Well, Mahima, I think, I've been fairly bullish on the cement space for some time now. I think it was in the last month or so where, we've initiated multiple calls, be it JK Cement, be it Ramco Cement, Orient Cement. So we've initiated a few calls. The entire sector has actually done rather well, or at least, a lot of stocks already have done rather well. I continue to remain bullish on JK Cement today. Also, if you see the move is fairly decent on this one. The volumes have also spiked up quite a bit. So I think 5400, 5550 are the targets to look for on the upside. Ramco Cement too, although it's come off the highs of the day, around the 1010 mark. But on the whole, if you see the structure still looks very positive for this one too. About 1030 and 1055 are the levels to watch for on the upside. So fairly constructive on the cement space.
Kush, any views with regards to where VIP Industries is concerned on the charts? Seeing significant gains in trade today. What are the charts indicating?
Well, they're indicating a revival for sure. However, if you put it in context, the stock's actually fallen off the cliff and has been doing so for the last, couple of years now. So I'm not sure if, this kind of a move is enough to build confidence in the fact that the stock could do rather well going forward. So I have my skepticism, as you can sense in my voice. I will wait and watch. I would actually look to look for the level of 350 to be cleared, some supply zone around those levels. If that is cleared, then perhaps you could see that a near term bottom is in place and the stock could start moving upwards. But after this multi-year underperformance, this is a minor blip. However, if it's on the upside, but it's still a blip. So I will wait for the 350 level to be cleared. I want a more meaningful volume accumulation also on the stock to happen, and then perhaps we could consider a long trade on VIP. For now, it's a wait and watch.
Avinash, how do you view, and we stick to what ACC is doing in terms of a reaction, because not seeing much of a reaction on the counter yet. Avinash, any move with regard to cement pricing, you think could likely lead to a bit of re-rating in these large cap counters, especially you spoke about Ambuja, Ultratech. Do you believe a significant move is necessary to expect?
Yeah, I think my guess is, now since we have entered the April to June quarter and construction activity has picked up, I believe, just ahead of the monsoon, if there are any reasonably good price increases, that would definitely aid the cement companies. But as I told you, basically, I think we would be awaiting some more big announcements from the government in terms of the spending on infra construction activities. And that is going to be a bigger kicker because volume growth is going to get significantly enhanced. So I think, yes, I think you could possibly look at companies like Ambuja, Ultratech, or for that reason, in the south, Ramco Cements. These are large players with large dominant capacities, and we are largely positive on the Western India side of the market where prices should move up first. So I think net, we are constructive on the cement space. I think ACC numbers, as I was mentioning, if you remove the one-off, then I think numbers are more or less as per in line with market expectation. There's no big earnings surprise which actually was getting reflected earlier.
Okay, it's that time of the show where we discuss the top stock of the day, and Syngene International is something that we've chosen for the day, and it justifies the kind of moves that we've seen in the stock. The stock is down by about 12.75% as we speak. The stock is down, and this is on the back of weak earnings, higher tax payments hit Q4 profit. EBITDA margin slipped due to higher employee costs as well. But Varsha, who tracks this very closely, gives us more details on that. Varsha?
Yes, thank you for that. The main reason why the stock is down is of course earnings, but also the outlook that the management has given. But let's see what are the key highlights when it comes to Q4 FY25 numbers that the company has posted. They've crossed 1,000 crore revenue in quarter threshold for the first time, but the revenue growth that you're seeing, that is 11%, is driven by the biologics, CDMO and commercial projects that the company has seen. The high pilot project conversion has boosted their research division growth, and the EBITDA margin decline of 80 basis points is due to lower gross margin, higher employee costs, and the net profit impact that you are seeing is one of the reasons is due to higher tax outgo. Now, if I were to talk about the interesting thing why the stock is actually under pressure is what to expect when it comes to FY26. The FY26 guidance has significantly below expectation, and they've reported a revenue growth is likely to be in mid-single digits, and there would be an adjustment due to client inventory balancing, and the mid-term outlook for CDMO sector is positive as per the company. But the new biologics facility will actually increase their operating cost and depreciation, which will moderate the EBITDA margin going forward to mid-20s. If you see the EBITDA margin, current EBITDA margin stand at around 29%, but because of this facility, the margin will be in the mid-20s, and there will also be a year-on-year decline in the profit after tax, which is anticipated. But we did speak to the CEO of the Syngene International, that is Peter Baines, on the growth outlook. Listen in.
So I think that, as the inventory adjustment plays through, that we would expect that to wash out in 27, and then the more fundamental underlying growth to emerge, and we'll guide on that later on in the year. It's too early to call, but fundamentally we would see strong momentum flowing through.
Understood. Also, Mr. Baines, just wanted to ask you a question on that. There was a concern about has Syngene lost any customers because some of the customers have switched to their captive centers. So any update that you can give?
No, I think we're building a broader and deeper customer base. We're seeing a lot of inquiries coming in from customers looking to rebalance their supply chains, and of course the impact of the China Plus One. The emergence of capability centres in England, I beg your pardon, in India, we see as a positive. What this will do is grow the ecosystem of life science in India, and that's an opportunity for us.
All right. So yes, that's Syngene International. Avinash, let me come to you with regard to this one. It's one of those pharma plays which is not playing out well today. One of those very, very few, because pretty much most of pharma is doing very well in trade today. So talk to us about what you think of everything that's playing out with regard to Syngene International, if you have coverage.
No, I think, clearly the markets have been disappointed because of the business outlook shared by Syngene. And I think clearly, at least in the next couple of quarters, we could see a little bit of stagnancy in the earnings. Margins have also not been up to expectations. And I think once new deals get signed up and new contracts begin, then I think possibly we could see a little bit of, re-rating and some sort of earnings accrual coming back. But probably for the second half, that is a time when Syngene again be looked at. But it operates in a niche space. It has got a very large marquee kind of customer base. So clearly this, outlook which has been shared by the management has not been taken very positively by the markets. And that's the reason the stock is underperforming. But from a longer term perspective, I think there are very few companies which actually operate in this space and run such a profitable model. So I think, in the near term, yes, challenges will be there and we could see a little bit of underperformance here. But on the broader pharma market, we are pretty confident that, despite the tariff issue, I think things would get sorted out. Companies like Sun Pharma, Lupin, typically Aurobindo Pharma, I would believe that, these are well positioned. Once the tariff solution and the pricing comes in, I think it will be back to business as usual, because typically, we have seen Indian promoters very aggressive in terms of their costing. They're pretty smart in pricing their products and getting very competitive vis-a-vis global companies. So I will believe, depending on the tariff and obviously the kind of molecule built-up these companies have, the pharma sector definitely looks good from a longer term angle. In the short term, we could see a little bit of volatility.
Okay, so short term, some volatility expected, but long term, still bullish on pharma. Kush, quickly, with regard to your view, Syngene International in particular, because such a large gash on the stock, what should a holder do at this point, and what are the levels to look for if at all one has to exit? Should one wait?
Well, the 640 to 630 zone, the recent lows that were made have actually been, the medium-term support zones as well. So if you want to give yourself that slightest chance of a rebound and perhaps exit at a lesser loss, then you should keep a tight stop loss near the 630 mark. A breach towards that will actually open floors for further downsides towards the 595 and 550 zones as well. But I don't want to go too ahead of, the structures just yet, because the 630 mark has proven to be a bit of a support zone. So keep that stop loss in mind. Let this day pass. If it does, close above that mark and tomorrow you see a rebound, that's when perhaps we should consider exiting. As I said, that will just aid in terms of having a lesser loss than you're seeing currently. So 630, tight stop loss, exit at any bounce that you get.
Right. So, shifting focus to the consumption theme, in the past 2 days, we've seen 3 major Nifty 50 companies, FMCG companies, come out with their earnings, and that pretty much sets the tone for the entire FMCG sector, because Q4 yet again is a disappointment for these FMCG companies, and commentary also coming in from the management is not very pleasing. Now, with respect to how numbers have fared out for 3 companies, that is Tata Consumer, HUL, as well as Nestle, Tata Consumer mostly in line. Tata Consumer, although performed better than its peers of HUL and Nestle, growth much better than that of HUL and Nestle. HUL mostly numbers in line. Nestle, slight beat in terms of where analysts had estimated, just a very slight beat. Now, in terms of how revenue and PAT have grown, Tata Consumer has seen a revenue growth of 17% and a PAT growth of 59%, but there's a one-off exceptional gain of around 125 odd crores there. So it is on the back of that. HUL saw a revenue growth of 2.4 odd %, which which the street was pretty much expecting, and a PAT growth of 3.6%. Nestle, on the other hand, saw revenue growth of 4.5%, but PAT degrew by 6.6%. However, the expectation of the street was that the PAT might degrow by around 8%. So slightly better there. Now, in terms of volume growth, Tata Consumer first time in its earnings has declared their volume growth, which came at around 6%. HUL at 2% and Nestle also at 2%. So flat growth almost for HUL and Nestle, but Tata Consumer did come out with a high single digit sorts of volume growth. In terms of margin trends overall, what is leading to these kind of margin trends? Both HUL as well as Tata Consumer, higher tea costs have fairly impacted the margins, and the commentary that the management has given, especially HUL, has come out and said that their margin band will be around 22 to 23%, and that too at the lower end of the spectrum. In terms of gross margins, they will remain under pressure in the first half of FY26. They're expecting a revival in second half of FY26. In terms of growth, revenue growth was largely led by pricing and not volume. These companies have been trying to catch up with the inflation, but overall the kind of price hikes that these companies have taken is not in line with where the inflation has risen. Tata Consumer did say that around 46% of price hikes was covered by the overall inflation. E-commerce, this is a separate trend where e-commerce growth has strengthened further this quarter. So general trade is slowing down as compared to the e-commerce trend. Faster growth. Now this is another trend that is being observed, that is faster growth has been seen in lower end of products rather than premium products. In the past few quarters, we were seeing that premiumization is something that is taking a step ahead and growing for these companies, but this time lower end of products are leading the entire pack. In terms of demand, rural recovery is taking place, but not at the pace at which it was expected. Urban slowdown still persists. And lastly, in terms of dividend recommendations, well, Tata Consumer has recommended a dividend of 8.25, HUL 24, and Nestle at 10 rupees per share. So this is entirely that one needs to know about how so far FMCG results have come out with. Avinash, I'll come to you. How are you reading these numbers per se, and how do you think that the overall FMCG pack will turn out to be this quarter, and what are you expecting as to how this will pan out in FY26 as well?
I think we are expecting a much better quarter in the April to June quarter, basically because our sense is that, today Lever numbers and Nestle numbers have come out. I think numbers have not been, very solid, but at the same time, they've been in line with expectations. As far as the growth is concerned, in terms of the volume growth opportunity, with the Met declaring a normal monsoon, I would believe that rural demand also would get reflected in the April to June quarter. So we are quite constructive on the space, but I think within that, we like companies like Dabur, Marico, typically, smaller FMCG companies, and of course, Godrej Consumer Products. Basically, Lever, I would believe, would take a slightly longer time to, get numbers getting reflected on the earnings side. Their base is large, so I think, and the valuations are not very cheap. So I think Dabur and Marico could be better bets in this kind of market, plus Godrej Consumer Products. But I think for the numbers to get reflected and the volume growth to kick in, we will have to wait for the April to June quarter. The March quarter is not going to show any big fireworks.
Okay. Kush, any of the FMCG, I know you said you don't like HUL on the charts right now, but any FMCG company that you think is attractive enough to enter into right now?
So as we discussed, I like Colgate and Britannia, but I'll add one more name to the list from, the three stocks that you mentioned, which is Tata Consumer, albeit it'll be on decline. 1,000, about 1,100 or thereabouts are the levels that you should look for a re-entry, because at the moment the rally has been so stellar that actually it's gone into overheated territories on the daily charts, and you're seeing multiple legs of negative divergences on the smaller time frames. So I would wait. The medium-term trend definitely intact, but a dip closer to the 1,100 mark, maybe even just under it, should be taken as an opportunity to enter. So yeah, these are some of your picks. Some of these names have actually started to do well on a sustained basis, at least on a price action perspective. So just to reiterate that, Britannia, Colgate, and Tata Consumer, some of these names are starting to look good.
Okay, so starting to look good, at least for Kush on charts. But let's look at what's in the bull versus bear segment today. Mihika is bringing this to us. Mihika, plenty of movement on this counter. over the last couple of days. Yesterday belonged to the bulls, today belongs to the bears.
Yeah.
Give it to us.
It's been a volatile movement. Yesterday you saw Worry gaining as much as 19%. Today it fell as much as 6%. And so here's the bull and bear. So first, market leadership. Worry is India's largest solar module manufacturer. It has a 14% share in India's manufacturing landscape. However, there are many key players that are adding capacity on an annual basis, and this rising competition can impact the company and eat away some of this share. Now, the company did give an FY26 EBITDA guidance. Management expects around 5,500 to 6,000 crores in EBITDA, and this is what led to some of the optimism yesterday. However, even if you look at the analyst consensus estimates for FY26, they expect around 4,300 crores of EBITDA level, and this is despite considering a 40% revenue growth in FY26 for the company. In terms of margins, the company did see 21% of margins. Management has said that their current margins are sustainable, but this is a pointer that the entire street has worries on, and they expect margin moderation from FY28 for something like Avari Energies because of the rising competition I spoke about earlier. The next thing is the US business, which is also the export opportunity for Worry. Now, their 1.6 gigawatt of capacity is already operational. They plan to double the US module capacity to 3.2 gigawatts by FY26, and they are India's leading solar module exporter, most of it going to the US. However, there's uncertainty around IRA incentives that local manufacturers in the US are getting because of Trump's policy changes, and the management has also said that the FY26 overseas revenue share is expected to be 17 to 22% versus 57% in FY24. And then when you look at the stock performance, it has gained around 22% of listing, and valuations are attractive when you look at a Premier Energies, which trades at a PE multiple of 42, but Worry trades currently at a PE multiple of 31. However, this is a key pointer why we have 3 sell calls out of 4 analysts tracking this stock, and they still believe that Worry has high valuations and the risks are not baked in.
Very interesting. Thanks for that detailed, piece with regard to Worry Energies. Avinash, plenty of moving parts here, that there is no doubt, including the fact that tariffs could well impact businesses like this, as well as pricing, of course. How should one look at it in your view? And how should one play the theme? Because power is, of course, a very big theme, even domestically, that you can play in India.
No, I think clearly, Harsh, Worry is definitely well positioned in the solar, modular space. They are an integrated player, and very soon, they would be getting into solar cell manufacturing. And that would obviously give them a significant edge in terms of margins. And plus, they have a very strong order book. The management is very hopeful that they would be obviously be maintaining, EBITDA margins. Clearly, I think at least for the next 12 to 18 months, the order book visibility is going to give a good push to the top line. But once surplus capacities come in, I think that is a time when the markets would keenly await and watch how the company responds to competition. Clearly, I think supply is going to come in a big number. So my sense is, it's better to hold the stock for some more time. Fresh buying, I would suggest if the stock corrects further, then I think that could be a good opportunity to accumulate. But definitely medium to long-term prospects are good. But the challenges remain that despite growing demand and a huge runway, competition is also going to increase quite fast. So I think it's better to wait and hold. Fresh buying, not advisable.
Fresh buying not advisable in something like a Worry. Kush, I know charts are limited here, but is there a view that you have?
Well, very similar to Avinash's, no fresh buying suggested at this level. The stock actually run up quite high, quite fast. Some cooling off is par for the course. I think around the 2600, 2650 zone, should be a good entry point. And then perhaps, you could start accumulating at around those levels. But at the moment, no fresh buying recommended. 2650 are the levels to watch for to start any kind of accumulation.
Okay. All right, Kush, Avinash, we'll let you go on that note. Thank you so much for joining us and giving us all of those views this afternoon. And what we'll do is we'll slip into a very short break. On the other side, we'll get you a little bit more with regard to pharma, because that's one piece which is buzzing. We'll get you more views on the FMCG space as well, and we'll get you top BTST ideas as well. So stay tuned.
second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
To India specifically, I really think India has
You're watching India Market Close. We have Laurus Labs, who's come out with its earning right now, and you can see that flashing on your screen. In terms of revenue, it's up around 19.5%, EBITDA up 74%, margins at 24.4% versus that of 16.8%. But Harsh was just saying that the expectation and the margin guidance that the management had said was 30%, and it has come at 24.4%. We'd have to see as to how Street is reacting. The Street has, I think, still not gauged that, it seems. But the Street right now is pretty much neutral about the earnings. In terms of the other income, it stood at around 58.6 crores versus that of 18.5 crores. So that's with regards to Laurus Labs. Even the net profit has seen a multifold jump at 234 crores versus that of 76 crores. So that's with regards to Laurus Labs. Of course, we'll get in more details from Varsha once she analyzes the earnings. Let's also get in Mr. G. Chokalingam, founder and MD at Economics Research, who's joining us now. Mr. Chokalingam, a very good afternoon to you. If any, by any chance, if you've had the chance to go through the numbers of Laurus Labs, how are you reading it? And of course, your take on the entire Nifty Pharma.
Yeah, it's a phenomenal. Year-on-year growth in the revenue is phenomenal, no doubt about it. Even the profit growth is amazing. But still, stock is slightly stretched in valuation, not slightly, quite stretched. Trading at around over 90p on FY25 numbers on a consolidated basis. So I would give hold rating for long-term investors, because in the short to medium term, the stretched valuation could be one risk factor, and second, we are yet to see what is ultimately going to come from the US president on India's pharma exports. He has already proposed to tax, implement a reciprocal tax. So one has to see. So therefore, I would give only hold rating, that only for long-term investors.
Okay, so that's the view with regards to where Laurus Labs is concerned, and of course, Mr. Chokalingam's entire take on the pharma space. We also have Girija Shankar Ray, lead cement analyst from Yes Securities, joining us now. Good afternoon to you, Girija. Just your take, your first read of ACC numbers, how are you penciling it? And overall, your take on the entire cement space.
Hi, good afternoon. Yeah. It was a kind of surprise, and it's really great number, what I believe, for ACC. In fact, Dalmia also numbers yesterday came, numbers were really pretty good. I can understand from the volume perspective, this is a volume-driven quarter. Obviously, volume has to be great. In fact, as per our channel 6 suggests, the volume could have much better, but it's okay. It's a pretty decent volume number the company has given so far. In fact, for ACC particularly, the number is really great in terms of volume. And coming back to the realizations, even in fact, on quarter-on-quarter basis, the realization is like I can say it's a superb realization they have delivered this time around to 2.7% quarter-on-quarter growth. See, somewhere it was being offset by southern region prices. Even from past 4 months, there was no price hike in southern regions. And that is the only reasons where this 2.7 has came. Otherwise, it would have been much better. But yes, in April, there is a price hike of around 45 to 50 rupees per bag in southern regions. Total price hike was around 70 rupees per bag, but it has some marginally, some prices were rolled back. That is the reason I am saying 45 to 50 rupees. If this price sustainability or kind of price hike the companies have taken in the regions, if this sustain for next 3 months, the first quarter will be a very good quarter for the cement space, as I mentioned. SCC specifically, what I see, even in fact, cost per ton, they got a very good operating leverage benefit in this quarter as well, while they have made a very big, volume numbers. So around 2.2% quarter-on-quarter decline on OPEX per ton. So for ACC, our assumptions, whatever our assumptions in, with respect to your EBITDA per ton, it is completely in line. We were expecting 675 EBITDA per ton, but this time they have delivered 673 EBITDA per ton. So completely pretty good number. If you see also street numbers, it is more or less in line with street numbers. So I can narrate it. The numbers are really great this quarter.
Right. Got it. And Geja, anywhere in the cement players that you're seeing valuation comfort now?
See, for the valuation comfort, as I mentioned, someone can look at Dalmia, the EV per ton, somewhere running at 80 USD per ton, and for ACC also. So these are the companies that are really in a very good space, I can mention. But yes, things may get changed once, we have to see for next couple of days or couple of weeks just to understand how this pricing is going to impact, whether sustainability is there for this pricing or not. But what I believe the momentum is going to continue, and whatever the demand, growth, what uptick we can expect from second half of FY26, because there are a lot of pent-up demand in FY25, especially quarter 1 and quarter 2. So definitely we'll see cement space to do good well.
Okay, well, Geja, thank you so much for giving us all those insights on the entire cement space, and thank you so much for taking out time and speaking with us at NDTV Profit. With that, let's also welcome in Rajesh Palvia, SVP Technical and Derivative Research at Axis Securities, who's joining us now. Rajesh, very good afternoon to you. How are you reading the indexes right now, the Nifty 50 and the Bank Nifty?
I think Nifty is hovering near to the important put-based support area of 24,200. So that's the important level for today's expiry day. I think if it's sustained about 24,200, I think trend is likely to intact on the bullish side. And then in the fresh series, in the new series, I think again, traction would be there on the buying side only, and then we may see further higher level. But looking at the near-term structure, 24,350, 24,400 are immediate supply zone for the near-term perspective. But I think till we are holding about 24,200, 24,150 zone, I think one should use any minor dip should be as a buying opportunity. For Bank Nifty, little profit taking is happening in the Bank Nifty, and now Bank Nifty is trading near to the crucial support area of 55,100, 55,000 level, which is very important and crucial for near-term trend. If Bank Nifty slips below to 55,000 level, then maybe we may see furthermore profit taking to initiate, and then possible down move can extend to the previous bullish gap area of 54,700 to 500. That's the bullish gap area is still there in the Nifty Bank Nifty daily chart. So I think that may act as a next major support area. So below 55,000, we may see further more profit taking to initiate.
Okay, so Bank Nifty, we'll have to be cautious if we break 55 is what Rajesh is saying. So those are some levels to watch out for. Rajesh, I wonder what's your quick view with regard to a Divi's Labs, because stock is up 5%, showing some remarkable resilience in a market like this.
Yeah, so Harsh, very strong momentum, especially in today's session. During the week itself, stock has gained almost more than 9%. The way stock has moved up to the again, near to the all-time high trajectory, and now negotiating with its multiple supply zone, which is placed at around 6240, 6250 zone. So I think if at all stock crosses above 6250 level, I think another round of up move can be there in the stock, and then possible target towards 6500 we may see in short period of time. Overall structure is bullish. Those who are already in long of trade can hold the position with stop loss of 6070. That should be trailing stop loss. And once the breakout happens above 6250, next target would be 6500.
This afternoon, Rajesh?
So first stock is Colgate-Palmolive. Colpal is looking very attractive. The way stock has moved up in last 7-8 trading session, now stock managed to cross its 50 to 100-day moving average. A rounding bottom short of formation is taking place on the stock. So Colpal can be looked at for buying side. Possible target towards 2790, 2800 we may see. With one can place a stop loss around 2700. The another stock where we are focusing is from the banking space only, that is RBL Bank. This bank is showing a strong buying interest in last couple of days. If we analyze on the daily chart, the rounding bottom sort of formation is taking place. 20-day moving average has been given a crossover on the higher side to the 50-day moving average. That's the sign of strength. We are projecting target towards 210 with stop loss of 194.
So those are the picks that Rajesh has given. Mr. Tokelingam, before we move on to Divis, for which we'll be doing a detailed analysis, your view on the entire FMCG space. We now have 3 major FMCG earnings in the Nifty 50 space that have come out: Tata Consumer, Nestle, as well as HUL. What is your reading? First of all, in terms of how Q4 has panned out, because this will set a tone for the entire FMCG pack. And secondly, do you think FY26 will be better? Because FY25 on an entire year basis, it has been a disappointing year for the FMCG staples especially.
Yeah. So FY26 first half also going to be a little disappointing for entire FMCG pack. That's my view. They are growing in single digit in Q4 FY25. That single digit volume growth is likely to continue for the industry as a whole in first half of FY26 as well. Second, however, the performance is not going to be homogeneous across all FMCG players. The financial performance would also depend upon the input price behavior. Like for example, if you take a Britannia, the wheat prices have crashed about more than 20% in the last few weeks after robust arrival of wheat in the markets. And similarly, the sugar also weakened, and palm oil prices also corrected significantly in the last 2 weeks. So even if a single-digit volume growth is there in the biscuit segment, Britannia bottom line would do very well because of input price fall. So this is an example. So from this perspective, I feel that Britannia among FMCG would do very well. And I would also continue to recommend ITC. ITC is continuously going in for a lot of acquisition in other FMCG segment. Even in paper, they have done some acquisitions. And all this would augur well for re-rating the ITC stock, because the share of cigarette eventually should fall. So these are the 2 stocks I could consider for recommending buy within FMCG.
Some numbers at the bottom of your screen. You have Adani Energy's numbers. 35% revenue growth is what the company has clocked. EBITDA is up 44%. Margins getting better from 33% odd to 35% odd. So positive on that count as well. And profit after tax also seeing a bit of a surge in that sense, is up at 647 crore versus the 310 crore estimated. And justifiably so. You can see that spike on the stock. Stock is up 2.5% as we speak. So Adani Energy in focus. Mr. Chokalingam, would this at all feature as part of your investment basket within the energy space? Because the kind of numbers in terms of growth that this one is posting is standing out in an environment where otherwise power companies, energy companies not really demonstrating this kind of a growth clip.
Yeah, so it's a phenomenal, no doubt, year-on-year performance. I think it would continue to, perform very well. I believe that ultimately the large companies like Adani Energy, other companies coming from big industrial houses only would be able to grow. All the small and mid-sized players would find it very difficult to compete with the big players. Yes, we have, to our clients who are holding it, we have given a hold for medium to long term. In fact, if it declines even marginally, then one can consider buying.
Okay, Rajesh, any view on the charts for Adani Energy?
So Adani Energy as well as Adani Green, both stocks are looking attractive at this juncture, and I think the way a stock has moved up in last couple of weeks, we believe that furthermore upside towards 1,020 we may see in the near-term perspective. So I think one can initiate a fresh long also, and those who are holding can continue their position in this counter with stop loss of 945. Even for Adani Green also, there is a breakout on a weekly chart. So I think here also one can focus. This stock is also looking attractive for upside target of 1,020 with stop loss of 945.
Okay, charts of both Adani Energy as well as Adani Green looking attractive as per Rajesh. Let's also shift focus now to pharma space. Divis Lab is in focus, and Varsha joins us with exact details as to what's going on there. Varsha, what are you picking up?
Yeah, thank you for that. So Divis is, Divis has been surging now. This is on the back of Citi's note, wherein they've maintained buy with target price of 7,050, which determines a potential upside of around 19%. Now Divis is their top pharma pick. Now what they're saying is Divi's pipeline get a boost with orforglipron, that is Eli Lilly's, that is a global pharma company's GLP product, that is diabetes product. Now the planned capacity for this product is significant at 300 metric tons per annum, and the Divi's is also building 18 metric tons plus capacity for peptide GLP-1, that is the diabetes portfolio. Now the GLP-1 revenue for Divi's are forecasted at $800 million plus by 2030 with potential upside as well. And the complexity for this drug, that is GLP drug or diabetes drug, makes Divi's potential as the primary supplier strong, and the current planned capacity could drive 200 to 300 million dollars of annual revenue initially for the company. And the backward integration that the Divi's has been doing is a clear edge in GLP-1 manufacturing, and additional rounds of capex are likely beyond the announced $170 million primarily for GLP-1. So basically Citi has been bullish when it comes to GLP-1 product or GLP-1 API or intermediate that the Divi's will be making for Eli Lilly.
Right. Well, Varsha, thank you so much for breaking that down for us. Rajesh, your view quickly on the charts for Divis?
A very strong setup for Divis, and I think the way stock has moved up, it's now negotiating with its multiple supply zone. I think any move above 6250 can take this stock further higher. We are projecting target towards 6500 if this breakout happens above 6250. At this juncture also one can carry their long position as overall structure is bullish. At this juncture we are suggesting stop loss of 6070 to hold the positions.
So that's the stop loss and some levels to look out for on Divi's. Mr. Chokalingam, are you positive with regard to Divi's? I wonder, because certainly while business prospects look strong, valuation comfort not there. How should you view this one? Because good strong growth, good pipeline, good management, but valuations not in your favor. So how do you play it?
Yeah, certainly. I mean, amazing number, as you rightly mentioned, I just looked at it. But the stock is also trading at exorbitant PE. Still, I would not mind giving this kind of PE if company is going to maintain this kind of growth for at least another 4 to 6 quarters. The only one concern is that there's a lot of uncertainty from the US. we need to see what kind of reciprocal duty would come in. So pending that, I am not comfortable in giving this kind of PE multiple. So therefore, on any further rise, I would give a sell call on the short-term basis.
Mr. Chokalingam, every time we've tried to discuss FMCG, there's been something or the other that comes up in terms of earnings. So let me take the liberty to quickly ask you a couple of questions on FMCG. The first one being, consumption, is this the best way to play it? Just the volume growth isn't there. 8% for Tata Consumer on a very small base. Look at an HUL, you look at a Nestle, just no volumes seen, and plenty of pressure with regard to gross margin.
Yeah, you are absolutely right. I am not able to understand whether you are linking it to divis or absolute question on FMCG.
Different, completely different tack.
Yeah. So there are two structural changes happened, after learning from the market for nearly 3 decades. These two learnings are something new. The one is on the sector itself, as you rightly said, which everybody knows, is single-digit growth volume consistently for several quarters. That was not the case in the past, 20, 25 years. So despite, last Southwest monsoon being good, Northeast monsoon being good, even now the forecast of Southwest monsoon is normal. Inflation rate hitting, record lows, both retail and wholesale. Nothing is helping the FMCG sector to grow the volume in a strong double digit. So, and it doesn't look like next 2 quarters it is going to grow. Now, second, so what is the structural change? I am saying it is that, today the investor base, if you look at the NSE homepage, it has breached 22 crores. So in last 7-8 years, you saw more than 12-13 crore new investors have come in, and most of them are largely young investors. Now, these investors are, in my learning, majority of them are not defensive in nature. Many of them are interested in, making a quick return and taking very high risk. And that opportunity is not there at all in the FMCG. So I believe personally that in the last couple of years, as the investor base of young investors has boomed, the demand for FMCG stock in the market also in relative terms have come down a lot. I don't know how soon that's going to change. It is most unlikely that in the short to medium term, the young breed of investors who have come in crores in the last 4 or 5 years, I don't think they are going to chase the FMCG stock. So these are the two structural changes. Yes, it would remain as a defensive. We saw 100 lakh crore being washed out in the market after October from the overall market cap. Any such thing happened, then this would be proven to be defensive relative terms. But I don't think you can make a lot of wealth from the FMCG in the short to medium term. Yes, as I mentioned earlier, one can play for 10-20% return purely based on the individual growth story or the maximum significant gain from the input price trend.
Right. Mr. Chokalingam, there were a lot of reports that have come out and have said that a lot of valuation basis correction has taken place in a lot of these FMCG counters. Any particular stock, maybe from the small cap space, that you think where valuations have corrected enough? And it need not be a staple company per se, but any FMCG company, let's say retail or QSR or any of the, one of those stocks from that basket where you think that there is valuation comfort, as well as you are bullish where the growth prospects for the company is concerned?
So, unfortunately, all FMCG are large players. You have one small player, Jyoti Lab, that is also struggling with growth. And in other areas where direct consumer focused companies, really, I haven't come across any stock which gives me phenomenal confidence. The only sector which gives me tremendous confidence is the banking sector. Yes, the Q4 results may not be great across the board, but post that results, I see tremendous rise in the banking sector because monsoon forecast is good, inflation rates are at record lows, and the yield is falling substantially, and credit is continuously growing in double digit. So therefore, I am biased in favor of banking sector rather than the FMCG or other direct consumer players.
Okay, Harsh right now is smirking at me because he tracks the banking space very closely and I track the FMCG space. So he's happy, Mr. Chokalingam, that you like banks over FMCG companies. But with that, it's time to take Rajesh's buy today, sell tomorrow calls. Rajesh, what are you picking up there?
From automobile, I think from two-wheeler space, Hero Motor is looking interesting, and the way the weekly charts are shaped up, a falling trend line breakout is there on Hero Motor and comfortably holding above to 50-day, 100-day moving average. So I think this stock has potential to continue furthermore upside. 4,040 we are projecting target for BTST point of view. Keep stop loss around 3,915.
So, Mr. Chokalingam, I'll probably take the liberty of carrying forward on the consumption theme. So, if you don't play it through FMCG, right? Should you play it through maybe say a Hero? Is that a good way to play it? Consumer discretionary, is that a good way to play it? Consumer durables, how best would you play it, or would you just avoid it altogether?
Ultimate objective is to make money in the stock market. So that's what I learned in the last 30 years. So I am not married to the theme. I may be wrong, I can be right and all, but I always look for where I can make money for me or my clients. That's the way I approach. So definitely coming back to your question directly, yeah, one can look at two-wheeler because the two-wheeler segment remains as the topmost performing segment within the automobile. So there one can definitely play on these, emerging possible rural growth uplift due to the monsoon. So one can play on stocks like, TVS Motor and Hero Motor. And relatively, they have a much larger scope for the Indian market, from Indian market rather than to huge exports. So these are the two stocks. And also some of the component companies, small cap companies, which are likely to benefit from this robust outlook within the automobile sector in relative terms. There are one or two small and mid-cap companies which can benefit purely based on the domestic demand scenario. So one can consider those small cap stocks as well.
Right. Flashes at the bottom of your screen. Gensol. Now, ED sources seem to suggest that, of course, they are going to initiate and a case is going to be registered under the PMLA, which is the Prevention of Money Laundering Act, very, very shortly. So while nothing has been done as of now, and we got that clarification from Gensol overnight, expect something in terms of an evolution in that space very, very soon, because the ED is likely to register a case shortly with regard to that. Mr. Chokalingam, a little bit more on this. So many pieces within Gensol and even outside with regard to corporate governance which are playing out. This is just the latest one which has blown up. But the smaller ones, you have an IndusInd Bank as well, a PFC which has linked to a Gensol, and they also came out with their set of clarifications which weren't put out on exchanges. And you also have an IREDA, for example. How do you view processes of lenders lending to these institutions? Do you believe that is just nothing that the lender can do? And how do you believe that you look at, and how do you view a Gensol, and how do you view an IndusInd Bank at this point? Just trying to cover the whole gamut in one question.
Yeah, very tough question. Of course, I have answers coming on media. That is a tough question, but still I would give my views. First, to the lenders. I think it's a tough job, and I am sure the lenders have got an army of team, risk management team, which can definitely do better job than analysts. Still, they may go wrong, but very difficult to be, absolutely right. So one criterion, what one has to see, whether they have exposed significant proportion of their net worth to a particular lender, then that would be wrong. And I believe that is not the case with these two PSUs. I looked at the number, it is manageable, so one need not worry too much about those two PSUs. Now coming to IndusInd Bank, this is very surprising, and I believe one should look for other banking stock till all the the investigations completed and all the facts are on the table. Because we have already seen banks like Yes Bank and a couple of more mid-sized banks, when there was some question mark or possible observations on the governance, immediately the market contracts the valuation multiple substantially, and therefore possibility of recovering your money is quite remote. So therefore, I would stay away from IndusInd Bank. Third, coming to Gensal, we haven't recommended, we have not touched. Well, it's very difficult even for the analysts and investors to forecast this kind of episode. But still, even on this channel, I've been saying continuously for last 6 months, ever since the stock market started correcting. So one parameter, if investors have followed, they could have avoided the wealth destruction. That is, if you are paying 80 PE, the intelligence investors say that the profit should grow, are expected to grow 80% year on year.
Right.
So I was saying last 6 months continuously that at least see that the profit grows, if not at 80%, at least 40-50%, little more than 50% of the PE ratio.
Sure.
And that was not the case with the Gensal. If your people have followed this, I think they would have avoided a lot of wealth destruction in many more stocks, new age and new companies in the last 6 months. So that is what I would suggest to retail investors.
Point taken. Thank you, Mr. Chokalingam. Thank you, Rajesh, for joining us. We've closed for the day as well. Let's quickly look at the markets. We'll let you go on that note. 1/3% lower on the Nifty 50, 24,200 held. That's the one positive. The Nifty Bank also down around 0.4% thereabouts. So some pressure on both of those indices, but nothing to complain about because we've had a phenomenal run over the last 7 trading sessions where we've closed in the green. So this one little blip, not much to complain about. Let's look at the intraday chart as well, and what we're seeing on the Nifty at least is it's been a very range bound day of trade. 24,216 was the low and just about 130 points between the day's low and the day's high. So fairly range bound in that sense, and if we take out that one spike, you'll likely see that range contracting even more. But we've closed just off the day's lows and we clocked the day's lows sometime in the last half hour of trade. So something to look out for as well. Let's look at the heat map on the Nifty 50 and the heat map suggests that there's been some contraction with regard to the breadth on the Nifty 50. Of course, we look at the broader markets and how they fared as well. ICICI Bank was one which stood out and I'm sure was one of the top contributors with regard to the Nifty's losses in trade today. But outside of that, IndusInd stood out. There were some pharma names which have done fairly well for themselves. Ultratech has done well on a day when ACCs come out with numbers. Tata Consumer's numbers were out 1% higher. HUL and Nestle came out with numbers. Both were a tepid set of numbers and 4% lower on HUL, even though largely met estimates. 4% lower on HUL on the back of that. So something to keep in mind. Bajaj Finance and plenty of announcements across the board. Bajaj Finance looking at a stock split, a bonus. Despite that, the stock down around 1/3% thereabouts. Let's look at the advanced decline very quickly before I hand it over to Mahima for broader markets. The advanced decline has been a bit of a flip-flop today, at least towards the end, but we've seen the breadth turn negative towards the end, the fag end of the day. 1200 to 1000. I'd take that, Mahima, given that we've had a phenomenal run for the last 7 odd days. Absolutely. On the benchmarks.
Plus, the expiry is probably playing its role as well.
Absolutely. Some part of the expiry also playing a role.
Its role. And the ratio is hardly 1:1:2. So,
correct.
I mean, it's a give and take.
Yes.
Let's also take a look at how the broader markets have fared. Well, again, a mixed skew. The mid-cap 150 closed around 0.17% lower, but at its day's lows. Small cap 250 closed in the red, 0.05% lower, again at the day's lows, and quite far away from its day's highs as well. So that difference between the day's highs and lows is quite significant. In terms of the BSE 500, let's take a look at what stocks did well and what did not. There you go. Sterlite Tech significantly cratered in trade today, down by about 25%. Syngene International down by 13%. KPR Mills, textile stocks seeing pressure, down by about 4%. Canfin, Blue Star, HUL all down by about 4%.
Blue Star second consecutive day down.
Correct.
So and that HUL pressure from Havells seems to be seems to be moving.
Not really. It's not like a like-for-like peer, but maybe ahead of its earnings, it's down. HUL on the back of its earnings, significant disappointment there. Probably the street is not liking the growth metrics that the management has come out with. MMTC, the stock was up as much as 16% in trade today. It came down to around 11% and closed 11% higher. Whirlpool also seeing significant gains in trade today. KIOCL up by about 9%. Sonata Software, VIP, Natco Pharma, Vaibhav Global saw significant up moves of around 6.7%. Anupam Rasayan also up by about 5%. So that's with regards to where markets are concerned and what to watch out for. Let's also pull up as to what will we keep an eye on post market hours today. Well, eye on the globe, US initial jobless claims data will come out. US existing home sales data will come out, and US unemployment claims data will come out. So both of these important to watch out for. In terms of corporate actions, well, interim dividend last day for Muthoot Finance at 26 per share. Sanofi India at 117 per share. So both of these counters to watch out for. In terms of face value split, this is the subdivision split where AMI Organics, the former value was 10 rupee per share and now it will be 5 rupee per share. In terms of shares that will see exit in terms of its lock-in period, Vari Energies will see around 53% exit in terms of lock-in period. So tomorrow will be an important day to watch out for as to how this particular stock reacts. Earnings in focus tomorrow, big earnings, Reliance, Maruti, Hindustan Zinc coming out with their earnings. A couple of names like Kesoram which has been extremely volatile in trade. L&T Finance, Lloyds, Motilal Oswal, Tata Tech to watch out for. There's Bank of Maharashtra, Dr. Lal Path also coming out with its earnings. Oracle, Poonawalla FinCorp. All of these names to watch out for. Banking names, couple of banking names. There's DCB Bank, Bank of Maharashtra that will come out with their earnings tomorrow. So all of these things to watch out for definitely post-trade market hours. But with that, we're completely out of time on this edition of India Market Close. Stay tuned to NDTV Profit for more news and updates on the other side.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bhogna. Now let's get straight to the show. Viewers, the benchmark indices ended the session off their day's high point. While the Nifty concluded above 24,200 levels, the 30-pack Sensex dropped from 80,000 to close to around 79,800 levels. The broader markets outperformed the benchmarks, with the Nifty Small Cap 250 standing stronger than the Nifty Mid Cap 150. Most sectors end with significant cuts, with realty, FMCG, consumption, finance and banking dragging the most. On the other hand, pharma, metal and media concluded in the green, and Nifty oil and gas sector ended flat. Market breadth stood skewed in favor of the declines. Tata Consumer came up with its fourth quarter earnings yesterday, posting numbers that were largely in line with street expectations. The biggest revenue growth was due to pricing. The Indian business outperformed the international business as the revenue grew by more than 18%. The highest performing growth in the category segment was by India Food Organic. After the quarter four numbers of Tata Consumers, brokerage firms issued a positive note on the company, where Citi has initiated a buy note setting up a target of 1,350 rupees. JP Morgan has said that it has a neutral stance with a target of 1,100 rupees. And Jefferies have put out on a hold from buy, altering the target price to rupees 1,100. Now let us know to focus on Rallis India. They came out with their earnings report yesterday. Their fourth quarter revenue was marginally down by 1.4%. Their net losses stood at 32 crore rupees, while their exports increased by 6%. The company also stated that they had a positive volume growth in domestic business in fourth quarter of FY25. Pharma major Lupin received an approval to launch a new drug today in the US. The drug is called tolvaptan, which is used to slow down the kidney functions as well as helps in treating low sodium in blood. US FDA issued an approval for this drug back in 2023. Along with that, the production and manufacturing of tolvaptan will be done at Lupin's Nagpur facility. Now, the drug not only has the potential to increase Lupin's US sales exponentially, but also serves a head start to the company's FY26 revenue opportunity. FMCG giant HUL's quarter four came in